So today we'll take one more question on over the counter derivative. Please come to question number 4. Question number 4 is based on equity swap. A new type of question, you may or may not have done it before. So question number 4 is like this. CMT pension fund has a portfolio of shares of diversified companies valued at rupees 800 crore, enters into a swap arrangement with Boom Bank on the terms that it will get, underline, it will get 1.5% quarterly on notional principal of rupees 800 crore. So you will get 1.15% on a notional amount of 800 crore quarterly in exchange of return on portfolio, which is exactly tracking the Sensex, which is presently 43,200. So this will be swapped against Sensex return. This company CMT pension fund will pay Sensex return and will receive a fixed rate of 1.15%. So if it has to receive more and pay less, the difference will be received. But if it has to pay more and receive less, the difference will have to be paid. Okay, so we have to compute two things every quarter. We have to compute this amount, which is a fixed amount, but we have to compute the Sensex return every quarter. Sensex return every quarter will be the change in the Sensex divided by the base. The change in the Sensex divided by the base. So Sensex at the end minus Sensex at the beginning divided by Sensex at the beginning will give you return on the Sensex. You are required to determine the net payment to be received or paid. Very easy question once you solve it and once you practice it. This question is from October 2021, MTP for 6 marks, and it was asked earlier also. And these are the different Sensex values given at the end of each quarter. Sensex turns out to be 1, 2, 3, 4. So 4 calculation you will have to show. Would you like to try and tell me in the first quarter, how much amount will be received or paid? In the first quarter, how much amount will be received or paid? Anybody wants to try? In the first quarter, how much amount will be received or paid? This is the amount to be received. You have to compute the amount to be received or paid on Sensex. Anybody who wants to reply? Okay. So now I will try, but first I will give you a small note. Would you like to write the note? Say yes or no. Note on equity swap. Note on equity swap. Write down a small note first. Write down a small note. The above question is based on equity swap. The above question is based on equity swap. The above question is based on equity swap. Then write down, suppose they ask you a theory question. So tick mark for a 4 mark theory question also. Tick mark for a 4 marks theory question. Equity swaps. Equity swaps are derivative contracts. Equity swaps are derivative contracts between two parties. Equity swaps are derivative contracts between two parties. that involve the exchange of future cash flows with one cash stream determined on the basis of equity based cash flow that is your Sensex basically in our problem as return on equity index. One cash flow will be calculated based on movement in the Sensex, while the other cash flow stream depends on fixed income cash flow, which is 1.15% in our example, while the other cash flow stream depends on fixed income cash flow like LIBOR. Okay. So after writing this note, we will solve the question. The question is very easy. You have to compute how much amount is payable due to change in Sensex, how much amount is receivable, the difference between the two will be received or paid. So you have entered into a swap contract that you will receive a fixed income of 1.15% on a notional amount of 800 and you will pay the return on Sensex. So now we'll write down calculation of net payment to be received or paid. Presentation is equally important. Calculation of net payment to be received or paid. Calculation of net payment to be received or paid. Calculation of net payment to be received or paid. First you draw one table. Write down table heading. First write down heading quarter. Second write down Sensex. Which is given. Only the main calculation here is Sensex return. What is the increase or decrease in Sensex in percentage? Then we'll calculate column number 4, amount payable. This is what this company has to pay. Column number 5 is income receivable. Fixed income receivable, and the last column is net amount. 5 minus 4. Column number 1, 2, 3, 4, 5 and 6 is equal to 5 minus 4. 5 minus 4, if positive, is receivable, and if it is negative, then it is payable. So this table will help you to understand the answer easily. Have you drawn the table? Say yes or no. So first year 0 or quarter 0, the Sensex is today 43,200. That is the base for calculating the return at the end of quarter 1. Quarter 1 Sensex is 43,720. So your Sensex return will be closing Sensex minus opening divided by opening. Closing minus opening divided by opening into 100. Calculate and check. Is it right? 1.2037%? Yes. Is it right? 1.2037%? Okay. So you will pay 1.2037% of notional amount 800. So now you will write here 800 into 1.2037%, which is 9.6296. This is payable. This is payable. And receivable will be 800 into 1.15%. This will be every time the same calculation, 800 into 1.15%. So you have entered into a swap. You will pay swap based on Sensex return. You will receive cash flow based on a fixed return. So what is the receivable or payable in the first quarter? Please answer. What is the receivable or payable in the first quarter? 5 minus 4. Receivable is less, payable is more. Anybody wants to reply? Come on. The answer is payable. 0.4296. The answer is payable 0.4296. Is it right? 0.4296. Now you try the second quarter. Very good, Rishabh. Second quarter Sensex is 43560. 43560. Calculate the percentage. 43560 minus previous one 43720 divided by 43720. So this time there is a negative return. This time there is a negative return 0.3660. 0.3660. So you will take 0.3660 percentage into 800, negative amount you will get. So don't worry, negative is also possible because Sensex can go up or Sensex can go down. So minus 2.9280 approximately minus, and you are supposed to receive 9.20. Same calculation, I am not repeating. So 9.20 minus, again minus will become plus. This is already minus. So tell me the answer in the last column. Yes, please reply. Garg, please reply. Answer in the last column. It will be 9.20 plus 2.9280. So that is 12.1280. 12.1280. Very good. Come on, next. Quarter 3. Sensex is 44160. 44160. Priyanka is right. Very good. Now, student will complete Sensex quarter 3 figures and complete quarter 4. I will check the answer afterwards. Siddhana is right. Very good. Come on, next. What is the Sensex return in third quarter? Sensex return in third quarter is positive 1.3774%. So you will pay 1.3774% into 800. This percentage into 800. 11.0192. Very good. Cabra, very good. Next, 9.20 receivable. In the third quarter, you will pay the difference. Receivable is less, payable is more. So you will pay the difference. 1.8192. 1.8192. Now come to fourth quarter. Fourth quarter, 43920 Sensex. Take the difference in percentage. Take the difference in percentage. So you are getting 0.5435%. You are getting 0.5435% negative minus 0.5435% into 800. Amount payable is minus 4.3480. So student will now reply, what is the net receivable in the last quarter? Waiting for your answer. Net receivable in the last quarter. Net receivable in the last quarter. So Rishabh has answered 13.54. Very good. 13.54 receivable. Very good. Amazing. So this way you will solve this question. This was a question on equity swap. Mark important. Something new to learn here. Now we'll go to question number 5. Another highly repeated question is question number 5. Very, very important. Highly repeated. So this question you have to do it before you go to the exam because it keeps repeated. This is the question I have taken from November 21 RTP, but similar questions have been asked in the past exams. So can we start now? Question number 5. Can we start? Okay. Derivative bank entered into a swap arrangement on a principal of rupees 10 crore. So one party will pay 10 interest on 10 crore and agreed to receive MIBOR overnight floating rate for a fixed payment on the principal, and it will receive interest which will be based on MIBOR overnight floating rate. MIBOR overnight floating rate. So this is a question of overnight index swap. In short, we will write OIS, overnight index swap. The swap was entered on Monday, 19th August 2019 and was to commence on 20th August 2019 and run for a period of 7 days. Respective MIBOR rates for Tuesday to Monday were 8.15, 7.98, 7.95, 8.12, 8.15, 7.75. So in case of floating rate, the interest is calculated on a daily basis. Based on whatever is the rate available on that day, interest will be calculated on a daily basis and on compounded basis also. Fixed rate is 8%. Fixed rate is 8%. Then evaluate the nature of this swap arrangement. This kind of swap is called overnight index swap. And the net settlement amount. The net settlement amount will be the difference between the amount payable and the amount receivable. Sunday is a holiday only in the question. Okay. Sunday is holiday in the question. Consider 365 days in a year for interest calculation. So can we start now? You will say yes or no. Can we start? But first I will give you a small note on overnight index swap. Note, write down for 4 marks. Suppose the theory question is write a note on overnight index swap. So with the theory we will understand the concept also. It will serve two purposes. theory as practical both. So write down, note, the given swap arrangement is plain vanilla overnight index swap. The given swap arrangement is plain vanilla. One party will pay fixed rate, other party will pay at floating rate. It's plain vanilla overnight index swap. In short, write down OIS. OIS. Every time you don't have to write overnight index swap, you can write OIS. Now next line, write down, next line, OIS is an interest rate swap involving a fixed rate being exchanged for an indexed rate. A fixed rate exchanged for an indexed rate like LIBOR or MIBOR. What is the meaning of MIBOR? If you want to write Mumbai Interbank Offered Rate or Treasury Bill Rate. So floating rate will be linked to either LIBOR, MIBOR or Treasury Bill Rate. Next paragraph. In an OIS, one of the institutions is swapping overnight floating interest rate and the other institution is swapping a fixed short-term interest rate. It's swapping a fixed short-term interest rate. So one party will be paying floating rate, the other party will be paying fixed rate. But this is for a very short period, like few days. In our example, it is only for 7 days. So sometimes it is for 7 days, 10 days, like that. Now how is the interest calculated? Write down. Very important for solving the question. So next line is, the interest is computed on a notional principal amount. Principal will not be exchanged. Only the interest will be exchanged, and it will be calculated on a notional principal amount and settled on a net basis at maturity. So the one who will receive more will get the net difference, and the one who has to pay more will pay the net difference. Next line, last line for the note. On the floating rate side, this is important. The interest amounts are computed on a daily basis on the index. The interest amounts are computed on a daily basis on the index. The interest amount are calculated on a daily basis on the index. Okay, have you written? All of you have written. So can we now go to the answer? Now in your exam, the answer will start from here. You don't have to write the note unless they ask you to explain what is OIS. So let us write down. Calculation of net settlement amount. This is my question. What is the net settlement amount? So I need to first calculate the interest under floating rate. That is the main calculation. Fixed rate is simple. So student will write now, calculate interest as per floating rate. Calculate interest as per floating rate. Draw this table with 4 columns. First column write down day, then write principal, then write MIBOR percentage, then write down interest in rupees. Now first you start with Tuesday. Because you entered into contract on Monday, so the calculation will begin from Tuesday. Tuesday the principal amount is 10 crore and the first interest rate given is 8.15%. 8.15%. So how will you calculate interest here? You have to calculate interest for only one day, 10 crore. Type 10 crore into 8.15% into 1 by 365. Into 1 by 365. Please reply. One student has replied 22,329. Very good. Wednesday. Now Wednesday the principal amount will be principal plus interest. It will be calculated on compounded basis. So my principal amount will be 10 crore plus 22,329. 10 crore 22,329. And what is the interest rate given here for the next day? 7.98%. Again calculate. For one day, take this amount into 7.98% into 1 by 365. Into 1 by 365. Answer please. Just for one day you have to compute interest. So the answer is 21868. Very good, Rishabh. 21868. Thursday opening principal will be this amount plus 21868. Plus 21868. So 10 crore 44,197. Okay, come on. Interest rate 7.95%. 7.95%. Multiply and into 1 by 365. The answer for Thursday is 21790. Very good. Come on, next. Friday. Take the total of these two. This is the opening balance for Friday. 10 crore 65,987. Interest rate 8.12%. Come on. Friday interest. Interest for Friday. 22,261. Very good. 22,261. Now there is a problem. Saturday. And the note number 1 in the question is Sunday is holiday. So you will have to calculate interest for 2 days now. Saturday and Sunday. So this is important. If there is a holiday, you will calculate the interest for that day with the same rate. So now we'll take interest for 2 days when you do the calculation. So opening balance of principal will be, take the total of this number plus this number. 10 crore 88,248. 8.15%. Multiply into 2 by 365. Into 2 by 365. 44,697. 44,697. And the last calculation Monday. Take the total of principal plus interest. The opening balance on Monday would be 10 crore 1,32,945. 7.75%. Calculate on Monday. Monday. 21261. Very good. 21261. Take the total of the last column. total of the last column. Do it yourself and then we will check. That is the total interest under floating rate. Total interest under floating rate. The answer comes to 154,206. 154,206. So this is the interest under floating rate. Any query on this? 1,54,207 is right. 154,207, 206, 154,206. Now I will write down total interest at fixed rate. Total interest at fixed rate. Total interest at fixed rate. You will take 10 crore into 8% into 7 days divided by 365 days. Fixed rate interest will be, anybody fixed rate interest will be 153,425. 153,425 is right. The student who have replied is right. So net settlement amount, difference between step 1 and step 2. Anybody, net settlement amount? Yes, come on. Net settlement amount will be 154,206 minus 153,425. So the answer is 781 rupees. 781 rupees. So this is you will receive, this is you will pay. So this 781 is the net gain. 781 is the net gain. So after 7 days you will receive 781 rupees. This is how overnight index swap works. So this was interest rate derivative. So we have taken many questions on interest rate derivative. Now we'll go to our next important topic where you will get one question for 8 to 10 marks. That is business and corporate valuation. Business and corporate valuation. So should we start business and corporate valuation, or do you want to take a break? Continue or break? So we will continue. We are the student. Okay, we want to pass with good marks. So I will go to question number 1. I will tell you honestly, this is one of the most repeated questions from this topic. And second thing, the easiest question on this topic. Anybody can do it. You can see the frequency of this question. June 2009 exam for 10 marks. Same question in November 2012, November 18 RTP, May 19 exam, July 21 exam. Okay. And September 22 MTP also. Yes, the party has just started. One student saying party has started now. Okay. So question is, so I am going to take on this topic those questions which are highly repeated in the exam and which are very important. X Limited reported a profit of rupees 65 lakh after 35% tax. So this is PAT, 65 lakh. So profit before tax will be 65 lakh divided by 1 minus 0.35, which should be 100 lakh. So profit before tax will be 100 lakhs. Very good. For the year 2007-8, an analysis of the accounts revealed that the income included extraordinary item rupees 10 lakh and extraordinary loss rupees 3 lakh. When you are doing business valuation, you should not take into consideration extraordinary income or extraordinary loss. Abnormal item should not be considered, because extraordinary or abnormal item will not be repeated in future. These are one-time event, one-off event, and they will not be repeated. So any extraordinary income that you get, you deduct, 10 lakh will be deducted, and any extraordinary loss will add back. So you will get your normal profit before tax, 100 minus 10, 90 plus 3. 93 lakh will be your normal PBT. We have to eliminate the effect of abnormal transaction when you are doing business valuation. The reason is this will not be repeated in future. The existing operations, except for the extraordinary items, are expected to continue in the future. Very good. So we expect this 93 lakh will continue in the future. In addition, the result of launch of a new product are expected to be as follows. And what they have done? They have undertaken a new project. So this new project will also bring more profit. How much profit the new project will bring? Take your calculator. Sale 60 minus material 15 minus labor 10, 60 minus 15 minus 10 minus fixed cost 8. So how much is that? How much is the additional profit from the new project? How much is the additional profit from the new project? Is it 27? Just check. I have just done without calculator. So 27 lakh. So my revised PBT will be 100 lakh. My revised PBT would be not 100, sorry, 120 lakh. My revised PBT would be 120 lakh. Is 120 right? Today I forgot to bring the calculator. So please help me. If you help me today, God will help you in the exam. So revised PAT will be 120 minus 35%. Anybody? 120 minus 35%. 120 minus 35% will be the revised PAT in the future. 120 minus 35% will be the revised PAT in the future. So that will be equal to how much? 120 minus 35%. Anyway, please reply 78 lakh. Very good. Compute the value of the business given that the capitalization rate is 15%, which means the investor wants 15% rate of return. So how much are they willing to pay for this business? They will be willing to pay for this business equal to 78 lakh divided by 15%. How much they are willing to pay if they want 15% return? 78 divided by 15%. Yes, Garg, please reply. So they are willing to pay 520 lakh. That is what you have replied. 78 divided by 15%. So this will be your first answer. While talking only we have completed. Next is determine the market price per share. Per share means you have to divide by number of share, with X Limited share capital being comprised of 1 lakh 11% preference share of 100 each. So this was my PAT 78 lakh. I will have to deduct preference dividend first. If you have preference dividend, so preference dividend will be 1 lakh into 11% into 100. That is, I think, 11 lakh. So earning available to equity shareholder will be 78 lakh minus 11 lakh, 67 lakh. And how many shares are there? There are 40 lakh shares. So you have to divide by 40 lakh share. You will get EPS. And P ratio is 8 times. So multiplied by 8 times. If I use P ratio for valuation, the answer will be P ratio into EPS. P ratio into EPS. So that will be the value per equity share. That was a very simple question. I have almost written the answer, but we have to write the answer nicely. We are a student. So question already explained to you. You must have done in the regular batches also. Please write. Very easy. We'll go little fast because most of you can easily do it. Only you have to take care you don't make silly mistakes. So write calculation of future maintainable profit and value of business. Calculation of future maintainable profit and value of business. I have started getting answer also. I will check it later. See, presentation in the exam is very important and that gives you full marks. I came in the rank in foundation inter-final. One of the reasons was the answers were presented nicely, so the examiner does not have the scope of deducting marks. Okay. So first you write down first point a PBT. As discussed earlier, the current PBT is 65 divided by 1 minus 0.35, which is 100 lakh. Then I will remove the extraordinary gain or loss. Extraordinary gain remove minus extraordinary profit 10 minus extraordinary profit 10. But if there is an extraordinary loss, it will be added back. Add back extraordinary loss 3. Add back extraordinary loss 3. So that this will give me the current PBT, normal PBT at present. That is called existing normal PBT, and to that I will add the profit of a new project. So write down point number D. Add additional income from launch of a new product. Add additional income from the launch of new product. Add additional income from the launch of new product. Under that write down inner column you will write sales 60. Just don't take on calculator and write in the outer column. You have to present the calculation of additional income. Sales 60, material cost 15, labor cost 10, less fixed cost 8. So this will give you 27. So my PBT now, PBT after new project, PBT after new project will be 120, 100 minus 10 plus 3 plus 27, 120. Less tax at the rate of 35%, 42. Less tax at the rate of 35%, that is 42. Therefore, PAT 78. So in future the company would be earning 78 lakh rupees and the Capitalization rate means the required rate of return from such business is 15%. The required rate of return from such business is 15%. So if a company generates 78 lakh of PAT and the required return from such business is 15%, what will be the value of the business? The value of the business will be 78 divided by 15%. 78 divided by 15%. How much is that? 78 divided by 15%. How much is that? That is 520. Very good. 520. Now tell me, if you write like this, where is the scope of deducting marks? This PAT figure I will require for my next answer. This PAT figure I will require for next answer. This is the value of the entire business. This is the value of the entire business, 520. Now they have asked you one more query. What will be the market price per equity share? What will be the market price per equity share? Because they have given P ratio also, the intention of the question setter is that the student must apply P multiple approach for valuation of share. As you know, value of equity share can be calculated under different ways. One method is P multiple approach, EPS into P ratio. So therefore, I will first find EPS and then multiplied by P ratio. That will give you market price. So write down calculation of market price per share, per equity share. Calculation of market price per equity share. Under that write down serial number, particulars, rupees in lakhs. First write down, as we have done in the earlier step, FMP, future maintainable profit after tax. This was step 1. Step 1, 78. Less preference dividend. Less preference dividend. Preference dividend will be 1 lakh preference share into 100 into 11%. That comes to 11 lakh. So PAT minus preference dividend is called earning available to equity shareholder. You will remember those happy days of accounting standard 20 EPS 67, and you have Ind AS 33 also EPS. Now write down divide by number of equity shares. Divide by number of equity shares in lakhs, 40 lakhs. Very easy. You must have done this calculation several times in intermediate also. EPS, up to EPS calculation, Mehul is right, 1.675. 1.675. P ratio is given 8 times. P ratio is given 8 times. P ratio is given 8 times. Therefore, market price per share is 13.40. Market price per share is 13.40. Mehul is right. Rishabh is right. This is called P multiple approach. This is called P multiple approach. So can we go to the next question now? Another highly repeated question is question number 2. It's a repeat question. They can ask in next exam also. Don't be surprised. Question number 2. May 2018 exam for, I think it was 8 marks, and similar question is in November 19 RTP, and it has been repeated in other exams also, other RTP and MTP also. So question is again very interesting question. Valuation done of an established company by a well-known analyst has estimated a value of 500 lakh. So they have already done the valuation of a company, and it is done by a well-known analyst. Okay, well-known analyst. This analyst name is Hinderberg. Okay, name of this analyst is Hinderberg, and they have done the valuation at 500 lakh. If you have a network issue, some students are saying network issue, just restart your laptop or computer or mobile again, because we can find that the network is right from our end. Okay. Then there was an well-known analyst. He has done the valuation of a company at 500 lakh. This company is Adani Enterprise. Okay. Based on the expected free cash flow for the next year of rupees 20 lakh. So what are the data given? I will tell you. The valuation is 500 lakh. Free cash flow of the next year is 20 lakh, and expected growth rate is 5%. While going through the valuation procedure, you found that the analyst Hinderberg has made the mistake of using book value of debt and equity in his calculation. So what are the weights used? The weights used are based on book values. So this is a mistake. It should be based on market values. It should be based on market values. Next line. While you do not know book value weights he used, it means basically they are giving you a hint. The student has to find out what was the book value weight the analyst had used. You have been provided with the following information. What is the information? Good news for you. The cost of equity is already done for you, 12%. After tax cost of debt is already done for you, 6%. So the weighted average cost of capital is equal to weight of debt into cost of debt plus weight of equity into cost of equity. So you have to find out how much weight this analyst had used in the valuation of this firm using book value weights. Next line. The market value of equity is 3 times the book value of equity. So when you will do the calculation, you will take 3 into weight of equity based on book value weights. while the market value of debt is equal to book value of debt, but for debt you will take weight of debt will be equal to weight of debt only as per book value, but weight of equity will be 3 times the book value of equity. So my question is, for 8 marks, you are required to estimate the correct value of the company. You are required to estimate the correct value of the company. This means you have to do the value of the company using market value weight. Using market value weight, what will be the value of the company? Using market value weight, they have done calculation on the basis of book value. Book values are usually not reliable because they are based on historical values, whereas the market takes into account the current economic value of the firm. So it is believed that market value is a better way of assigning weight as compared to book value. So first chance to you. Question for you. What is the correct value of the company? I will give you 45 seconds to try. And I will give you 8 marks if you get it right. And then you will get a job in Adani Group company also. I want the final answer. What is the correct value of the firm? I want final answer. What is the correct value of the firm? The students are replying current cost of capital, current book value weight. You are right, but I want final answer. Keep trying, keep trying. You are on the right path. Keep trying. Other student will also try. So one student has replied 363.64. Let us check whether it is right or not. Let us check whether it is right or not. Any other student who wants to reply? So what we'll do, first we will calculate overall cost of capital used by the analyst. First we'll calculate overall cost of capital used by the analyst. For that we have to solve a simple equation. Write down step 1. Step by step you will get full marks. Don't write directly in the exam. On your calculator, don't calculate and just put the answer. Present it well. Present it well. Step 1, step by step gives you more marks. Psychological impact on the examiner that the student has written so many steps. Calculation of overall cost of capital using book value weights. So I have been given value of the firm, I have been given free cash flow of the next year, I have been given growth rate. So in this equation, if you really see, KO is missing. That is, overall cost of capital is missing. So I can solve the equation and find the value of KO. With practice, you can easily solve this question and you will get full 8 marks. With good presentation, you will get full 8 marks. So write down equation, value of the firm is equal to FCF divided by KO minus G. 500 equal to 20 divided by KO minus 0.05. So when you solve the equation, you will get KO is equal to 9%. This is based on book value weights. This is based on book value weights. Now write down step number 2. So this is our overall cost of capital, weighted average cost of capital. I have been given cost of equity, cost of debt. There are only two sources of finance, debt and equity. So if you assume one of them as, let us say, x, the other one will become 1 minus x, and therefore you have to deal with only one missing variable and solve the equation. So one more equation will have to solve to find the book value, weight of debt and equity. Write down step 2. Write down step 2, calculation of weight of debt and equity. Calculation of weight of debt and equity. Calculation of weight of debt and equity. Just 1 minute, please. Okay, let us start again. There was some internet issue, but now it is resolved. So write down step number 2, calculation of weight of debt and weight of equity using book value weight. Using book value weight. Let the weight of equity be WE. You can write X also. And weight of debt will be 1 minus WE. 1 minus WE. Weight of debt will be 1 minus WE. Correct? So therefore, the equation for overall cost of capital is WE into KE plus WD into KD. WE into KE plus WD into KD. Now I will give you the numbers. You will solve and give me the value of WE. Come on. KE overall cost of capital is 9%, 0.09. I will solve an equation 0.09. This is here. Weight of equity into cost of equity 0.12. Weight of debt into cost of debt is 0.06. Please solve and give me WE. Solve and give me WE. Solve and give me WE. Anybody solve and WE? So weight of equity is 0.5. Weight of equity is 0.5. And therefore the weight of debt will also be 0.5. 1 minus 0.5. Weight of debt will also be 0.5. Do you agree? So these are the book value weights. But the market value of equity is 3 times of the book value. So market value weight will be 3 into 0.5. That is 1.5. And market value of debt is equal to book value. So that will remain 0.5 only. Is it right? So write down step number 3. Step number 3, presentation is important. I am telling you calculation of market value weight. As per the question, the market value of equity is 3 times of book value. 3 times of book value. So that is 0.50 into 3. 0.50 into 3. 1.5. Market value of debt. Market value of debt. 0.50 into 1. 0.50 into 1 is 0.50. So total will be 2 now. And the proportion of equity will be 1.5 by 2. And the proportion of debt will be 0.5 by 2. Right. So use these weights and recalculate the cost of capital using market value weight. So write down again, calculation of revised overall cost of capital. Calculation of revised overall cost of capital using market value weight. Using market value weight. Calculation of revised overall cost of capital using market value weight. So now write the equation again. KO is equal to WE into KE plus WD into KD. In case if you don't want to write the equation, write directly 1.5 divided by 2. You can see here above 1.5 divided by 2 is the weight of equity into 12 plus you can see above 0.5 divided by 2 into 6 is the weight of debt. So the answer is 10.5%. Rishabh is right. Very good. Now I am going to use this as a discount rate, this as a cost of capital for calculating the correct value of the firm. So now my answer is almost over. Step number 5. Step number 5. Calculation of correct value of the firm. Calculation of correct value of the firm using market value weights. Calculation of correct value of the firm using market value weights. Calculation of correct value of the firm using market value weights. So please answer what will be the answer of this question. What will be the answer of this question? Okay, we are just reconnecting. Please wait a minute. Okay. So tell me the answer of this question. Value of the firm is equal to free cash flow divided by KO minus G. Free cash flow divided by KO minus G. Free cash flow divided by KO minus G. 20 upon 10.5% minus 5%. So the answer is, one student has correctly replied 363.64 lakh. Very good, Rishabh. You will get 8 marks for this answer. 363.64 lakh. This question has been asked several times in the exam. Now one more question which is repeated from this topic is question number 3. See the frequency of this question. Originally it was asked in May 2010 exam for 10 marks. Then they have given in RTP 2012, November 2022 RTP, and it has been asked in May 22 exam for 8 marks. So you can't miss this question. Very important question, tick mark. Question number 3. Ready for solving this amazing question? Yes, I think similar question was in November 22 exam also. I think similar question was in November 22 exam also. So please do it carefully. Please practice it 2 times before you go to the exam. There are so much of data. How to use the data properly we will see. Following information are available in respect of XYZ Limited, which is expected to grow at a higher rate of 4 years. First 4 year supernormal growth rate will be high, which is 20%, after which the growth rate will stabilize at lower level and then the growth rate will become 10%. Then the growth rate will become 10%. Last year or base year information. This base year means it is already happened last year. That will be taken as a base for next year calculation. So last year sale was 2000 crore, EBIT was 300 crore, capital expenditure was 280 crore and depreciation was 200 crore. Information for high growth and stable growth period are as follows. Now read the problem carefully. This column is applicable for first 4 years, when the sales and EBIT will grow at the rate of 20%, capital expenditure and depreciation will grow at the rate of 20%, risk-free rate is 10%, equity beta is 1.15, market risk premium is 6. So this will help you to calculate the cost of equity. Pre-tax cost of debt is 13%. Pre-tax means before deducting tax benefit. And during this period, the debt equity ratio will be 1:1. So this information will help you to calculate the KO. And in the stable growth period, sales and EBIT will grow at the rate of 10%. Okay, this student is asking, this is already asked in the last 2 attempts. Can it be asked again? Same question last November exam also the student had asked me that it has been asked in May 22. So will it be asked in November 22? Yes, sometime hat trick is also possible. So why not to learn this question? So next is stable growth 10%. Then capital expenditure are offset by depreciation. So no effect of capital expenditure and depreciation. Now in the stable period, this data have changed. So we have to recalculate KE. We have to recalculate KD. We have to recalculate KO for the stable period. For all time, working capital is 25% of revenue. So this is important. Working capital at any point of time will be 25% of your sales. So sales into 25% will be working capital and corporate tax rate is 30%. Tax rate for all calculation purposes 30%. Find out the value of the firm. So this is a two-stage growth model. First 4-year supernormal growth. So we'll prepare a table and then the growth will stabilize. So we'll apply the formula of growing perpetuity. And this problem will require you to calculate free cash flow available to the firm. Free cash flow firm approach. Free cash flow available to the firm. So I will have to write down the answer in step-by-step manner. You can see this question has come consecutively into exams. There is no reason it can't be asked in the next exam with some different data or some minor adjustment, because this question is very fundamental question for business valuation, right? So are you ready for 8 marks? Once you say yes, then only I'll start. Are you ready? So write down. We will divide our answer into 2 phases. Phase 1 is explicit forecast period, that is first 4 year, when you can calculate the cash flows of individual year. And then from 5th year onwards, the growth rate will become stable at 10%. Okay. So write down first stage 1. You can write in capital letters stage 1 explicit forecast period, when you can calculate individual year cash flow, and you have to first do some basic calculation like cost of equity, cost of debt, KO. So first you write down step 1, K is equal to RF plus beta into RM minus RF. RM minus RF. Look at the question. Look at the high growth column. RF is 10. RF is 10. Beta is 1.15. Beta is 1.15 and market risk premium is 6. Market risk premium is 6. I want the answer from you. Student should reply. Yes, come on. What is the answer? For cost of equity, the answer is 16.9%. 16.9% is right. Very good. Come on, next. Mehul is right. Kabra is right. Step 2, write down cost of debt. Cost of debt, Rishabh is right. Check cost of debt, I into 1 minus 3. Now in the exam, be careful with the wordings. Pre-tax cost of debt is written. So you will get tax shield. In some earlier question, post-tax cost of debt was written. In previous question number 2, if you see, in previous question number 2, after-tax cost of debt was written. So we have taken that answer directly. But pre-tax cost of debt is written. The student has replied 9.1%. Very good. Siddhana is right. Amazing. Now you tell me what will be KO or WACC, overall cost of capital. I will give you the formula. You will give me the answer. WD into KD plus WE into KE. The problem in the last line says debt equity ratio is 1:1. 1:1 means 50% debt, 50% equity. So Priyanka has replied, she has given two answers, 14 and 13, which you want to finally lock. 13% is the right answer. Rishabh and Priyanka have given 13% right answer. Okay, 13 is right. Now what I'll do, I will compute the present value of the free cash flow of the first 4 years, and I will also find out what will be my terminal cash flow. That means the cash flow of the 5th year, because that will be required for the infinite period. So year 1, 2, 3, 4 individual year, and we have to also estimate the cash flow of the 5th year for that stage 2 infinite growth period. Write down step 4. Step 4. PV of FCFF. FCFF, free cash flow available to the firm. FCFF means free cash flow available to the firm. Step number 4, free cash flow available to the firm. First write down NOPAT, net operating profit after tax. Net operating profit after tax, that is called NOPAT. Net operating profit after tax. How do you calculate? You have to take the previous year EBIT into 1 minus T into growth in EBIT 20%. Previous year EBIT is 300. I will give you the first working. into 1 minus 0.3, which is your tax rate, and the growth is 20%. Growth is 20%. So just take on your calculator 300 into 0.7 into 1.2. 300 into 0.7 into 1.2. So are you getting 252? And then you just increase it by 20% in the second year. Increase by 20%, 302.4. Increase in the third year also by 20%, 362.88. Increase by 20% in the fourth year, 435.46. Wait, in the fifth year, the growth rate will be 10%. Can you see 10% stable growth? So what I have done, I have multiplied by 1.1, that is for 10% growth. This is your net operating profit after tax. Net operating profit after tax. Any query on this? No query? Then I will write down capex less depreciation. Capex less depreciation. The problem says in high growth period, capital expenditure less depreciation will also grow at 20%. So go to the previous year. Previous year capex was 280 and depreciation was 200. Depreciation was 200. So 280 minus 200 into 1.20 will give you 96. And then you increase by 20%, 20%, 20%. Here I have written 0 because in the stable period, capital expenditure are offset by depreciation. Capital expenditure are offset by depreciation. So capex minus depreciation is 0. Capex minus depreciation is 0. In the stable growth period, capital expenditure and depreciation are equal. Third line, write down working capital. Last second line of the question. Working capital is 25% of the revenue. Working capital is 25% of the revenue. Now you understand the year 1. The revenue of the previous year is 2000, but growth rate is 20%. So the next year revenue will be 20% more than previous year and multiply by 25%. 2000 into 1.20 will be future sale into 25%. The answer is 600. Now go to next year. This will increase by 20%. 720, 20%, 864, 20%, 1036.80, and then the growth rate will be 10%. Write down nicely. Calculation also you can write if you want. Okay, so now we'll come to, this is working capital required. Now this is the point of mistake. Student will just take this figure. You don't have to take this figure. You have to take the increase in working capital or decrease in working capital for calculating free cash flow. So I have to compare with the opening working capital and I will see how much additional working capital would be needed. So write down point number D. This is important. Students forget to write this line. Increase or additional working capital. Now last year working capital was 25% of 2000. Last year working capital was 25% of 2000 because last year sale was 2000. and this year working capital, coming year working capital requirement is 600, just 600 rupees. So I will have to invest 100 more. Same logic here, 720 minus 600, 120. 864 minus 720, 144. This minus this, 172.80. This minus this, 103.68. Write down nicely. This presentation helps you to understand better and we don't make mistake. Now this is my NOPAT. This is my additional capex required and this is my additional working capital required. Do you know the formula of FCFF? FCFF means free cash flow available to the firm. So that will be NOPAT minus this because the cash flow that we will get in our pocket will be after incurring capex and working capital requirement. So my next line is very important, FCFF. A minus B minus D. A minus B minus D. A, B and D. Try yourself. FCFF is NOPAT minus net investment. You are right. Net investment is capex minus depreciation plus working capital. NOPAT minus net investment is FCFF. And net investment is capex minus depreciation plus additional working capital. Very good. Check the answer. Once you say it is right, I will go to the next column, next line. Check the calculation and suggest me if it is right. Is the answer right? 56, 67.2. All are right. Very good. So I can go to the next line. Now I need to compute the present value of only the first 4 number. This is the first year of the normal growth period. It will grow forever at 10%. So only calculate the present value of the first 4 years. Present value will be at the cost of capital of the first 4 years, which is 13%. Write down PV at 13%. Take on your calculator. 56 divide by 1.13. Divide by 1.13. You will get 49.56. Memory plus. Year 2. 67.20 divided by 1.13 equal to 2 times and memory plus 52.62. Year 3, 80.64 divided by 1.13 3 times equal to, you will get this number 55.88 memory plus, and then you take 96.67 divide by 1.13 4 times equal to memory plus 59.32 is the 4th year. Take the total of these numbers or memory recall. If you have used the memory plus function, you will get 217.38. You will get 217.38. Is it right? 217.38. Total of the first 4 year is 217.38. Yes. Now I am going to calculate the PV of terminal value. But for that, the data has changed. The cost of equity will undergo a change. The cost of debt will undergo a change. Overall cost of capital will change. So I need the basic calculation of KO again. Write down stage 2, capital letters. In capital letters, write down stage 2, stable growth. Stable growth. New cost of equity. New cost of equity 9 plus 1 into 5. 9 plus 1 into 5. Data has changed. So revised cost of equity would be 14%. New cost of debt. Cost of debt has also changed to 12.86. So it will be 12.86 into 1 minus 0.3. That is equal to 9%. Check. Is it 9%? So can you give me WACC now? WACC, that is KO. Please reply. What will be the revised KO from 5th year onwards? It will be based on new weights. Weights have also changed. 2:3. The weight is 2:3, means 2 by 5, 3 by 5. 2 by 5 means 40%. 3 by 5 means 60%. So the answer is, anybody? Yes, one student has replied 12%. Very good. So this will be the KO for normal growth, so stable growth period, 12%. So now I am going to calculate first terminal value, present value of terminal value, and then finally the value of the firm. Write down, next line, write down terminal value. Terminal value is equal to free cash flow of the 5th year divided by KO minus G. So we have computed this number 375.32 in the previous table. This is my new KO, 12%, and the growth rate is now 10% in the stable period. So the answer is, check, approximately 18750. 18750. But this is the value you will get at the end of 4th year. If you want to write, this is nothing but PV4. Means the present value at the end of the 4th year, not today, because the infinite series will start from 5th year. Now write down PV of terminal value. PV of terminal value will be 18750 divided by 1.13 to the power 4. Do this calculation. You will get approximately 11,500. And the last part, value of the firm, will be stage 1 plus stage 2. Stage 1 plus stage 2. Go to your stage 1 answer, you will get 217.38. And this is stage 2 terminal value 11,500. So the final answer is 11717.38. 11717.38 is the value of the firm. We have written all the details. Okay. The purpose of writing in detail is that when you revise, you understand, when you write the answer in the examiner is also impressed that yes, you have written everything on step by step basis and you have not written anything directly. So this answer is over. One student, Rishabh, has got it right before everybody. Very good. Keep it up. Now we'll go to question number 4. Question number 4 was originally asked in November 2010 RTP. Then it was given in May 18 RTP. And it was asked in one of the exams also earlier, long back. This question is different from other questions. This question is different from other problems. Why? It is based on chop shop approach. What is chop shop approach? Breakup value approach. This method is used for diversified companies. The companies which are operating in multiple business segments. So each business segment is valued separately and then you add it. That gives you the value of the business. So I will read the question. I will give you a small note on chop shop approach. Then we'll solve. Are you ready? Are you ready? Say yes or no. Using the chop shop approach or breakup value approach, assign a value for Cranberry Limited whose stock is currently trading at a market price of euro 4 million. Now don't get scared by this euro. In this question there is no conversion involved. All figures are in euro. Some students have asked me in the past, is it a Forex question? This is not a Forex question, this is a valuation question. For Cranberry Limited, accounting data set forth 3 business segments. So there are 3 business segments here: consumer wholesale, retail and general center. Data of the 3 segments are as follows. Segment sale, segment asset, segment income. These are the different bases for valuation. Some valuation is done on the basis of sales multiple. Some valuation are based on asset multiple. Some valuation are based on income multiple. Okay. So we are going to apply all the 3 bases of valuation. And then industry data for pure play firm. Sir, what is pure play firm? Pure play firm is the firm which is only into one line of business. Only into wholesale business. Only into retail business. Only into general center business. And they have used the multiple of pure play firm that will be used for valuation of this company Cranberry. So they have gone to the stock exchange. They found that those companies which are only into wholesale business, their market capitalization to sales ratio, market capitalization to sales ratio is 1.18. Market capitalization to asset ratio, I think it is written sales upon capitalization in your book. My mistake. In your book, it is written sales upon capitalization. This was how it was asked in the exam. Asset upon capitalization and income upon capitalization. And these are the ratios they have given to you. Based on that, You have to do the valuation of this company. So how are you going to do the valuation? Kindly guide me. Kindly guide me. How do I do the valuation of this company? There are three segments. So I will have to value each of them separately. Under sales multiple, asset multiple, income multiple approach. So again I will get three answers. If I use sales as a base, I'll get one answer. If I use asset as a base, I'll get second answer. If I use income as a base, I'll get the third answer. Then I will do the valuation under all the three approaches and take a simple average. Nothing is given, take a simple average, and that will be the value of this firm Cranberry. So first I will give you a note on chop shop approach. Write down note on chop shop approach. Under this you write down steps involved. Chop shop approach is used for a diversified company where they will identify each business segment and do the valuation of each business segment separately. So write down steps involved, note 1. Steps involved, note 1. Identify the firm's various business segments. Identify the firm's various business segments and calculate the average capitalization ratio for firms in those industries, and calculate the average capitalization ratios for firms in those industries. That they have done in the second table. Then step 2, calculate a theoretical market value based upon each of the average capitalization ratios. Calculate a theoretical market value based upon each of the average capitalization ratios. So for each segment, using each approach, we will find out the market value. Then average the theoretical market value, and then I will take the average, because different approach will give me different answer. And as you know, valuation is an art, it is not a science. There is no final answer in valuation. It is always based on estimates, and therefore multiple approaches are there. So when multiple approaches are used, we will take average under different approaches. So third step, write down average the theoretical market values to determine the chop shop value of the firm. Average the theoretical market values to determine the chop shop value of the firm. Okay, so one by one we'll solve. Very easy question. First I will use sales multiple. Now in this question, to confuse you, they have given sales upon capitalization is 1.18. Sales upon capitalization is given 1.18. But if I want to know capitalization upon sales, it will be 1 upon 1.18. That means the market capitalization to sales ratio is 1 upon 1.18. Market capitalization is 1 upon 1.18 times of the sale. Is it right? So what I will have to do, first I have to take the reciprocal of each of them and then solve. So write down first step 1. Step 1, very easy, I am not explaining much, only this part I wanted to explain. Value using capitalization to sales ratio. Value using capitalization to sales ratio. Under that write down 4 columns. 4 columns. Business segment. Now in your question sales to capitalization is given, and that is where the students have made mistake in the exam. In one exam they have given capitalization to sales ratio, so then directly multiply by sales. But if they give you sales to capitalization, you have to take the reciprocal. Mathematically, it means sales divided by capitalization is given. But I want to know how many times is market capitalization for 1 rupee of sale. So 1 by 1.18, 0.85, 1 by 1 divided by 0.83, 1.2, 1 divided by 1.25, 0.8. And these are the sales given to you. Sales given in the first table. Multiply now. Multiply. Please multiply and tell me whether this total is right or not. If it is right, I will go to the next calculation. Do the calculation and check if it is right or not. If I apply capitalization to sales ratio, the value of the firm is 3055250. Is the calculation right? Please reply yes or no. Is the calculation right? Can we go to the next calculation now? Write down next calculation, step 2. Value using capitalization to asset ratio. Value using capitalization to asset ratio. Value using capitalization to asset ratio. Same format, business segment. Now read your problem. They have given you asset divided by capitalization. But I have to take capitalization divided by asset. Segment asset and theoretical value. In this question, for all the 3 firms, the ratio given was 1.43. So I will take 1 divided by 1.43, which is 0.7, 0.7, 0.7. Segment asset given in first table, 6 lakh, 5 lakh, 40 lakh. Just multiply and take total. This is a very practical question because in India there are many companies which are diversified like ITC, HUL. So you can't apply only one approach for valuation. You have to apply multiple approaches for valuation, and they have different segments. So this way the valuation is done for conglomerate companies which are into multiple business lines. So is the answer right? 35,70,000. Is the answer right? 35,70,000. Can we go to the step 3 now? Write down step 3. Value using capitalization to income ratio. value using capitalization to income ratio. Here also institute has given operating income to capitalization, but I want capitalization to operating income. So take the reciprocal. Take the reciprocal. Do you watch Shark Tank on TV? Sometimes, not every day. You have got exam. There they are using either this sales to capitalization or income to capitalization method when they answer the valuation of the potential candidate. Okay, most of the time you will find these are the two ratios they are using, either it is based on income or based on sales. And if the candidate comes who are into different business, sometimes they use two methods for valuation. So do the calculation and give me the answer. I am not a brand ambassador of Shark Tank. Okay, I don't get any influencer fees from there. So tell me the total of the last column. Check the answer. Is it 4675000? Yes. Now once you have completed all the three answers, your answer is still not over, because these are three different values under three different approaches. So you have to take the average now. So take me the average of the three values, simple average of the three values. So you will write below this step 4. Step 4, write average theoretical value of the firm. Average theoretical value of the firm. Average theoretical value of the firm is equal to take the total of the three divide by 3. How much is the answer? Preeti has replied 3766750. Wonderful, Preeti. Amazing. Rishabh has also replied. Same answer. Very good. Slightly different answer by Rishabh. Check your answer again. So this answer is over. There is one question number 5. So that will take tomorrow. Thank you very much for joining me and wish you all the best.
We'll take question number 5 from business valuation topic. Write down this question as very important. Very important. Question number 5. Keep the question paper in front of you and you can understand better. This question was asked in May 2020 RTP, November 21 MTP for 10 marks. And I have found this question is getting repeated at different places. So read the question. ABC Limited is considering a new sales strategy. This is a question on new strategy. What will be the benefit of new strategy on the valuation? Question is, what will be the benefit of the new strategy on valuation? Considering a new sales strategy that will be valid for the next 4 years. They want to know the value of the new strategy. This is the question. Read line by line slowly, you will understand what they are asking. They are trying to ask you to find out what will be the value of the new strategy. Following information relating to the year has just ended is available. So this is the last year data which has just ended. Income statement first. Sales, Gross margin 20%, amount 4,000. Administration, selling and distribution expense 10%, 2,000. PBT 2,000. Tax 30%, 600. Profit after tax 1,400. So this portion is P&L account. And then balance sheet information. Fixed asset is 8,000, current asset is 4,000, and equity is 12,000. Now the question starts really, if the company adopts the new strategy, sales will grow at the rate of 20% per year for 3 years. Sales will grow at the rate of 20% per year for 3 years. So if sales will grow, profit will also grow. The gross margin ratio means 20%. This is gross margin ratio. Asset turnover ratio, whatever asset turnover ratio is there, will be maintained. The capital structure and the income tax rate will remain unchanged. So GP ratio, asset turnover ratio, income tax rate, capital structure will remain unchanged. Depreciation would be at 10% of the net asset at the beginning of the year. The company's target rate of return is 15%. This is the discount rate. This is the discount rate. Determine the incremental value. Determine the incremental value due to adoption of the strategy. So what is the value right now and what will be the value after adoption of the new strategy? Is it right?
Yes, sir.
Right now you will take this as a PAT, and this is your cost of capital. So the current valuation of the company will be PAT upon 15% or no PAT upon 15%. So this is a question called special case of FCFF approach. So first what I'll do, like I did previously also, I'll give you a note. I'll give you a note how to solve such question of new strategy. Is it right? So are you interested in writing the note? Half page note. Say yes.
Yes, sir.
Write down. Special case of FCFF approach. 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 Then write down bracket Alcar model. Alcar model. Under that write down a no growth firm. A no growth firm is evaluating. A no growth firm is evaluating a new growth strategy. So this firm was no growth firm, and now it is evaluating a new growth strategy. We are required to calculate the value of strategy. So this is a typical question of strategy. A no growth firm will be adopting a new strategy, and the student is asked to find out the value of the strategy. Value of the strategy is equal to post strategy value minus pre-strategy value. Post strategy value minus pre-strategy value. Post strategy value means value of the firm after adopting the strategy, and this is what was the value before adopting the strategy. So if the value of the strategy is positive, you will adopt the new strategy. Now write down pre-strategy value. Pre-strategy value is equal to when there is no growth. When there is no growth, the value is no PAT upon K. The value is no PAT upon K. the value is NOPAT upon K. The value is NOPAT upon K. Is it right? The value is NOPAT upon K. Then the student can ask why we have not taken FCFF. Why we have not taken FCFF? This can be your question, because the valuation is done on the basis of FCFF approach. But why we have not taken FCFF? The reason is there is no growth. So if there is no growth, write down here. Net investment is zero. Net investment is zero. So FCFF is equal to NOPAT minus net investment. NOPAT minus net investment. And if net investment is zero, FCFF will be equal to NOPAT. FCFF will be equal to NOPAT. That is the logic. If you want to write FCFF also here, you can write, but then that will be equal to NOPAT in case of zero growth. Yes. Understood? Yes, so in case if you have written, can we move ahead now? Write down step 2, post strategy value. I'm just dictating the note first. We'll do the calculation after some time. Post strategy value is equal to, before that we'll write a note. There are two statements made in the Alcar model. There are two statements made in the Alcar model. Statement number 1. So what this model assumes, first is the firm's operating margin, that is EBIT, as a percentage of sale will remain constant. EBIT as a percentage of sale will remain constant. EBIT as a percentage of sale will remain constant. EBIT as a percentage of sale will remain constant. It means EBIT as well as NOPAT. It means EBIT as well as NOPAT will grow at the same rate of sale. EBIT as well as NOPAT will grow at the same rate of sale. Understood? In the problem, sale will grow at the rate of 20%. NOPAT will also grow at the rate of 20%. And statement number 2, write down. Statement number 2, all turnover ratios will remain constant. All turnover ratios will remain constant. So what is the meaning of this line? All turnover ratio will remain constant. It means your sales upon asset ratio will remain constant. Sales upon capital employed, this ratio will remain constant. Now when will this ratio be constant? The sale is growing. If asset is also growing at the same rate, then the ratio will be constant, which means the assets or the capital employed will also grow at the same rate. Next line. This means that capital employed in bracket fixed asset plus current asset minus current liabilities will grow at the same rate as sale. Will grow at the same rate as sale. Will grow at the same rate as sale. So the further interpretation is, hence we define net investment as change in capital employed. Hence we define net investment as change in capital employed. Net investment figure you have studied in your chapter. Net investment means additional capital expenditure minus depreciation plus additional working capital. That is called net investment. So in case of Alcar model, net investment means change in capital employed, and capital employed will change at the same rate as that of change in sale. So if sale is growing at 20%, capital employed will also grow at the rate of, come on, 20%, which means it has taken care of capex, depreciation, and additional working capital. Now I am going to come to the question. So in the exam, your answer will start from here. Few lines I have dictated for conceptual understanding. I hope you would like it. Otherwise, you can start in the exam directly from here. Step number 1, NOPAT. Pre-strategy value. Pre-strategy value is equal to NOPAT plus K. Why NOPAT? Why not FC, FF? Both are equal. Because there is no growth. Because there is no growth. So we can take NOPAT. If you look at your question book, NOPAT means profit after tax only. Because there is no other calculation involved. So 1400. Can you see 1400? Yes, sir. Divide by 15%. Come on, be ready with the answer. So one student Rishabh has replied 9333.33 lakhs. Very good. I am happy. Now write down step 2 at the top, post strategy value. This I am going to divide into 2 parts. First 3 year there will be growth. First 3 year there will be growth, and from the 4th year it will become constant. Okay. So write down stage 1. Stage 1. When there are growth given for 3, 4, 5 years, you will have to prepare a table and find out the individual year FCFF. Okay. So write down the heading stage 1. Stage 1 means explicit period of 3 years. When individual year cash flow we can compute. Write down this table, serial number, particulars, year 1, year 2, year 3, year 1, 2, 3 you have written. First point A, write down NOPAT. First you write down NOPAT. They are saying that the growth will be 20%. If sale will grow at the rate of 20%, NOPAT will also grow at the rate of 20%. So what you do, to ensure you don't make a mistake in the exam, write the calculation 1.20 into previous year. 1.20 into previous year. Previous year was 1400 into 1.20, 20% growth. 1680 plus 20%, check 2016 plus 20%, check 2419.20. Is it right? Yes. Now write down capital employed. Capital employed will also grow at the rate of 20%. What was the capital employed in the previous year? Look at your equity, 12,000. A balance sheet. Look at balance sheet information. Yes, or you can look at the fixed asset plus current asset, 8 plus 4, 12,000. That will also grow at the rate of 20%. So take 12,000 plus 20%. 14,400 plus 20%, 17,280 plus 20%, 20,736, right? I have to find out what will be change in the capital employed. So write down point number C. So the point of mistake is the student may not consider change. They may directly take the capital employed. You have to take change in capital employed. How much additional funds will be required? Okay. How much additional funds will be required to support the growth? So point number C, I will write increase in capital employed. Increase in capital employed.
That is the 20% only that will
be 20% only. You can write directly also. So 20% of 12,000 you can write. Okay. Or current year requirement is 14,400. You already have 12,000 invested.
Yes, sir.
So you need additional fund of 2,400. Now this takes care of three things. This takes care of capex, depreciation, and additional working capital. This takes care of three things. So I don't have to write depreciation again because it is already taken care of in the increase in capital employed. Next year you will require 2880. Next year 3456. Just keep taking the difference between these two numbers. Right. Now you will write FCFF. FCFF. A minus C. Students in the exam they write A minus B, but we have to take A minus C. Okay. So 1680 is your NOPAT. Additional capital required 2400. So first year there is a negative 720. Second year 2016 NOPAT minus additional funds required. So free cash flow 864 negative. Third year NOPAT minus additional funds 1036.8 negative. So what you will do next now, you will convert into present value. Point number E, present value. Take on your calculator. 720 divided by 1.15. 720 divided by 1.15. 626.09. Memory plus. 864 divided by 1.15 2 times equal to memory plus 653.31. Again 1036.8 divided by 1.15 3 times equal to memory plus
681.71.
Yes, if you have used memory plus, memory recall function you will press. You will get the FCFF for first 3 years.
1961.11.
How much you are getting? 1961.11 lakhs?
Yes, sir.
This is for first 3 years. Game is not over. From 4th year till infinite period. From
4th year.
You will get free cash flow which will be constant. And what will be that free cash flow on the screen? It will be equal to NOPAT. If there is no growth, FCFF is equal to NOPAT. So write down below note. Write down below note. Everybody please participate. Note, write down after 3 years. After 3 years, the growth rate is 0%. The student after some months they will ask me why we have taken FCFF as NOPAT. Because there is no growth. As there is no growth, net investment would be 0. As there is no growth, net investment would be 0. As there is no growth, net investment would be 0. Hence, FCF is equal to, free cash flow is equal to free cash flow is equal to NOPAT. Free cash flow is equal to NOPAT. Free cash flow is equal to NOPAT. So now write down terminal value. TV means terminal value. Terminal value means value at the end of explicit forecast period. Value at the end of 3 years. PV3. PV3 is equal to NOPAT by K. PV3 is equal to NOPAT by K. NOPAT of the third year, previous table, 2419.2. 15% is your cost of capital or target return. Now I want the students who are learning at home also, they must give me the answer. Why you have gone into silent mode? So what is the terminal value?
16128.
One student has replied 16128. Wonderful. 16128. Now this is the value at the end of third year. Do I need to further discount it by 3-year factor? Yes.
Yes, sir.
So write down below present value of terminal value. Priyanka is right, Mehul is right, Rishabh is right.
So because that is PV3. No, so
That is PV3. So we have to make it PV0.
Yes, sir.
You have to make it PV0. So right now you are here, 16128. You have to come to 0. So you have to discount it by 3-year factor.
15%.
So write down 16128 into PV factor for 15% and 3-year. So on your calculator, take the factor 1 divided by 1.15 equal to. You'll get this factor multiplied by 16128. So Kabra has replied 10,604.42. Amazing. Amazing. Garg has also replied same. Sidana also same. So this is my stage 1 plus stage 2 will give me the final answer of post strategy value. Student will write, therefore post strategy value equal to, therefore post strategy value equal to stage 1 plus stage 2. Stage 1 is 3-year period and stage 2 is that infinite period. Who will give me the final total? Come on, answer. Come on, answer. Stage 1 was a negative figure, 1961.11. Stage 2 was a positive figure. So the answer is 8643.31.
Yes,
Priyanka is right. Now compare pre-strategy value with post-strategy value and check whether your value will increase or not. So student will reply whether it is better to adopt the new strategy or not. Come on. Whether it is better to adopt the new strategy or not.
No, it's negative 933.
So write down step number 4.
It is negative.
Value of strategy. It can be negative, it can be positive. Value of strategy equal to post strategy value minus pre-strategy value. So one student, Priyanka, said no, we should not undertake the new strategy. Rishabh also says no. The answer is right because there is some negative impact of the strategy on the value. Almost 690 lakh rupees value will go down. So 8643.31 minus 9333.33. 690 lakh you can write. Approximately 690 lakh. Write down approximately 690 lakh. Don't worry, institute will not deduct marks for rounding off. Since the strategy is negative, since the value of strategy is negative, write down the comment and complete the answer. Since the value of the strategy is negative, since the value of the strategy is negative, the strategy should not be implemented. The strategy should not be implemented.
So all this also depends on the company's target rate of return. If that changes,
A
everything
lot
changes.
depends on discount rate. Discount rate is very important because that can affect your answer. Yes, you're right. But we are a student, so whatever discount rate is offered to us, we will use that. Okay. Some student can ask, what about the depreciation at 10%? That is already included in the change in the capital employed. The effect of the depreciation has already gone into the change in the capital employed. So don't worry about that. Now we'll go to next topic, mergers and acquisition. Next topic, merger and acquisition, highly important topic, and there can be a large number of questions on this topic. Okay, there can be a large number of questions on this topic. So we have found out 4 important questions. Due to fast track revision batch, we'll take some important questions. There is huge variety of sums we can solve here. Okay, but let us take some of the typical exam questions which they are likely to ask. Question number 1. Come to question number 1. This question number 1 is from October 2021, MTP for 8 marks. Mark it important. All 4 questions I am going to take will be treated as important. Intel Limited, promoted by a transnational company, is listed on the stock exchange holding 80%. So Intel Limited is promoted by this company, transnational company, and it is holding 80% in that company. 20% is with the public. 20% is with public. 20% is with public. This is public holding is called non-promoter holding. Public holding is called non-promoter holding. Is it right? This is a very good question in the current scenario. If in India there is a public limited company, listed company, public holding should be at least 25%. At least 25%. But here the public holding is less than 25%. So this company will have to issue more share to the public. Okay. The value of the floating stock is rupees 45 crore. What is the value of floating stock? Value of 20% stock. The value of 20% stock which is available with the general public is 45 crore. So you can find out the total value of the company from this information. 45 divided by 20%.
225.
So 225 will be the total value of the company. The current market price is 150 rupees. Capitalization rate is 20%. The promoter holding is restricted to 75% norm, 75% as per the norms of listing requirement. So promoter holding is right now 80. They will have to bring it down to 75%. Is it right?
Yes, sir.
This in recent past, some of the Adani group company had a similar situation where the public holding was less than 25%, and therefore now they are trying to increase the public holding to 25%. So therefore, in the current scenario, this question is very appropriate. Now they are saying the board of directors have decided to fall in line to restrict the promoters holding to 75% by issuing bonus share to minority shareholder. Who are these minority shareholder? This public. Public is minority shareholder. They are holding 20% only. The promoter is holding 80%. So they will have to issue bonus share to the public. So public shareholding will increase. If public shareholding will increase, automatically the promoter's holding will reduce while maintaining the same P ratio, while maintaining the same price earning ratio. So price earning ratio will remain the same before bonus issue also and after bonus issue also. You are required to calculate the bonus ratio. So what should be the bonus ratio such that hello, what should be the bonus ratio such that
the P ratio also remains the same?
P ratio also remains the same. And second question is, what will be the market price after the issue of bonus share? And third question is, what will be the free float market capitalization? Free float market capitalization means non-promoter value of the shares held by public or non-promoter or minority interest after the bonus share. Is it right? First you will try. I will give you 1 minute to try your luck and tell me what should be that bonus ratio which will reduce the public holding to 25%, which will make public holding 25%. Yes, anybody wants to reply? Some students have already replied. Yes. Let me check who has got it right. Now, what is the free float valuation? 45 crore.
Yes, sir.
This is 45 crore. And what is the market price per share? 150. So can you calculate the number of shares held by minority? 45 crore divided by 150 will give you number of shares held by minority. So how much will that be? 30 lakh. Minorities are holding 20% share in the company. So the total number of share of the company is 1 crore 50 lakh. Total number of share of the company is 1 crore 50 lakh. Out of that, 80% is held by promoter. So promoter holding is 1 crore 20 lakh.
Yes, sir.
Now they want promoter holding should be 75%. Now they want promoter holding should be
75%.
So the total number of share of the company should be 1 crore 20 lakh divided by 75%. If the total share of the company is 1 crore 60 lakh, promoter are holding 1 crore 20 lakh, promoter share will be 75%. Right? Public holding should be how much? 40 lakh. Why 40 lakh? Out of 160, 120 is held by promoter. So if out of 160, 120 is held by promoter, public should be holding 40 lakh. 40 lakh. And how much they're holding right now? 30 lakh. So we have to increase the public holding from 30 to 40. So number of bonus share to be issued must be 10 lakh. 10 lakh bonus share against 30 lakh existing share. 10 lakh bonus share against existing 30 lakh share. If you give, the public holding will become 40 lakh. The bonus ratio will be 1:3. The answer is 1:3. Rishabh has given this answer. Very good. Amazing. So now we'll write down the answer of the first part. So write down the answer of the first part. Calculation of number of shares, bonus share to be issued. Calculation of number of bonus shares to be issued. Calculation of number of bonus shares to be issued. Please write down calculation of number of bonus share to be issued. Then you write down in detail. First point A, free float market capitalization in rupees crore. See the presentation. You have to write in detail. All calculation must be shown. Format can be different, but presentation should be such that all calculation must be there. So we have 45 crore rupees. Free float market capitalization means shares held by minority interest, shares held by non-promoter. Current market price is 150. Please write down little fast. Current market price is 150. Number of shares held by minority. Number of share held by minority in crores. 45 crore divided by 150. Just remove this crore, because we are writing actual absolute digits. We are writing 30 lakh shares are held by minority. Now minority shareholding percentage at present is how much? 20% today, before the bonus. Before bonus, minority holding is 20%. So if minorities are holding 30 lakh and their stake is 20%, can you calculate the total number of shares? So write down total number of shares at present. C divided by D. C divided by D. This company right now is holding or has issued 1 crore 50 lakh shares. This company has issued 1 crore 50 lakh shares. Up to this, if you have understood, then you can understand the remaining answer. Is it right? Point number F, write down. Shares held by promoters. 80% of 1 crore 50 lakh. 80% of 1 crore 50 lakh. 80% of 1 crore 50 lakh. Revised shareholding percentage of promoters. Revised shareholding percentage of promoters after bonus issue. Revised shareholding percentage of promoters after bonus issue. So how much do we want? We want 75%.
Yes, sir.
We want 75%. Promoter will not be issued bonus share. Promoter will continue to hold 1 crore 20 lakh and divide by 75%. Divide by 75%. So now it will be 1 crore 60 lakh. 1 crore 60 lakh. 1 crore 60 lakh. If promoter is holding 1 crore 20 lakh, desired shares 1 crore 60 lakh, so public holding should be 40 lakh. Shares of minority after bonus, H minus F, 40 lakh. How many shares minorities are holding right now? 30 lakh. How much do you want after bonus issue? 40 lakh. So therefore, bonus shares issued to minority, bonus share issued to minority, bonus share issued to minority will be I minus C, 10 lakh, I minus C 10 lakh. 10 lakh bonus share against 30 lakh existing share. So point number K, bonus ratio is 10 lakh is to 30 lakh. 10 lakh is to 30 lakh, that is 1 is to 3. Was it difficult or easy? It was easy, but you have to practice because this step should be done properly. Now tell me any query on first part. Next question is, which again you will try, what will be MPS after issue of bonus share? I am giving you a chance to reply 30 seconds. What will be market price per share after bonus share? 30 seconds allowed to you. Please reply. Anybody wants to reply? Market price per share after bonus issue. Let us say this question appears in your exam. How will you solve? Market price is equal to EPS into P ratio. So you have to find out both the numbers. What will be EPS after bonus issue and what will be P ratio. So the student will have to find out these two numbers to answer this question. Anybody wants to reply? I am waiting for your answer. I am waiting for your answer if you want to reply. Okay. So now write down, I will tell you, there is a hint in the problem. Hint is that capitalization rate is 20%. You have studied in your financial management, capitalization rate means EPS upon MPS. EPS upon MPS. And P ratio means MPS upon EPS. Capitalization rate is EPS upon MPS. Therefore, P ratio is MPS upon EPS. So can I say P ratio is equal to reciprocal of capitalization rate. Oh my God. P ratio is reciprocal of capitalization rate. That is a concept one should know. So once you know the P ratio, you can solve the problem easily now. So write down P ratio is equal to 1 by 20%. If nothing is given, then take P ratio as reciprocal of capitalization rate. Capitalization rate is EPS upon MPS. So that was the trick in this question. P ratio will be 1 by 20%, that is 5. And what is the current market price? Current market price 150. Current market price 150. So if you know market price, if you know P ratio, can you tell me what is EPS? EPS will be market price upon P ratio. Market price upon P ratio. C divided by B. EPS is 30 rupees. EPS is 30 rupees. If EPS is 30 rupees and the total number of shares before bonus issue is 1 crore 50 lakh. Total number of share before bonus issue is 1 crore 50 lakh. Now this all requires some mathematical skill, okay? Some basic understanding of the numbers. EPS is 30 rupees. Number of shares are 1 crore 50 lakh. Can we not calculate the total earning of this company? So what will be the total earning of the company? Total earning of the company will be 30 rupees into 1 crore 50 lakh share. That will give me total earning D into E. Will the bonus share affect the earning? Tell me, yes or no. Everybody, students at home also. Will the bonus share issue affect the total earning? Will the bonus share affect the total earning? The answer is no. Because in bonus share, we don't get additional capital, additional funding. So my business is run with the same capital.
Yes.
Write down. Total number of shares after bonus issue, which is 1 crore 60 lakh. As per step 1, total number of share after bonus issue 1 crore 60 lakh. 1 crore 60 lakh. Now write down revised EPS. Revised EPS after bonus issue. It will be F by G. Revised EPS after bonus issue, F by G. 28.125. 28.125. Then write down P ratio. The question says P ratio will remain same. Somewhere in the problem they have mentioned P ratio will remain same. So same means it will remain 5. Now tell me what will be MPS after bonus issue? What will be MPS after bonus issue? Is it 140.625? EPS into P ratio, G into H.
140.625.
Very good. 140.625 is right. 140.625 is right. Come on, everybody. Very good question. Okay. Nobody was able to answer this number either in the class or at home. Third question is, what is free float market capitalization after bonus? Free float market capitalization after bonus. Any other method also is right if you are able to reach the same number. Okay, don't worry. Because it's a mathematical topic, so you'll get the same result. Total market capitalization divided by total number of share. Even that will lead you to the same result. But this method of presentation is okay because the P ratio you have to present in your answer. Write down next answer. The free float market capitalization after bonus issue. The free float market capitalization after bonus issue. Both methods are right. You can either take market capitalization divided by number of share, or you can multiply P ratio into EPS. Free float market capitalization. Free float market capitalization means market value of shares held by non-promoter. Market value of shares held by non-promoter. So you will first write number of shares held by non-promoter.
40 lakh.
40 lakh. Market price after bonus issue. Market price
140.
after bonus issue.
165.
140.625. Last line. Therefore, free float market capitalization. Therefore, free float market capitalization is 56.25. 56.25. This is the answer, 56.25. In crores. In crores. So non-promoters will benefit because of this exercise. Their valuation was 45 crore. Now they have gone to 56.25 crores. Next, write down question number 2. Another very good question from July 21 exam for 5 marks. And you probably may not have done it before. Okay. Again, like this question number 1, it requires a lot of calculations. Are you ready? SM Limited has a market capitalization of 3,000 crore. Total market value of all share is 3,000 crore. And the current EPS is 200 rupees. EPS and P ratio is 15. So my question is, what is current MPS? 300 rupees. 200 into 15 is how much? 3,000.
3,000.
This is the total market cap, means total value of all the shares. Each share is 3,000 rupees. So what will be the number of shares? Can you guess number of share? 3,000 is the market cap, 3,000 is the market price per share. So the number of shares will be 1 crore. So indirectly one figure is given, number of share is 1 crore. The board of directors is considering a proposal to buy back. Oh, this is reverse. Buy back. Previous question was issue a bonus share. Many companies in the recent past has gone for buyback. Okay, like TCS has gone for buyback. Paytm has gone for buyback. So practically also you have to check, do we see such thing around us? The answer is yes. So company is considering a proposal to buy back 20% of share. 20% means they are going to buy back 20 lakh shares. Do you agree? When you are reading the problem, mind should also keep working. The company is planning to buy back 20 lakh shares at a premium. Now this is what you will have to compute sometime later. At a premium which can be supported by the financials of the company. The board expects post buyback market price of 3,057. So they want that after the buyback is complete, the MPS should be 3057. Post buyback P ratio, price earning ratio, will remain same. So 3057 is the market price. P ratio will remain 15. So what will be the EPS after buyback? What will be EPS after buyback? 3057 divided by 15. 203.8. So this will be your EPS after the buyback. Okay. And how many shares you are left with after buyback? 80 lakh shares. 80 lakhs. 100 minus 20. 20%. So what will be your total earning after buyback? what will be your total earning after buyback? EPS is 203.8, number of shares are 80 lakh. So what will be total earning after buyback? Total PAT after buyback, PAT. Multiply, take your calculator, 80 lakh shares into 203.80. So your post buyback capital, post buyback profit is 16 something.
163.04 crores.
16, you give me in 5 digits. Multiply 80 into 203.8. 16304. Mehul is right. So this will be my PAT after buyback. Okay, let us read the problem. The company proposes to fund the buyback by availing 8% bank loan. So the amount you are going to pay for the buyback will be borrowed from bank at 8% interest. Tax rate is 30%. Calculate the interest amount which can be paid for availing the bank loan. The interest amount which can be paid for availing the bank loan. Very interesting question. Second question, what is the loan amount to be raised? Loan amount will be interest divided by 8%. Second question is easy if you can answer the first question. If first is wrong, second is automatically wrong. You will not have to take extra effort to make it wrong. Okay. And the third question is, what is premium per share and the percentage premium paid over the current market price? So for that you will have to find out what was the buyback price. Buyback price will be compared with current price 3000. The difference is called premium. And the premium divided by 3000 will give you the premium in percentage. Compared to current price, how much premium the company has given to the shareholder to induce him to go for buyback. So since you are an intelligent student, I'm going to ask you first answer. Without any further discussion, take 30 seconds mental rest and try to reach interest amount. 30 seconds starts now. Assume that I am taking your class test today. Give me the interest amount.
In this question, the total earnings will also change because last question it was a bonus issue. No? So
yeah, total earning will definitely change because
fund flow is going up.
You have taken a loan. So because of the interest paid, your earnings will change. Is it right?
So also because of interest paid and also we are paying back. No?
Yeah, you do your calculation. What you are saying is right. Based on your understanding, give me the interest figure. Whatever data they have given, based on that you will answer. Theoretically, earnings will change because of reduction in the capital employed. But that capital reduction they have supported by bank loan, not from existing capital.
Okay. Then the 8% change that will.
Whatever is the amount paid to shareholder is replaced by a bank loan.
Bank loan. So 8% that will be.
Right. But give me the answer first. My question is interest amount. Student has a query and answer. What is the interest amount? My question is, what is the interest amount? Very easy question. Yes, please reply. Nobody has replied till now. I am still waiting. So see, the answer is very easy. what is your current profit after tax? EPS is 200 multiplied by 1 crore shares. So your current earning in rupees in lakhs is, current earning is 20,000 lakhs, and your earning after tax after buyback was 16,304. This difference represents interest, because only because of interest your earning will change. Earlier your earning after tax was 2,000. This 200 into 1 crore share. Since we are writing in lakhs, it will become this much.
Okay.
Now this is your earning after tax. The difference will be 3696. Sorry, 3696.
3696.
This is the interest after tax.
That is the interest amount.
Interest after tax amount, because it is, we are comparing earning after tax. So interest before tax will be, 3696 divided by 1 minus 0.3. So the interest before tax will be 3696 divided by 1 minus 0.3. So that is 5280. 5280 lakhs would be your
Interest
interest
before tax. Yes,
before tax. And this you divide by 8%. This you divide by 8%, you'll get the loan amount also.
66,000.
66,000 lakhs or 660 crore. Rishabh has already replied. Very good. Congratulations. You are right. You are on the right path if you can solve questions like this. So now I'm going to present my answer, which will cover first and second part. Is it right?
Understood now, sir.
And then once you get this figure right, you can answer the third part also. So write down first part.
A good question.
Good question. You're right. Good question. I will take only good question for you, which will give you a lot of understanding. Calculation of number of shares to be bought back. Calculation of number of shares to be bought back. Calculation of number of shares to be bought back. That was an easy part. First write down point A. EPS before buyback. EPS before buyback. EPS before buyback. 200 rupees. Write down in rupees. Then write down P ratio 15 times. P ratio 15 times. MPS before buyback in rupees. MPS before buyback in rupees, A into B, 3,000. Okay, this I think everybody should get it right. At least 0.5 marks you will get if you write so much. Then you write down market capitalization before buyback in rupees in crore. Market capitalization before buyback rupees in crore, 3,000, which is given. Therefore, number of shares before buyback, D by C, 1 crore. Number of share before buyback, 1 crore. 3,000 divided by 3,000. 3,000 divided by 3,000. Correct. And then write down number of shares to be bought back is 20% of 1 crore. 20% of 1 crore. 20 lakh shares. So after the buyback, the number of shares will become 1 crore minus 20 lakh, 80 lakh. Is it right?
Yes, sir.
After the buyback, number of shares will become 80 lakh. Now my next two questions will be answered in this table. Step 2, calculation of interest. which can be paid for availing bank loan and the loan amount raised. So I am answering our two questions. If you will get this much right, you will get 4 marks. And if you get the last one also right, you will get full 5 marks. A very interesting question. First write down desired post buyback price per share. Desired post buyback price per share. Desired post buyback price per share 3057. Then write down P ratio. P ratio is 15 times. P ratio will not change. P ratio will not change. So if your price is 3057 and if your P ratio is 15, can you calculate the post buyback EPS? The post buyback EPS will be A by B, right? A by B 203.80. 203.80. Then you write down point number D, number of shares after buyback.
Yes.
Number of share after buyback. We had 1 crore share and we have bought back 20 lakh. So the number of share after buyback would be, write down 80 lakhs. Number of share after buyback would be 80 lakhs. Number of share after buyback would be 80 lakh. Point number E, post buyback EAT. Post buyback earning after tax. This is my EPS and this is number of share. So when you multiply these two, you'll get the total earning after tax after buyback. Multiply C into D, rupees in lakhs, 16304. 16304. And what was pre-buyback EAT? Pre-buyback EAT. Pre-buyback EAT was, you had 1 crore share, that is 100 lakh shares, and the EPS was 200 rupees. So the pre-buyback earning after tax was 20,000. But it has gone down from 20,000 to 16,304. The reason for this drop is the interest paid on the loan. There's no other reason. After tax, because we are comparing earning after tax figure. So the difference will also be earning after tax figure. Difference will also be post tax figure. So now point number G write down. Point number G write down post tax interest that can be paid. Post tax interest that can be paid, that is G minus E. This is not G minus E, it should be F minus E.
3696.
Yes, F minus E.
So if tax rate was not given, we would have assumed this only as.
Yes, if tax was not there, then this is the interest. Okay, if tax is not there, then this is the interest. But tax is there, that is where the institute will earn income from you. Because many students will take this only as an interest. This is not interest, this is post-tax interest.
Post-tax interest.
So the pre-tax interest will be 3696 divided by 1 minus 0.30, that is tax rate. So this is the actual interest you are going to pay, 5280.
Yes, sir.
And the interest rate is 8%. So one more answer you will get here is the loan amount raised. Loan amount raised. The loan amount raised will be 5280 divided by 8%.
66,000.
66,000 rupees.
Rupees in lakhs.
In lakhs. Write down rupees in lakhs. Rupees in lakhs write down. Or if you're writing in crores, 660 crore. This is the amount they have used for buyback. 66,000 crore or lakhs they have used for buyback 20 lakh shares. Correct?
Yes, sir.
So can you find out if you are paying 66,000 lakhs for buying back 20 lakh share, what is the buyback price you have paid to your investor? How much per share you have paid? 66,000 lakhs divided by 20 lakh. Per share paid to buy back the share is how much? Calculate. Per share amount paid. Yes, come on, student. Why are you not replying? So the per share amount you paid to buy back is 3,300. And the current market price is 3,000. So instead of 3,000, you are paying 3,300.
So 10%.
10% is the buyback premium. You are right.
10%.
Yes, very good, Rishabh. So write down the last answer. This is bonus mark. If you get that 66,000 figure right, this answer is automatic. Write down step number 3. Calculation of buyback premium and buyback premium percentage. Calculation of buyback premium and buyback premium percentage. First you write down amount paid for buyback, same figure, 66,000 lakh. The loan raised was fully utilized for buyback purpose, 66,000. Point B, number of shares bought back, in bracket step 1 is 20 lakh. Both figures are in lakhs. You can divide directly. Point C, buyback price per share in rupees. Buyback price per share rupees 3,300. Current market price per share 3,000. Current MPS 3,000. So first answer, what is buyback premium paid? Buyback premium paid is C minus D 300 rupees. And then what is the buyback premium percentage they are paying? So write down percentage premium. Just write down percentage premium and you will take 300 divided by 3,000. That is 10%.
Lovely sums.
Good sum. Enjoyed.
Yes, sir.
And how much you'll get? Only 5 marks. This is our professional exam. In BCom they asked it for 20 marks. And in professional exam only 5 marks. What an injustice to us.
But this was a good sum, sir.
Now you have to practice. Question number 3, another good sum, which is a 20-mark question. But it is very lengthy also and it deserves 20 marks. This is normally taught in the regular SFM batches, but because it covers many concepts of the chapter in one problem, I decided to take question number 3. Are you ready?
Yes, sir.
Yes. Everybody should say, then I will take. All the students who are learning from home will say yes, then I will start. Okay, so everybody is saying yes. Question number 3, write down, very important. The following information relating to the acquiring company Abhiman Limited. Abhiman is the acquirer, underline. And the target company is Abhishek Limited. Acquiring is Abhiman. Target is Abhishek. are available. Both the companies are promoted by a multinational company, Trident Limited. So who is the promoter? Promoter is Trident. The promoter is holding 50% and 60% respectively in Abhiman and Abhishek Limited. So these two companies are actually subsidiaries of Trident
Limited.
Are actually subsidiaries of Trident Limited, because Trident is holding 50% in Abhiman and 60% in Abhishek. So what is free float percentage in these two company? This is 50. So in Abhiman the free float is also 50%, and in Abhishek the promoter is holding 60, so the free float will be 40% here. Understood? Now it says share capital in rupees 200 lakh, 100 lakh, reserve and surplus in rupees 800 lakh, 500 lakh. If you add these two, what do you call it? If you add share capital plus reserve, what will you call it?
Equity.
You will call it shareholder fund or net worth. So we will call it net worth or shareholder fund, right? Then the paid up value per share is given 100, and here it is 10. Be careful, they are different, 100 and 10. Now just quickly answer. Share capital is 200 lakh, paid up value per share is 100. So indirectly, how many shares are there in Abhiman Limited? 2 lakh.
Yes, sir.
And in Abhishek Limited, 100 lakh.
100 lakh.
Divide by 10. How many shares are there in Abhishek Limited? 100 divided by 10.
10 lakh, sir.
100 divided by 10, 10 lakh shares. Some hidden information are involved. Then free float market capitalization is 400 and 128. We have already discussed.
50% and 40%.
Here free float is 50% and here free float is 40%. Then P ratio is given 10 times, 4 times. So these are basic data required for solving such questions. Okay. Now they have written a long paragraph. Trident Limited is interested to do justice to the shareholders of both the companies. For the swap ratio, weights are assigned to different parameters by the board of directors as follows. Now, how do you calculate the swap ratio? The swap ratio will be based on 3 parameters. Book value per share, earning per share, and market price per share. So not one parameter but 3 parameters will be used. Book value, earning per share, and market price. Which means I have to calculate first these 3 ratios or numbers for all the 3 companies. Is it right? Then compute the swap ratio based on this. Give them this weightage, and then you will get the swap ratio. So this itself will be a long task to find the swap ratio. For that, I need the book value per share of both the companies, EPS of both the companies, market price per share of both the companies. This is usually taught in our regular class, how to compute swap ratio when more than 1 parameters are used. Okay. Now your real intelligence will start from here. B. What is the book value, EPS, and expected market price of Abhiman after acquisition of Abhishek? So you have to compute post-merger book value, post-merger EPS, post-merger market price. And to help you, they have said assume P ratio will remain unchanged and all the assets and liabilities of Abhishek will be taken over at book value. So no problem. You just have to simply add the net worth of the 2 companies, that will give you total book value. Okay. Any query on this? No query. Very easy question, but it's a lengthy question and requires patience. Third question is calculate. Under that, again 3 questions. What will be promoters revised holding in Abhiman? What will be free float market capitalization? Not only that, to make your life more miserable, also calculate the number of share, EPS, and book value per share if after acquisition of Abhishek, Abhiman Limited decided to issue bonus share in the ratio of 1:2 and split the stock as rupees 5 each fully paid. So there is a bonus issue, there is a stock split also. Stock split means shares of higher denomination will be divided into shares of lower denomination. Earlier the share was 100 rupees. Now they want to reduce the face value to 5, which means 20 share will be issued against 1 share. So first they will give bonus share and then they will also go for stock split. So the number of shares will increase substantially. So first you will have to find out what will be the new share after bonus and stock split, and then you will have to calculate again the EPS and book value per share. So did you like this question? First tell me yes or no.
Lengthy questions about good.
But did you like it or
Yes,
not?
yes.
Like, okay. So write down. First we will find out for the 2 companies their individual BVPS, EPS and MPS before the merger. Is it right? Start. Question is lengthy but very easy. Today as a homework you will revise all the questions that we have done till now. Okay. So write down, students, calculation of book value per share, earning per share and market price per share. Right hand side 2 columns. Abhiman and Abhishek Limited. So how do you calculate book value per share? You have to calculate share capital plus reserve and divide by number of shares. Is it right? Write down share capital. Question should be in front of you. Share capital rupees in lakhs, 200, 100. Paid up value per share, 100, 10. Paid up value means per share value. Number of shares, point number C, A by B. Number of share in lakhs, A by B.
2 lakhs, sir.
In lakhs, 2 and 10. 2 and 10. Very good. Come on, next. Reserve and surplus. Reserve and surplus in rupees in lakh. Rupees in lakhs, 800, 500. So this is your share capital.
Yes, sir.
This is reserve and surplus. So if you add them, you'll get the net worth. That net worth divided by number of shares will give you book value per share. Okay. So point number E, write down net worth, A plus D. Net worth, write down A plus D. You add share capital and reserve. You will get 1000 here. Again 100 plus 500. You'll get 600 here. Now write down promoters holding percentage. In the question they have given you promoters holding percentage in the first paragraph. Promoter holding percentage 50% and
40%.
60%. Promoter is 50, 60.
Yes, sir.
Non-promoter will be 1 minus promoter. Okay. 100 minus promoter. Continue. How many points we have written? F. So please continue below this table. Please continue below this table. Write down point G, non-promoters holding. Non-promoters holding will be 50% and 40%. Agreed?
Yes, sir.
And what is the free float market capitalization?
Given.
It's given. Given in the fourth line of the table, 400 and 128. 400 and 128. Total market capitalization. Total market capitalization.
800 and 120 divided by 50%, 320.
H by G.
800 and 320.
800 and 320. Point number J. MPS, market price in rupees. Anybody who wants to reply? Market price. Total market capitalization divided by total number of shares. So I upon C. How much is the answer? 400. Very good.
32, I guess.
320 divided by 10. 32. You're right. Amazing. Now write down P ratio. P ratio in times. P ratio in times. Given. P ratio is given in the fifth line of the table. 10 and 4. P ratio is 10 and 4. So can you tell me what will I get next? MPS is known. P ratio is known. What will you get now?
Earnings per share.
EPS. Very good. EPS.
Okay.
EPS in rupees. Tell me how much is EPS in rupees? J by K. J by K. Yes, student, come on.
And 8.
40 and
8.
8. 40 and 8.
JKLM.
Now write down total earning. What is total earning of the firm? C into L. C into L.
So 80 and 80.
Number of share into earning per share. Anybody?
80 and 80.
80 and 80. Both are 80, 80. Very good. And one more line which is pending since long. Book value per share. This I could have written earlier also. Anybody who wants to answer book value per share, E by C. Net worth by number of share. Net worth divided by number of share in rupees. In rupees, come on, in rupees write down. E by C. So are you getting 500?
Yes, sir.
And second column? 60. Very good. Second is 60. So I got book value per share, earning per share, market price per share. So first we will compute swap ratio based on this, multiply by respective weights given in the problem. That will give me swap ratio, exchange ratio, and then we can calculate number of share to be issued. Okay. So once you get these numbers right, now the remaining part of this question is just a formality. So can we go ahead? Yes. Step 2, swap ratio. Step 2, write down swap ratio. Swap ratio in this problem is weighted average swap ratio, where we are assigning weights to different parameters.
3 parameters.
3 parameters. Students will write format first. Presentation is also equally important. First column basis, second column swap ratio, third column weight, fourth column weight into swap ratio. Right? Are you with me?
Yes, sir.
First basis book value per share. And how do you calculate the swap ratio? Target company ratio divided by acquiring company. Target company is Abhishek. acquiring is Abhiman. Book value per share of Abhishek divided by book value per share of Abhiman. What will be the ratio? 60 by 500. Is right? 60 by 500? 60 by 500. 60 by 500 is 0.12. Very good.
Yes, sir.
Now EPS, based on EPS, write down second EPS. Now what was the EPS of Abhishek? EPS 8 divided by EPS of Abhiman 40.2. Okay, you will give me MPS. You will give me MPS.
32 divided by 400. So
32 divided by 400. Is it 0.08?
Yes, sir.
0.08. Now give the weights according to question. 0.25, 0.50, 0.25.
The 0.3 first weight.
0.03, 0.10, 0.02. Check the calculation. You can't make mistake here. Your remaining entire answer will go wrong.
25, yes, yes.
So the total comes to 0.15.
So we can write the first one as 0.25 also, no?
0.25, yeah. It is actually 0.25. You can write 0.25. So the swap ratio is 0.15:1. 0.15 share will be issued against 1 share. 0.15 share will be issued against 1 share.
Okay.
0.15 share will be issued against 1 share. Now the remaining questions are very easy. Only some calculations are involved. Step 3, write down. Right below. Step 3. Number of shares issued. Number of shares issued. Go to the question. Abhishek Limited has got 10 lakh shares. Yes or no? 10 lakh into 0.15. 10 lakh into 0.15. 1.5 lakh share. 1.5 lakh shares. 1.5 lakh shares. Now write down step 4. Total number of shares after merger. Total number of shares after merger. Abhiman Limited has 2 lakh share. Abhiman Limited has 2 lakh share.
And it issued 1.5.
And it issued 1.5 lakh share.
1.5.
So now it will have 3.5 lakh shares. Do you agree?
Yes, sir.
If you agree, then go ahead. Any query till now? Now my next question is point number B. Keep question in front of you. What is book value, what is EPS, and what is market price after acquisition? Assume P ratio will remain same. Okay, we are answering part B. This is the answer of part B. Post merger book value per share. Right hand side rupees in lakhs. PVPS means book value per share. The problem says the assets will be recorded at their book values. Means you just have to add the net worth of the two companies. You just have to add the net worth of the two companies. So combined net worth is.
So whatever calculation we had,
we have done in the earlier table, we will use
same.
it now. Correct, because the assets will be recorded at book value. So same assets plus same asset is the total. What is net worth? Suppose this is my balance sheet.
1,000.
We have share capital, we have reserve, we have asset, we have liability. So asset minus liability, share capital plus reserve is asset minus liability. So this will be recorded at book value. So the total will match. total net worth will match.
Yes.
Is it right?
Yes, sir.
So write down total net worth 1000 plus 600. So write down this comprise of 350 lakh share capital. Why 350 lakh share capital? You can see here 3.5 lakh into 100, and remaining will be reserve and surplus. Remaining amount will be reserve and surplus.
The net worth will be same, but the EPS and everything will change, no? Because
Number of share will change. I am only telling net worth will be same. I am not saying EPS will be same. That is why we have to compute EPS again. Net worth will be same. The logic is asset plus asset will be same. Liability plus liability will be same.
Yes, sir.
So when both are same, the difference of asset minus liability will be same. Okay, so can we move ahead now? Number of equity share, here you see 3.5 lakh. Number of equity share we have computed in step 4 above, just above, 2 lines above, 3.5 lakh. 3.5 lakh. If you don't want to write this, don't write. Don't take stress. Okay.
That is what is confusing.
Unnecessary. Don't take stress. Something if it gives you stress, don't do it. Except CA course, because that also gives lot of stress. But at least some professional degree I require. I have to eat bread butter also. Yes or no?
Yes.
Otherwise, remaining thing ignore.
That was confusing me.
So that is not confusing. That requires intelligence. Unfortunately, we are not in a mood to apply that. 3.5 lakh into 100 is 350 lakh share capital. Remaining is reserve. Reserve. For that, I have to do accounting, but that is not my scope of work right now.
3.5 lakhs is this thing, no, sir.
Number
of shares,
into
but
100 rupees face value. 350 lakh. Achha, you ignore it. Okay, let us not waste time. If you are not comfortable with this, then kindly remove. If you have understood it, keep it. Okay, choice is yours. So BVPS is 457.14. 457.14.
Yes, sir.
Correct. Now next is step number 6. Very easy. Bonus mark. Calculation of post-merger EPS and NPS. Everybody can ask question. Everybody can reply. Post-merger EPS and NPS. Nothing to explain here. Total earnings will not change. So write down total earning after merger. You have already calculated total earning in the step 1. 80 lakh for both companies. 160. Number of shares already calculated in the step number 4. Number of share in lakhs 3.50. Number of share 3.50. Post merger EPS. Very easy question, nothing to explain. A by B in rupees. $45.71. Check. P ratio remains the same 10 times. P ratio of Abhiman Limited will remain same 10 times. So therefore post merger EPS C into D without calculator 457.10. 457.10. 457.10. Is it right? 457.10.
Got it.
Any query now?
Yeah. वो जो paid up value है ना, that is actually the face value ना.
Paid up value per share is face value per share.
3.5 lakhs into 100 per share.
Yes, now you got it. So this completes our second answer. Sometime in the exam they only ask part A and part B, okay? But this time they have asked you additional questions. So part C now. Now we are replying to part C. Write down part C and below that write step 7. Promoters revised holding. Promoters revised holding and free float market capitalization. So this will answer my part 1 and part 2 of part C. So how do I calculate it? Very easy. First you write down point A, total number of shares after merger. Total number of shares after merger
3.5
is 3.5 lakh.
Yes, sir.
Total number of share after merger 3.5 lakh. Point B, write down promoters holding. Promoters holding. The promoter was holding earlier. Understand this part. Earlier they are holding 50% of 2 lakh. This is your existing holding, correct? In Abhiman Limited. This is existing holding in Abhiman Limited, 1 lakh, 50% of 2 lakh. Then in the Abhishek Limited, they are holding 60% of 10 lakh. And this is your swap ratio. So they will get 6 lakh share they are holding multiplied by swap ratio. So these are the shares got as a result of merger. 1 lakh they are already holding. 6 lakh into 0.15 will be issued to them. So my question is, what is the total number of share held by promoters after the merger?
1.9 lakh.
1.9 lakh. Very good. So can you not convert into percentage?
Yes, sir. We can.
Right. Promoter holding percentage 1.9 divided by 3.50.
54.29.
That is 54.29. So non-promoter holding percentage.
1 minus promoter.
100 minus 54.29. What is the answer?
1 second. Calculation.
Non-promoters holding percentage 45.71%. Keep trying, keep trying. This is again a very good question. What is the market price per share in the step number 6? Market price per share in the previous step 6 was 457.10. The question is, what is free float market capitalization? This is total number of share. This is non-promoter holding. This is MPS. So if you multiply these three things, don't you think you will get the free float market capitalization?
Can you repeat?
Total number of share into non-promoter holding will give you number of share of non-promoter multiplied by price per share will give you the value of shares held by non-promoter. Next point, write down total market capitalization.
3.5 minus 1.
Total market capitalization is 3.50 into 457.10, 1599. But suppose you want to write directly, you can multiply three things. You can also multiply by 45.71. So last line of this answer is, last line of part B, free float market capitalization. Free float market capitalization, total market cap into percentage of shares held by non-promoter. So the answer is 731.29 approximately.
So can we do it this way?
Any way you can do it. If your answer is same, you are most welcome.
So, but there's a little bit of difference, rounding of difference.
Rounding of difference after decimal is okay.
0.36 आता है.
0.36 is okay. One student has got 0.36, one has got 0.42 also.
So 3.5
So
minus 1.9.
see, enjoy 731 now. Why you are bothered about decimals? Who talks about decimal? Do you say that market capitalization of Reliance is 5,000 crore, 0.32? Then round up only, matter closed. Last step, number 8. Now the question has added one more part. This is part C3. This company has issued bonus share also, 1:2, and it has gone into stock split ratio 20:1. Is it right? So after that, our number of share will change. If the number of share will change, book value per share will change, earning per share will change. Is it right? So first write down the heading. Student has to write properly. Sometimes the student write directly and then the institute can deduct marks. So please write down number of shares of Abhiman Limited after bonus share and stock split. Number of shares of Abhiman Limited after bonus share and stock split. I am asking you, you are looking at me. What is the answer of this? Final answer. Show your intelligence. What is the final answer? Number of share before bonus and stock split is 3.5. Bonus share is in the ratio of 1:2.
1 for every 2. 3.5.
So 1 for every 2. So number of share will increase.
1.5.
And again that will be multiplied by 20 because one share will be split into 20 share. Why 20? 100 is the present face value. The revised face value is 5. So for one share, the company will issue 20 share. In case of stock split, the company reduces face value and increases the number of shares.
Yes, so 100 divided by 5.
Right.
20.
So write down the answer. One student has already replied. Very good. Let me check. First write down point A, number of shares. 3.5. Point B. Point B, bonus ratio 1:2. Point C,
1.75.
bonus share 1.75.
Yes, sir.
So what is number of shares after bonus issue?
3.5 plus 1.75. 5.25.
5.25. Point E, share split ratio. Share split ratio 100 by 5, 20. One share will be converted into 20 share of 5 rupees.
Yes, sir.
Then write down number of share after share split. Number of share after share split. D into E. D into E. 105. If you present like this, nobody has the guts to deduct marks. Okay.
Number of shares.
Multiply these two. 5.25 into 20. 105.
Achha.
105 lakh shares.
Of 5 rupees each.
Yes. Of 5 rupees each. Of 5 rupees each. If you want to write down for your understanding. Now using this number, we will calculate the revised EPS and revised book value per share. So write down our last answer
कितना बड़ा है?
Revised book value per share and revised EPS. Revised book value per share. Very lengthy question, but it's okay. Revised book value per share and revised EPS. Write down. There's no choice.
20 marks.
20 marks. Maybe now they will not give 20 marks. They will give only suppose 12 marks or 14 marks.
Theory भी आते हैं.
Yes. And one theory question of 5 marks they will add. So 15 plus 5 probably. Right hand side amount, or just draw one table. Point A, write down number of share after bonus and stock split as per step 8. 105. Combined earning. Combined earning 160, not change. Bonus and stock split will not affect earning because there is no new capital introduced in the business. There is no outflow of capital also. It is just a accounting impact, no real impact.
Presentation.
Yes, numbers will change, face value will change, but the total capital employed remains the same. Then write down revised EPS. Revised EPS will be B upon A, rupees 1.52. Rupees 1.52. Then write down point D, combined net worth. Again we have done it, it will not change. Only face value and numbers will change. Reserve will get converted into share capital.
Yes, sir.
But your total net worth will remain same. Total net worth will remain same.
15.2.
Total net worth will remain same. Because of bonus and stock split, they will not change. So 1600. So 1600 divided by 105.
15.24.
15.24. 15.24. Right? Enjoyed?
Yes, sir. ये आना चाहिए sir. Exam.
This should appear in the exam.
15
I also hope.
bonus.
One last question on merger we will take. Very small question. Question number 4. This question was first asked in November 14 exam for 5 marks, and there was a similar question, not same, similar question in May 22 exam. This question has a concept, okay, which will be very useful to everybody. So come to question number 4. It has a new concept now, which is true cost of acquisition. Are you ready? Everybody will say yes. Then I will go ahead. Yes. So let us read the problem. Elron Limited plans to acquire Doom Limited. The relevant financial details of the two firms prior to merger announcement. This is individual figures. Elron is price 50, Doom price 25, number of share 20 and 10. So market capitalization will be how much?
50 into
50 into 20.
1,000
Market cap is 1,000.
lakhs.
And here market cap is
250 lakhs.
250 lakhs. Understandable format? Right. The merger is expected to generate gain which will have a present value of 200 lakh. So if the two companies merge together, the market value of the merged entity together will increase by 200 lakh because of synergy benefit. Because of synergy. Synergy benefit means additional benefit due to merger. Sales will increase, cost will reduce, market share will increase, bargaining power as a group goes up and the exchange ratio will be 0.5. So how many shares will be issued? 10 into 0.5. 5 lakh share will be issued. 5 lakh share will be issued. 10 lakh into 0.5. 5 lakh share will be issued. So what will be the number of share after merger? 20 lakh plus 5 lakh share issued.
Yes, sir. Yes, sir.
So my question to this batch of talented student is, what will be MPS after merger? MPS will be total market capitalization divided by total number of share. Calculate 1000 plus 250 plus 200 and divide by 25. 1000 plus 250. So how much is the answer?
58.
58 will be market price after merger. 58 will be market price per share after merger. When synergy gain is also given, add that also. What is this is the important question, underline true cost of merger from the point of view of Elrond Limited. True cost of merger. How much is the true cost? True cost, some student will say they have issued 5 lakh share and the market price after merger is 58. This is the cost. The answer is not this is the cost. क्या हो गया? 5 मिनट रुको. So I am going to give you how to solve question of true cost of merger and I am going to explain also. Write down. Please write down. The reason for writing it down, if they change the question in the exam slightly, you should be able to handle. True cost of merger. How much is your extra cost you are incurring by acquiring the target company? So step 1, write down. These are the steps. Then we will solve this question. This is theory part. First write down, first step 1, compute synergy gain. Synergy gain, which they have in the problem already given 200 lakh. Then step 2A, write down. Step 2A. Step 2A. Compute theoretical post-merger price.
58 जो हम कहते हैं.
बाद में we'll write down everything later. This is just a theory. How will you compute the post-merger market price? Market value of first acquiring firm plus market value of target firm plus synergy gain. Divide by, this is divide by number of shares of A plus shares issued to B. Number of shares to A plus shares issued to B. Now write down step 2B. Step 2B is the value of consideration. This is what you are paying to the target company. Value of consideration. Step 2A. Step 2A means this price multiplied by number of share issued. Multiplied by number of share issued. So you will get the value of consideration. Value of consideration. This is what we have paid. Less market value of B. This is what we have acquired. This is what we paid. This is what we acquired. So the difference between these two, what you paid versus what you acquired, is called true cost of acquisition. Is true cost of acquisition. If you have paid more than what you acquired, there is a cost involved, extra amount you have paid. You have paid to a company more than what it is worth in the market today. That is called true cost, 2B minus 2C. And if they ask you, what is the net gain to the acquirer company? What is the net gain to the acquirer company? This is the synergy benefit they get minus this is the cost of acquisition. So difference between step 1, this is synergy gain minus cost that you incurred. That difference is the net gain, which can be positive, which can be negative also. If you have paid a huge premium, huge amount to acquire the other company, which many companies do also in real life, so they don't have a positive net gain, rather they have a negative net gain. But this is not asked in the question. This is for future exam. Okay. Now come back to the question. Just 3-4 lines and the answer is over. Step 1, write down post-merger MPS. Post-merger MPS formula, market value of A for acquiring company, Elrond, plus market value of B for Doom. Instead of B, you can write Doom. Instead of A, you can write Elrond, plus synergy gain divided by shares of Elrond plus shares issued to Doom plus shares issued to Doom plus shares issued to Doom. One line blank equal to question in front of you, 50 into 20 market value of Elrond plus 25 into 10 market value of Doom and plus 200 synergy gain given in the problem upon 20 shares of Elrond, 10 into exchange ratio 0.5 issued to Doom. So the answer is 58 as we had already discussed. 58 is right. 58 is right. Okay. Now write down our step 2, which is the question. Calculation of true cost of merger. Calculation of true cost of merger. Right hand side rupees in lakhs. First point A, step A, synergy gain. Synergy gain they have given in the problem 200. Step B, capital B, small a, or you can just write whatever you want, A, B, C, D, E, F. Post merger market price 58. Post merger price 58. Step capital B, small b, value of consideration. Value of consideration. You have issued shares whose worth is 290. You have issued shares whose worth is 290. Correct? You have issued 5 lakh share at post acquisition price 58. The value of the share is 290. Now write down less MVB, market value of Doom, which is 250. 250 is 25 into 10. You are acquiring a company whose market value is 250 by paying a consideration of 290. How much more did you pay? You are acquiring a company of 250 by paying 290. How much more did you pay? Come on. 40. That is the answer. Compare these two. Many times student compare 290 and 200. That is wrong. So 40 is the true cost of acquisition. 40 is the true cost of acquisition. Step 290, just write down 290 minus 250. 40. And if they ask you what is the gain, The gain will be total synergy gain is 200. 40 you have transferred to other company. If they ask you what is the gain to acquiring company, if they ask you what is gain to acquiring company, then you will write 200 is my total synergy gain. Out of that 200 synergy gain, 40 I have shared with the target company. So acquiring company will also get 160 benefit in this deal.
Yes, sir.
Okay.
So,
One query from a student.
Sir,
Please wait.
the value of consideration वो वाला part.
Value of the consideration means
why we have taken post
because
merger price.
why we have taken post merger, because this is what my total market capitalization would be after merger, and in that market capitalization, what is the stake of target company? Because this 200 I have considered in the post merger market capitalization.
Yes,
this is the value we are sharing with target company in that post market capitalization. So that is why we have taken post merger market price, and this is what is left to us. This is the benefit that is left to us. So that is how the companies will do the calculation. How much is the benefit of acquiring the other company? Is it right? Net benefit of acquiring the other company. If you're acquiring other company for a benefit of 200, but out of that 40 you are sharing with them, so you are only going to get 160 in that increase in market capitalization. Okay, so this answer is over. Now we'll continue tomorrow. So dear student, as already mentioned, we are starting a test series. From 13th, you can appear any test anytime from anywhere. You have to register on our website vino.in, and we will send you the test series on your mail. You will write it, take the photo, make PDF and email us, and we will check the answer and send it back to you. There will be 4 tests for SFM and 4 tests for FR. I will be setting the paper and checking the paper also. On our Vino app, I have also uploaded one subject, FR revision in English. FR revision in English. I will also upload FR revision in Hindi. The price is 2000 rupees right now only, including the study material. Hard copy of study material will be mailed to you. So in case if the student wants to purchase FR revision, he can directly go to our Vino app and you can register there. The lecture will start immediately and you'll get the notes in the form of booklet in 2 to 3 days by courier. Okay. So thank you very much. See you tomorrow at the same time, 9:30.
Happy Holi.
Happy Holi to everybody. Enjoy your day. You should study also.
Hello, good morning everyone. Today's topic is very important. It is foreign exchange exposure and risk management. So in short, we will call it Forex. Okay. This topic is highly relevant for the exam. You will score about 10 to 20 marks from this topic in the exam. Some exams are even having a higher weightage on this. It can go up to 20-25 marks also. So I have selected some of the important questions from last few years exam, RTP, MTP, and similar type of questions are expected for Forex in the coming exam. So are you ready? Yes. So first question is from July 2021 exam for 6 marks, and we can see this question in the October 22 MTP also for 6 marks. So after MTP, the next destination is exam. So the question is Mr. Mamen an Indian investor invest in a listed bond in USA. Underline, who is the investor? Indian. Where he has invested? In USA. Okay, a similar question was asked earlier also in the exam, that is May 2012 exam, long back. Similar question was asked. So, if the price of the bond at the beginning of the year is $100 and it is USD 103 at the end of the year. Okay, so beginning value 100, ending value 103. So what is your capital appreciation? $3. Capital appreciation is $3. The coupon rate is 3% payable annually. 3% on which number? 100 or 103? 100. So the coupon will be 3. This is coupon. This is your capital gain. So total appreciation in dollar term is 6%. Total profit in dollar terms is 6%. Do you agree? If you agree, write down yes. Say yes. Find the return on investment in terms of home country currency. This is the important question. Find the return in terms of home country currency. That means in rupee terms, what is your return in percentage? If USD is flat means no change in exchange rate. USD is flat means no change in the exchange rate. Understood? Then second question is USD appreciates during the year by 3%. So dollar rate appreciates by 3%. Then what will be your return? And the reverse question, dollar depreciates by 3%. What will be the return? Indian rupee appreciates during the year by 5%. Suppose Indian rupee appreciates by 5%. Then what will be your return? Will your answer differ if Mr. Mamin invests in the bond just before the interest payable? Will your answer be different if you invest in the bond just before the interest payable? Even if you invest just before the interest payable, you'll get $3 interest, $3 capital gain. So total return will remain. Total return will remain. Come on, same. So the answer is total return will remain same. Doesn't matter which. Will your answer differ if Mr. Mamin invests in the bond just before the interest payable? As long as you are getting $3 interest, $3 capital appreciation, your return remains $6. Your answer will not change. If you don't receive the interest, if you invest after the interest payable, then only you have to get capital gain. But if you are getting interest also, then the answer will not change. Understood? So first answer is very easy. If US dollar rate does not change, the Indian investor will earn 6% only, because at whatever rate he had invested, at same rate he will get his money back. So the answer would be 6% in the first case. So first write down, this is a 5-mark question, 5 question, 5 marks, 1 mark for each question. So first you write down case 1, US dollar is flat. US dollar is flat. Write down everybody, US dollar is flat. So return is equal to, one is you are going to get interest, and second you are going to get the capital gain, which is the difference between price at the end minus price at the beginning. Divide by price at the beginning. My objective is not just to reach the answer. I am also telling you the presentation part. Some examiner, if you write suppose 6% directly, they will not give you marks. They want you to present also properly. I have seen students getting different marks because of difference in presentation. So write down 3 plus 103 minus 100 divided by 100. The answer is 6%. So there won't be any difference between this and Indian rupee return. This return in dollar and return in rupee will be same if the exchange rate does not change. But now your intelligence will be tested in full public view. Full public will check your intelligence today. If USD appreciates during the year by 3%, if USD appreciates by 3% during the year, now I am asking this question to this whole batch, face to face and online students. What will be the final answer? What will be the final answer? Final answer. Yes, come on. Come on, everybody. You are appearing for the upcoming exam. You should be able to solve such basic question of SFM. Basic question of Forex. Yes. Waiting for your reply. If the US dollar appreciates during the year by 3%, what is the return an Indian investor will get? Yes, reply please. 9 point something. 6% you are getting because of the capital gain and interest, and dollar is also appreciating, so you will get more rupee when the dollar appreciates, when you are converting dollar into rupees. So the answer will be something more than 9%, not just 9. So write down the answer. In that case, return will be 1.06 into 1.03, because this 3% appreciation will be applicable not only to the principal amount but also to interest and capital gain portion also. So the answer would be 9.18%. One Mr. Rishabh has got it right. You also got it right. Very good. What is your name? Ajinkya has also got it right. 9.18%. Now I am going to prove this in case if you are interested. Are you interested? So if you are interested, not required for the exam, but for learning. Otherwise, some students could have answered 9%, 6 plus 3. That is not right. Now let us say the exchange rate today is rupees 80 per dollar. So what will be exchange rate after 1 year? 80 plus dollar is appreciated by 3%. 82.40 rupees per dollar. What was the amount invested today? What was the amount invested today? $100 you have invested at the rate 80. So you have invested 8,000 rupees. And how much is the amount received after 1 year? You will receive $106 at the rate 82.4. So can you see this 2.4 extra is applicable to 6 also. So please multiply 106 into 82.4. 106 into 82.4. 8734.4. 8734.4. So 8734.4 minus 8000 divided by 8000 is equal to how much? Exactly, you are getting 9.18%. Exactly, you are getting 9.18%. The student who are interested can note down the proof. If you are not interested, go ahead. So very good Rishabh, very good Ajinkya. Let us go to the next question. Please reply now. Write down. If USD depreciates during the year by 3%. Reverse question. If USD depreciates during the year by 3%. Yes, come on, reply. Anybody wants to reply? Yes, please reply. Waiting for your answer. You are a student for the exam. You should be able to solve this kind of question. So this time you will just take reverse. Instead of taking 1 plus 0.03, you take here 1 minus 0.03. So the answer is approximately 2.82%. 2.82% is right. Very good. 2.82%. Sidana is right. 2.82. So dollar depreciation is not a good news for the investor in USA. Is it right? He gets lower return. As a patriotic person, you will say, yes, I am happy, dollar is depreciating, rupee is appreciating. But the investor who has invested in USA, he will feel sad. Okay. Next, Mehul is also right. Fourth number question. Let us see who will give the answer right. Indian rupee appreciates. Write down. Indian rupee appreciates during the year by 5%. Indian rupee appreciates during the year by 5%. Please reply the final answer. Yes, please reply the final answer. This time it is not dollar which is appreciating. It is rupee which is appreciating. It is rupee which is appreciating. Rupee is appreciating means dollar is depreciating. Rupee is appreciating means dollar is depreciating. Yes, I am waiting for the answer. Yes, come on student. I don't want 95% answer. I want final answer. One student saying 0.95%. Okay, let me check. 0.95%. One person has replied. I have to check. So you will write 1.06 is your return. Divide by, in this case you will divide by 1.05. When rupee is appreciating but the rate is given as rupees per dollar, you will have to divide by 1.05 and minus 1 so that you will get a lower return. As an investor, dollar is depreciating means we will get lower return. But the appreciation is given not in terms of dollar but in terms of rupees. Is it right? So you will get the answer as 0.952%. 0.952%. 0.952%. Garg has got it wrong. Sidana has got 0.95, but I am not sure whether you have done by this method or some other method. Now some students who are not satisfied, I will solve it by other method also. Is it right? Suppose you don't know whether you have to multiply or divide, then you can simply say spot rate, assume 80 rupees per dollar, which is equal to 1 by 80 dollar per rupee. Do you agree? Okay, 1 by 80 is how much? Just take on your calculator. Point something. 0.0125 dollar per rupee. So what will be the rate after 1 year, rate after 1 year, rate after 1 year will be 0.0125. No, rupee is appreciating, na? If rupee is appreciating, it will get more dollar. So plus 5%, because appreciation is given in rupee. Appreciation is given in rupee. So the answer is how much? 0.01312 $5 per rupee. Now this you can convert into rupees per dollar. Take 1 divide by 0.01312 76.19 rupee per dollar. Amount invested today. I am explaining the logic. Amount invested today will be $100 into 80 rupees 8,000. Amount received after 1 year will be 106 into 76.19. How much is that? Please reply. 106 into 80.14. So the return in percentage will be, take 8076.14 minus 8,000 and divide by 8,000 into 100. 0.95 1 something. That is, we have rounded off in 2 digits, 3 digits percent. It is matching with this answer. Suppose you don't have so much time in the exam, only write this much. Okay, in case if you are confused, then follow the long process. But you must get it right. You must get it right. Institute has given an answer which is wrong. Why it is wrong? They have said 5% rupee appreciation is equal to 5% dollar depreciation, which is not correct. 5% rupee appreciation is not equal to 5% dollar depreciation due to change in the base. This is called change in the base effect. 5% rupee appreciation is not equal to 5% dollar depreciation. So you have to solve in a different way. So Rishabh has also done in the same way and his answer was right. So now the last answer write down first and then we'll take queries. Will your answer differ if Mr. Mammon invests in the bond just before the interest payable? So write no. No. Our answer will not differ. Presentation is equally important. Our answer will not differ. Our answer will not differ if Mr. Mammon invest in bond just before the interest is payable. Just before the interest is payable, because he is going to get interest also, he is going to get capital gain also, and we will assume that the exchange rate will change as per the question. So this important question is over. Students normally make mistake in the fourth part and they don't understand the fifth question only. So out of 5 you may get 3 marks easily, but last 2 questions you have to practice. So now we'll go to next question number 2. Are you ready? Yes. Now see the importance of this question. You just mention in your notes, this was asked in November 16 exam for 5 marks. One student is asking whether X interest or some interest logic will apply in the previous example. Good question. The answer is question is silent. If you are going to receive interest, if you are going to receive interest, then my answer will not change. But if you are not going to receive the interest, answer will change. So we have to assume that the bond is purchased on cum interest basis. We have to assume that the bond is purchased on cum interest basis, so you will get the interest also. Anyway, you are going to get interest. Question number 2, very important question again, and if you have not practiced it before going to the exam, you can make a small mistake here. So this question, write down important. November 16 exam, May, November 22 RTP. Now just waiting for the next exam. Okay. On 3rd April 2016, a bank quotes the following. What is the date? 3rd April 16, and who has given this quotes? The bank. So first and second question are fundamental basic question on rate understanding, appreciation, depreciation understanding. Then we'll take advanced version. Spot rate for $1 US, 66.2525, this is buying rate. 67.5945, this is sell rate, ask rate. All of you know the higher rate is the ask rate and the lower rate is the buy rate, bid rate. Now understand, this is a very fundamental question. 2 months swap point is given. 2 months swap point means you have to find out the rate of exchange after 2 months, forward rate after 2 months, and they have given you 70-90. That means this 70-90 are premium or discount. I am asking you a question, kindly reply. If the swap points are given as 70-90, whether these are premium points or whether these are discount points. Premium. Why premium? Why premium? Because they are in ascending order. They are in ascending order. Very good. Yes. So if the number written points for ask rate is more than points for buying rate, the dollar is trading at a premium. Same thing applies here also. 3 month swap point is in ascending order, so dollar is at a premium. So in 30 days time, the premium has gone up by, in case of buying rate, in 30 days time, the premium has gone up by how many points? 90 points. And in case of ask rate, the premium has gone up by how many points? 96 points. The premium has gone by 96 points. Mehul is right, Preeti is right. Very good. I am happy that you have understood the basics. In a spot transaction, delivery is made after 2 days. Assume the spot date is 5th April. This is 3rd April plus 2 days, 5th April. Assume one swap point is 0.0001. So 70 swap points will be 0.0070, 0.0090. In fact, this the student should know, but institute is very kind. Okay, so they are helping you. They are helping you. So the swap points are actually 0.0070 and 0.0090 for the 2 months period. And same thing for 3 months period. You are required to ascertain swap points for 2 months and 15 days. Oh my God. You are given swap points for 2 months, 3 months, but they want you to find out the swap point for 2.5 months. So 2 months is already 70 and 90. In 30 days time, the swap point has increased by 90. So in 15 days time, it will be half. Similarly for this also half, 48. So the swap point for 2.5 months will be 115 and 138. If you know these basics, you can solve. Otherwise, you will not be able to solve and you may lose 5 marks. 5-mark questions are usually compulsory questions. Oh, you can't skip it also. Okay. And the next question is, determine the foreign exchange rate for June 2016. So I will take the spot rate. I will add the premium. I will get the exchange rate for June 20, 2016. Very good, Sidana. Compute the annual rate of premium or discount. Annual means you have to annualize. Your question is of 2.5 months, but you have to answer in per annum terms. Premium or discount. This is premium of US dollar on INR on an average rate. Underline average rate. Average rate means spot rate plus forward rate divided by 2. Is it right? So how much is the premium on average rate? So premium divided by average rate into 12 divided by 2.5. Why into 12 divided by 2.5? Because we have to annualize it. This much premium is for 2.5 months. So what is for 12 months? Okay. If you know the basic, this question 5 marks is in your pocket. So let us solve one by one, step by step to get full marks. Step number 1. First question is ascertain the swap points after 2 months and 15 days. Write down. Come on, step 1. Calculation of swap points. Calculation of swap points for 2 months and 15 days. Calculation of swap points for 2 months and 15 days. So under that write down, right hand side 2 columns, bid rate, ask rate. Any other presentation is also welcome if institute can understand your answer. So first you write down swap points for 2 months. Swap points for 2 months, question in front of you, third line, 70 points, 90 points. Then below write swap points for 3 months. I am explaining to you that in such problem you have to first find the difference and take proportionate change in the point. So 160, 186, both are given. Okay, now we will write swap points for 30 days. Swap points for 30 days. That is the B minus A. B minus A. The student told me B minus A. Wow. Amazing. Huh? Now you have also understood the presentation. 90 and 96. But we want the swap points only for 15 days, not for 30 days. So I will take C divided by 2. C divided by 2. Come on, student. Is it 45 points and 48 points? So I have to answer swap points for 2 months and 15 days. This is 2 months plus 15 days. Write down point number E. Swap points for 2 months and 15 days. Swap points for 2 months and 15 days. Is A plus B, 115 and 138. 115 and 138. 115 and 1 mark. You will get 1 mark. Okay, enjoy 1 mark. If you want 1 mark, this must be right. If that is right, then next answer will be right. Step 2. Step 2. Exchange rate. Forward exchange rate. Forward exchange rate on June 20, 2016. forward exchange rate on June 20, 2016. Right hand side again two columns. Bid rate, ask rate. Bid rate, ask rate. Bid rate, ask rate. First write down spot rate. Question in front of you, second line. Read the second line, you will find 66.2525. 67.5945. Then write down point B, add swap points. Why swap points is added? Because it is at premium. Ascending order means premium. So you will add 0.0115. 1 point is equal to 0.0001. So 115 points will be 0.0115. 0.0138. Now tell me the total. Do the total and write yourself. That will be your second answer for 2 marks. Yes, Rishabh has answered 66.2640. Very good. And 67.6083. Amazing. Wonderful. This is right. Now, step number 3. Calculation of annual rate of premium on average rate. Very easy. Premium we have already calculated. That premium amount we have already calculated. Average rate means spot rate plus forward rate. Because that is only possible average rate. Spot plus forward. Divide by 2. Again write down 2 columns. Heading write down first. Answer of part 3. 2 marks for this much effort. Calculation of annual rate of premium on an average rate. Underline the word average rate. In your exam they can give spot rate. So be careful with this wording. Bid rate, ask rate, 2 columns. First write down spot rate. Given in question, second line. Spot rate. Spot rate is 66.2525 and 67.5945. Then write down forward rate. Then write down forward rate. 66.2640, 67.6083. Now write down average rate. Average rate, because the question has asked average rate. Average rate will be A plus B by 2. On your calculator, A plus B divide by 2. 66.2583. Anybody for the next column? Ask rate. Ask rate. Ask rate. Ask rate is 67.6014. Very good. So this is my average. So this will be the base for calculating the premium in percentage. Very good. Now write down premium in bracket as calculated in step 2. As calculated in step 2. So that was 0.0115. Can you see that? 0.0138. 0.0138. So now you write down annualized premium percentage. Annualized premium percentage. So how do you get it? This is your premium. Divide by this. But that will give you premium for 2.5 months. Into 12 divide by 2.5. So I'll give you the formula for this if you want to write. D by C into 12.5 divided by 2.5 into 100. into 100. So that is 0.0833%. 0.0833% and 0.098% and 0.098%. Is the answer right? Everybody please reply yes or no. Is the answer right? Is my calculation right? 0.098. Yes, please reply. Is it right? Can we go to the next question if you agree? 5 marks. But the problem is many students don't know how to get the swap points when it is given between two dates. So you have to count the number of days, check how much is the difference and calculate proportionately. So now we'll go to another question number 3 from July 2021 exam. Write down important. This question has come in RTP, MTP also. I have not mentioned the date for RTP and MTP, but it was there. This question is based on early delivery of forward contract. This question is based on early delivery. First let us read and then we'll discuss, then we'll solve. Very important. Have you marked it important? Another question where the student needs pre-practice, because in the exam you can't handle it. First time if you are solving, there are rules of solving question of early delivery. The rules are given by a body in India called FEDI, Foreign Exchange Dealer Association of India. They regulate the foreign exchange market. Okay, to practice this question before you go to the exam. In fact, I will say practice all questions which I have given in this session, revision session for exam purpose. On 1st October, underline the date 2020. Mr. Guru, Hoja Shuru, Mr. Guru, an exporter. Again underline the word exporter, because your answer will change completely had it been importer. As a practice you can try it for importer, okay. As a homework you just change it to importer and your answer will change. Enters into a forward contract with the bank to sell. Underline, to sell means the exporter will sell dollar to the bank. If exporter will sell dollar to the bank, what will bank do? Bank will buy dollar from the exporter. Bank will buy dollar from the exporter. And what is the rate at which they have agreed? $1 lakh. The date forward contract will be executed 31st December. That means how many months? 3 months. And at what rate? 75.40. Very easy question. These are the important parameters I have to keep in mind. Then what happened? However, at the request of the importer, Guru has an importer in foreign country USA. That party importer, let us call him Mr. Biden. Okay, let us call him Mr. Biden. Mr. Biden, who is a customer of Guru, Mr. Guru received the amount on 30th November only. Such a nice customer. He paid, instead of 3 months, he paid in 2 months. Happy. Guru is happy that I received the payment 1 month before the due date. But the forward contract was taken for 3 months. So what he will do with that $1 lakh now? He will have to go to the bank and request the bank, sir, please accept this $1 lakh at forward rate. The bank will say, okay, I will accept, but whatever are the losses that I will suffer, you will have to compensate. Is it right? Are you willing to compensate? You say yes, yes. Then we are going to accept the early delivery. Is it right? So the question is how that gain or loss will be calculated by the bank, which Mr. Guru will have to pay to the bank. Right. Now you have understood the concept? Okay, one student is saying Guru is Modi ji. You are right. They cannot write the name directly. So Guru, Vishnu Guru. Okay. They should have written Vishnu Guru, self-declared Vishnu Guru. Now Mr. Guru requested the bank to take delivery of the remittance on 30th November 2020, that is before due date, 1 month before due date. 1 month before due date. The interbank rate means the rate at which one bank buys or sells to the other bank. That is called interbank rate. The rate at which banks deal with each other. So this bank will become a customer for the other bank. This bank will become a customer for the other bank. Okay, that is interbank rate. On 30th November 2020 was as follows. Spot rate 1 month forward premium 10.15. Ascending order means again premium. Anyway, they have written premium, so say thank you to the institute. Assume 365 days in a year. We need to do some interest calculation in this problem. That is why they mentioned about days. If bank agrees to take early delivery, then what will be the net inflow to Mr. Guru? This is my question. Sometimes students don't know what is the question. Question is what will be the net inflow to Mr. Guru? Net inflow to Mr. Guru will be 1. He is going to get 1 lakh US dollar multiplied by 75.40. But he has to pay some charges to the bank. So the answer is 1 lakh into 75.40 minus any charges which is going to be levied by the bank. Okay, so that will be the answer. Some student only write 1 lakh into 75.40. Then out of 8 marks you will get 0.25 marks, which will be rounded off to 0. Okay. Assume that the prevailing prime lending rate is 18% per annum. This will require interest calculation also, because the bank will have to execute the transaction 1 month before the due date. So there will be some net inflow and outflow to the bank. Bank will buy from the exporter and bank will sell in the spot market to another bank. Bank will not keep 1 lakh dollar. Banks are just intermediary. They buy, they sell. They don't stock foreign exchange. Of course they may be, but for our calculation purpose as per FEDI rule, the bank will sell at the spot rate to the interbank, and the difference between the rate at which it will buy and the rate at which it will sell. So there is an inflow and outflow. That inflow and outflow happened 1 month before the due date. On that, interest at 18% for 1 month will be paid. But we'll calculate in days, which will come to 30 or 31, we'll check. No problem. Plus there will be a swap charges also. Plus there will be a swap charge. What is swap charge? When Mr. Guru came on 1st October to sell dollar, simultaneously bank also enter into a forward sale contract with the interbank, because they banks know when Guru will sell dollar to me after 3 months, I will also sell to some interbank. Guru will sell after 3 months to bank. Bank also will sell it to interbank. Now bank has also entered into forward contract, that also needs to be cancelled. So that is why the bank will have to cancel the previous forward contract by entering into a 1 month forward contract, right? And because of that, if there is any loss to the bank, Guru will have to pay, right? So the question is, if this is one question which normally we teach in the classroom, but institute is also smart. They have added one more question. If Mr. Guru can deploy these funds in USD, if Guru can deploy these funds in USD, suppose Guru will tell the other party, Mr. Biden, don't send me money now. I will invest in USA only for 1 month. And after 1 month I will bring. Possible? Why to bring money 1 month in advance? You can keep it there in some bank and bring it after 3 months and convert at the forward rate that you have agreed. Okay? He gets a return of 3% per annum. But if he keeps money there, he will get interest also for 3 months. 1 month, you are right, 1 month. Which is better? Which is better means, should he receive the money today or should he receive the money after 3 months? Okay, so that is another good question they have added. Now, in order to understand such question, we will first make a summary of transactions which have happened in this problem, and we will look at the question from bank's point of view. Okay, right. Write down the question. I am going to present in a summarized format. What are the transactions that are happening, and from whose point of view? Bank's point of view. Okay, how will the bank look at all these transactions? Please write down. Write down the heading, summary of transactions, and you will find it very easy. This summary gives you a snapshot of all transactions, very easy for understanding. Institute's answer does not contain this summary. This you will write in the exam if you have time. If you don't have time, directly solve the answer. Are you ready? Yes. 3 columns we will draw. First column date, second column transaction entered by bank with the customer, and transaction entered by the bank with interbank. Okay, so write down date 1st October. 1st October, what is the transaction entered into by the bank with the customer? The bank has agreed to purchase $1 lakh. Exporter wants to sell. So bank wants to purchase. So write down, with customer, bank has entered into a forward purchase $1 lakh at 75.40 due on 31st December. So what bank has committed? Bank has committed to the customer that I will buy $1 lakh on 31st December at the rate 75.40. Now understand, if a bank enters into a forward contract with the customer, bank also enters into a forward contract with interbank, so that on maturity after 3 months, bank don't have any risk. Is it right? So what contract bank will enter into with the interbank? Forward sale. So bank will simply think like this: I will get $1 lakh from the customer after 3 months and I will sell it to the interbank. So usually the difference between these two rates become the profit of the bank. So that means without any effort, only you are doing as a middleman, buy from one party, sell it to another party and enjoy the difference. This rate is not given, so I have not written the rate, but the transactions will be covered like this. Date is wrong. You are right. So I am going to change the date. Sometime while making presentation, we also make mistake. We are also human being. We have not come from planet Jupiter. Okay. So it will enter into forward sale dollar 1 lakh due on 31st December. If everything would have gone as per the plan, then bank will buy from customer, sell it to the interbank, and the difference in the two rates will become profit to the bank. This rate is not given, not required also. Ask one query. One student wants to ask a query. Come on. No, that we will see on this date. Now, this rate is given on 30th November. On 1st October, interbank rates are not given. Not given, not required also. Rate on 1st October with interbank not given, not required also. That rate we don't require. That is not customer's job to find out at what rate you have entered into a contract with the interbank. You will come to my office and you will say, sir, I want to purchase this book. I will also purchase from somebody and sell it to you. Are you interested in knowing at what rate I have purchased? No. And customer is not responsible also. That is your business. How do you arrange your transaction is your business. Okay. Come on, next. Let us move fast now. On 30th November, customer comes to the bank and requests, sir, please take $1 lakh. The bank will say, okay, come on, I will take $1 lakh at the agreed rate 75.40. Bank will purchase at the same rate. Don't worry, write down. But what will bank do with this dollar? First, you listen to me. First, let me complete the whole story. Bank will purchase $1 lakh at the contractual rate from the customer. As I have told you, all these calculations are done as per FEDI rule. Okay, so some doubts you may have, but forget it right now. And this is correct also, logically. Customer will sell dollar at agreed rate. But then what bank will do with this dollar now? It will sell in the spot market. Bank will sell in the spot market. Now do not ask query what if bank does not sell. All those are hypothetical questions. For calculation of charges to be levied on the bank, I will take spot rate. Okay, which spot rate will you take now? That is another query. This bank will sell. Interbank rate will buy. Interbank will buy. Now this bank is like a customer to the interbank. Yes. So the interbank will buy. So we'll apply the lower rate. The lower rate is 75.22. Here again scope of accident is there. Somebody can take 75.27. Okay. We have to take the rate quoted by interbank. But this contract which the bank had entered into will remain open. Will remain open. So that contract also has to be cancelled now. Now this customer will not come on 31st December. He has already closed his transaction. So I need to cancel it. How do I cancel it? I will enter into a reverse contract with interbank. To cancel the forward sale contract, I will enter into a forward purchase contract. Write down point number E. Forward purchase $1 lakh. At what rate we will take? Now this bank is like a customer to the interbank. It will purchase, but interbank will sell. So you have to apply the selling rate, ask rate. Now the student is asking, how did you get 75.42? So in case if you are interested, you can write 75.27 and margin is 0.15. Is it right? Not Google it. These two contracts are reverse. If you enter into a forward purchase, how do I nullify it? By entering into a forward sale, reverse, so that after 3 months I don't have any risk now. On 31st December, I will purchase $1 lakh and I will sell $1 lakh. So I don't have the risk on 31st December. This is how the banks manage their foreign exchange risk. Is it right? They will not keep the exposure open, because then anything can happen after 1 month. After 1 month, Russia can be defeated by Ukraine. Okay, Germany can also join the war. So this is my presentation, and one more line right on 31st December. 31st December, what will happen? Customer transactions are complete, but with interbank I will purchase $1 lakh under contract E and I will sell $1 lakh under contract B. So with this my entire transactions will get complete. It seems from the face of a student in the classroom he has not studied this chapter before. You studied. This portion is very complicated. You are right. I am also sometimes confused. And I am assuming many other students will also be getting confused in this. It takes time to think, and thinking is one of the most difficult tasks on this planet Earth. And in exam time it is even more difficult. You are right. So now what I'll do, I'll just give you an explanation and then we'll solve. Customer comes on 30th November. Bank purchase dollar. So this is outflow of cash. And bank sales. This is inflow. So the difference between C and D is the net cash flow, actual cash flow happening here. And if it is outflow, interest will be charged at the rate of 18%. If it is inflow, bank will pay interest to the customer for 31 days. Okay. So one thing we have to compute is the interest. Interest will be on actual inflow and outflow. And because the customer comes to the bank for early delivery, the bank has to enter into these two extra contracts. So the difference between these two rates is called swap difference. It's called swap difference. Swap difference is between point number D and point number E. Because the customer comes to the bank for early delivery, bank had to sell at this rate and bank had to purchase at this rate. Bank had to purchase at a higher rate than the rate at which it sold. So swap charges will be levied upon the customer because the bank suffered loss due to early delivery. Interest charges will be levied upon the customer because there was a net outflow of the bank 1 month before the due date. So these are the two charges the bank is going to levy on the customer. Right. Step number 1, calculation of interest. Calculation of interest. Mehul is saying very complicated question. Yes. But if you practice 2-3 times, then you will get it. There are a lot of rates given in the problem, and that is the reason for confusion. Which rate should be used when? Which rate will be used for interest? Which rate will be used for swap charges? So the two inflows and outflows are understandable. That is interest. And the two contracts which bank had entered into extra is the swap loss or gain. Okay, that's it. Let us go to the calculation part. Please write down calculation of interest. Right hand side rupees. Right hand side rupees. First point A, outflow of fund. Bank will purchase $1 lakh from the customer at 75.40. But the same dollar will be sold to interbank at 75.22. So inflow. Please write inflow. 1 lakh into 75.22. 1 lakh into 75.22. 75 lakh 22,000. So is there net inflow or net outflow? Net outflow. Very good. Net outflow, write down 18,000. Net outflow is 18,000. Now write down point number D. Interest at the rate 18%. So number of days will be 31. In December we have 31 days. Customer comes on 30th November. So from 30th November to 31st December you have 31 days. Don't include both days. Only include 31st December. So tell me the interest. I am waiting for the students to give me interest. Interest, anybody interest? 275.18. 275.18. Now write down step 2. Calculation of swap gain or swap loss. Calculation of swap gain or swap loss. Swap gain or loss means the bank had to sell today and buy 1 month forward. Sell today and buy 1 month forward because of customer request to go for early delivery. So the difference between those two rates will be gain or loss to the bank. Yes, very good Mehul, you are right. So write down, look at your table. In your table, point number D and E. Point number D and E. In the table, point number D and E. Bank purchases dollar. Bank purchases dollar at rupees 75.42. And bank sells dollar at what rate? 75.22. Just understand now, purchase rate is more than sale rate. In order to help the customer, the bank had to take the loss, take the hit. How much? 75.42 minus 75.22 per dollar, 0.20 per dollar. So total loss on $1 lakh. Come on, total loss on $1 lakh is 20,000. Is right, rupees 20,000. This will also be recovered from the customer because it is interest to be levied upon the customer. This is also to be recovered from the customer because of swap loss. So the total charges the bank will levy upon the customer will be 20,275.18. 20,275.18. Write down one small working for that also. Total charges. Total charges. Please practice again and again. You will get it. Total charges, right hand side rupees. Point number A, interest. Point number A, interest. How much is interest? 275.18. Very good. Point number B, swap loss. Swap loss. How much is that? 20,000. Point C, total 20,275.18. So this is your charges, and the last answer is net amount payable to the customer. How much net amount bank will pay to the customer So as we discussed, bank has to pay to customer contractual rate 75.40 into 1 lakh minus, come on, the charges. That was your question. Okay, right. Gross amount, come on everybody. Gross amount 75 lakh 40,000. Gross amount 75 lakh 40,000 less total charges as calculated in step 3, 20,275.18. So the answer is A minus B, net amount. Point number C, net. A minus B. One student has already replied. Very good. 7519724.82. Presentation is also important. 8-mark question. 4 steps you will write, and the examiner will keep writing 2 marks. 8 marks total. हाँ जी. 18,000 is not the charges to be levied. On 18,000 interest will be charged. The bank, that is not a loss to the bank. The loss to the bank is the swap loss. Because of the early delivery, how much additional amount the bank has to pay. Is it right? Because they are selling and they are buying also, na? So the difference between the two is the loss to the bank. They are selling and they are also buying in forward market for 1 month. That difference is the loss to the bank. On 18,000 only interest will be calculated because there is an outflow 1 month before the due date. Okay. That is a good question. Many students have asked that question in the past. Now this question has one more additional feature. Third part of the question, which normally they don't ask, but this time they had asked. If Guru can deploy these funds in USD, he gets return at the rate of 3% per annum. Which is a better option and why? So write down, if Guru deploys these funds in US dollar, if Mr. Guru deploys these funds in US dollar, then inflow will be, so he will take $1 lakh from the customer and he will invest in USA for 1 month, on which he will get interest at the rate of 3%. So write down first point number A. Point number A, write down receipt of US dollar on 30th November. This is clear. The customer will give him $1 lakh, but he will not bring it into India. He will invest in USA. So on that he will get interest for 1 month. Because we have to compute in days, I will take 31 by 365. Add interest for 31 days. Take on your calculator 1 lakh into 3% into 31 by 365. Yes, 254.79 or 80 is right. So what is the US dollar available on 31st December? US dollar available on 31st December. A plus B. 1 lakh 254.79. $1,254.79. Now write down point D. Now wait, this time there is a small area of mistake. This entire dollar will be converted into rupees at what rate? For $1 lakh you have entered into a forward contract. So 1 lakh you will multiply by 75.40, but this is extra 254.79. What about this 254.79? Which rate you will apply? So you will have to see on 30th November you will enter into one more forward contract for 1 month. 1 month, not 3 months. 1 month. So which rate you will apply? Buying rate or selling rate? Again you are going to bring the money. So you will sell 75.22 plus the premium on that 0.10. So this will be converted at 75.32. Is it right? So what students do, they multiply the entire amount by 75.40. Another mistake, they don't take 75.32, they take some other figure only. And then you will lose 2 marks. So I will have to apply 2 separate rates for principal and interest. There is no note required. Because there is no choice, na. There is no need to write a note. A smart person will enter into forward contract only. And based on the information available, that is the only possible rate we can use. So write down. First write down sale of US dollar 1 lakh to the bank. Sell US dollar 1 lakh to the bank as per agreed rate. As per agreed rate. For 1 lakh dollar we have entered into forward contract at 75.40. 75 lakh 40,000. And then you write down sell US dollar 254.79. This interest part. How did we calculate that? 75.22 plus 0.10 premium. So we have to use this rate only. Spot rate for 31st December is not given. So the only way to reach that rate is this rate only. Spot rate for 31st December is not given. So we have to take the forward rate for 1 month. Add these two figures. So write down the inflow is equal to, amount of inflow equal to, very good, come on. Add D plus E. Add D plus E. 7559190.78. Now the question is, which is better and why? Here the amount is 7559190. What was the answer earlier? This is higher. So write down advice. Since cash inflow will be higher, in deployment of funds, option comma, the same would be chosen. The same would be chosen. The same would be chosen. The same should be chosen. But this question has a small mistake. In India, he will get the fund after 2 months. These funds you are getting after 3 months. So comparison is not proper. We should have been given at what rate in India you can invest that money also. Is it right? For 1 month. You have to also consider the interest opportunity for 1 month in the first option if you invest in India, but that is not given to us. Is it right? So whatever is given, based on that, this is the answer. So write down assumption. It is assumed that it is assumed that there is no opportunity cost of funds received in India under first option. It is assumed that there is no opportunity cost of funds received in India under the first option, because comparison is happening between cash flow at the end of 2 months and at the end of 3 months. So 1 month gap is there between the two figures, right? So that was a question on early delivery. Not complicated. What is complicated you will see now. The genuine meaning of the word complicated is question number 4. The source is MTP October 2021. Write down, very important, because this question is based on an amendment which has happened in FEDI rules. Okay, amendment in FEDI rules. So that is why the institute have given this question. So first you read the problem yourself. Read the problem. I will come in 1 minute. Read slowly, silently. There is some typing mistake here, so please rectify. In your notes probably you will find March, April, May, June is written, but actually it is April, May, June, July. So just rectify it. I'll come in 1 minute. Read the problem, try to solve. Okay, welcome back. This is a question on automatic cancellation, right? Z has to remit US dollar 1 lakh for her daughter's education. Wow, such a caring father. For her daughter's education on 4th April 2021. He wants to remit funds on 4th April. Underline 4th April. This is the maturity date of the forward contract. Right? Accordingly, she has booked a forward contract. Instead of she, it should be he. He has booked a forward contract with his bank on 4th January 2021 at the rate 73.8775. So this is my original contracted rate with the bank. Okay. So bank will sell to Mr. Z, and what bank has done, the bank, from where will bank get $1 lakh? The bank has to also purchase from interbank. So bank has covered its position in the market at rupees 73.7575. Understood? So the logic is that this is how banks operate. After you will qualify, you will also join a bank, and suppose you join the treasury of the bank. This is what you do: buy from interbank at this rate 73.7575, sell to the customer at 73.8775. So the bank was enjoying the profit of the difference. That is what they do when the customer books a forward contract. If they have to buy from the customer, they'll buy at a lower rate than the interbank. If they have to sell to the customer, they will sell it at a higher rate to the customer. You're right. The exchange rate for US dollar in the interbank market, interbank underline means one bank is quoting to another bank on 4th, 7th and 14th April 2021 are. All rates are not relevant in solving the problem. Okay, only some rates are relevant, and that is where your intelligence will be tested in full public view. Is it right? The whole world will watch your intelligence today. So these are the spot rates on various dates. Then this is the spot rate. April means for April end, because you will say, sir, we are already in April. So this is for the April end. If you want to enter into a forward contract, if in your book March is printed, you have to make it April, because March is not relevant in our answer at all. Is it right? And then May, June, July. So these are the forward rates basically. These are the forward rates. So you have to choose the right forward rate for solving the problem out of so many. We will see one by one. First read the problem. Lot of adjustments are involved. Then it says exchange margin of, one more concept they have added, exchange margin of 0.10%. What is the meaning of exchange margin? Anybody? When bank sells to customer, the interbank rate plus exchange margin, because that is the profit of the bank. Bank is like a, you can say, retailer, okay. Interbank is like a wholesaler and the customer. So what the retailers do, they buy from wholesaler, they add their margin and they sell it to the customer. So here this bank will purchase dollar from interbank and sell to the customer by adding 0.10%. That is, the FEDI has given a range. Within that range, you can charge the extra amount to the bank. And suppose because of the customer there is an outflow of fund, there is an outflow of fund to the bank is going to charge you interest at the rate of 12%. In earlier problem it was 18%. Next is the remitter. Remitter means whom? Z, Mr. Z. Remitter means Mr. Z. Due to rescheduling of the semester, oh my god, due to rescheduling of semester, has requested on 14th April. When did this fellow come? He should have come on 4th April. Is it right? He should have come on 4th April. But he comes on 14th April. But he comes on 14th April. Such a lazy fellow. Okay. For extension of the contract with due date 14 June 2021. So now he wants the contract should be extended to 14 June because the semester got rescheduled. Now the problem is, these are the 6 questions and the institute will give you 10 marks. 1.5 marks for each question, 9 marks, 1 mark for good handwriting. Okay. That is how they can do. Cancellation rate you have to find, at what rate the contract will be cancelled. Then amount payable on $1 lakh, swap loss, interest on outflow of fund if any. If there is an outflow, bank will charge interest. What will be the new contract rate? So the new contract rate will be the forward rate to be taken on 14th April for 14 June. Forward contract to be executed on 14th April for 14 June maturity. New contract rate and total cost. Total cost means one is your cancellation charges, swap charges and interest charges. So the total of these 3 will be total cost. Is it right? Now one more instruction, rates must be rounded up to 4 decimal places. Means your answer will have 4 digits after decimal and in multiples of 0.0025. Means the last 2 digits will be either 25 or 50 or 75 or 00. Last 2 digits will be in multiple of 25. So you have to round off to the nearest 25 or 50 or 75 or 100. This is how the banks actually operate. Okay. And for interest calculation, we will require it. For interest calculation, take 365 days in a year. So this is a question on automatic cancellation. This is a question on automatic cancellation. Write down. This is a question on automatic cancellation. Since the customer does not turn up on 4th April, bank will wait for 3 days. Bank will wait for how many days? 3 days. That is why 7th April dates are given. Because you are wondering why to 7th April doing here. 7th April bank will wait for 3 days as per the new FEDI rules. And if it does not turn up till 7th April, the bank will cancel the old contract automatically. That is why it is called automatic cancellation. Is it right? If you don't turn up, how much will I wait? I am not a Majnu, I will wait for infinity period for my Laila. I am a bank, you are a customer. Okay. I hope you liked the joke. So write down summary of transaction. Summary of transaction in bracket from bank's point of view. From bank's point of view. So for few minutes you assume you are a bank what are the transactions you will have to enter into. So first write down 3 columns. First column date, second column transaction with customer, and third column transaction with interbank. Okay. 4th January the customer comes to the bank, which is printed in the first paragraph also, for daughter's education, and the contract is for 3 months. So with customer the bank enters into a forward sale contract. Yes or no? Yes, right, forward sale. Then write down $1 lakh, that is quantity. Then write down the rate at which contract was entered, at 73.8775. Then write down due on 4th April. Due on 4th April. Are you understanding? If this question comes in the exam, only if you have done practice before going to the exam, you will be able to solve. Otherwise, just ignore it. Then write down with interbank. Even this is printed in the first 2-3 lines. Forward purchase. This is how banks operate. Tomorrow you will pass and you will also do the same thing. Then you will remember me. Okay. Sale contract with customer, purchase contract with interbank. So what is the logic? Suppose everything goes according to the plan, they will buy at this rate, sell at this rate, whatever is the difference becomes the profit of the bank. And this way they earn lot of profit on such transactions, because every day thousands of customer come. This amount is 1 lakh only. Some customer come with 1 million, 10 million requirement also. Okay. Point number, next write down 4th April. 4th April was the due date. The customer should have come, but he has not come. So there is a default. But what about interbank? I can't default. I am a bank. My reputation is at a stake. Yes or no? You are a student. If you don't come on time, it's okay. If you are absent also sometime, it's okay. But what about me? I have to come on time. I have to come every day, because my reputation is at a stake. So I will have to honor my contract with the bank. So what is my contract with the bank? That interbank. My contract with interbank is that I will purchase $1 lakh on 4th April at 73.7575. So I will take delivery. But then what will I do with this dollar? My customer has not turned up. So I will sell that dollar in the spot market today. I'll sell that dollar in the spot market today. But at the same time, we hope that the customer might come tomorrow or day after tomorrow or after some other day. So I will enter into a forward purchase contract. That is how they do the calculation. Okay. So I will assume that the customer will come in the near future. So I will take the nearest forward contract, which is April, and I will enter into a forward purchase contract, so that if the customer comes tomorrow, day after tomorrow, I can give him the dollar. Is it right? Whenever he comes. But that is how the calculations are done. Right. Point number C, write down. Point number C, write down. This is my contract with interbank. I have committed to purchase, so I will purchase. Take delivery under contract B. Take delivery under contract B. I have committed with interbank to purchase $1 lakh. On 4th April, I will do it. But I will sell it also in the market immediately, because the customer has not turned up. So look at the table, 4th April column, 4th April spot rate. Can you see 4th April spot rate? I'll just go to the question to make you understand. We are on 4th April. Remember, 4th April. The bank has to sell $1 lakh in the interbank market. This bank will be like a customer for the interbank. So they want to sell, the interbank would buy. They want to sell, interbank would buy. So which rate will be applied? Yes, the lower rate, 73.2775 on 4th April. So come back. I hope now you understood why 73.2775 is written. Right. But as per FEDI, the customer has not yet come and the contract is not yet cancelled. So I will keep myself ready for a possibility that customer may come afterwards and ask for dollar. So I will enter into forward purchase due April. So I will take some nearest forward contract. Nearest forward contract is April only. Forward purchase due April. Now what is the purchase rate? If I want to purchase on 4th April, forward contract maturing in April only, I want to purchase, interbank wants to sell. So I will take the selling rate of April forward. Second line of the table, first column. In case if you are not understood, I have to go behind. This rate I have to take, April. Bank will enter into forward purchase contract with interbank. If this bank is purchasing, the interbank will be selling. So I will take higher rate. Okay. Now comes to 7th April. Customer has still not come up, not turned up. So I will cancel this contract. I will cancel the contract with the customer. At what rate it will be cancelled? It will be cancelled at the rate on 7th April. Is it right? So write down cancel contract A. Cancel contract A. A means contract number A. I hope you are writing number also. A, B, C, D, E, F. Cancel contract A at 73.1575. At 73.1575. At 73.1575. But when you enter into a contract with the customer, you will have to adjust the exchange margin also. You have to adjust the exchange margin. So when buying rate is to be used, margin is deducted. When selling rate is used, margin is added. So I will cancel at 73.1575 minus 0.10%. Now your question will be why we have taken 73.1575. Look at the 7th April column in your book. First line, spot rate on 7th April. There are two rates given, 73.1575 and 73.1975. Mr. Z, understand on the screen left side. Now this is the most trickier part. Which rate I will use? The buying or the selling? You are Mr. Z. What was your original position? To buy dollar from the bank, $1 lakh. So Mr. Z will have to take opposite position. Mr. Z will have to take opposite position to cancel. So Mr. Z will have to sell dollar, correct? If Mr. Z has contracted to buy, the contract he will have to enter into is to sell. Buy will be cancelled by sell. Buy will be cancelled by sell. I have not written in bank now, I have written outside the bank. The answer will be same, whichever way you understand, but this is easier. You are Mr. Z, you have entered into a contract to buy. So what rate bank would have applied at that time? Sell rate. Now Mr. Z wants to cancel. So what rate bank would apply now? Reverse, buying rate. So it will apply buy rate. That is the logic. Customer wants to sell means bank wants to buy. Buying rate will be applied. Or look at it from this point of view. When bank sold to the customer, it applied selling rate. When it has to be cancelled, buying rate. So buying rate. I think that is easy. Okay. Bank sold to the customer by applying selling rate. So bank will cancel it by applying buying rate. Okay. So first buying rate logic is clear. Now you are not given a rate between bank and the customer. You are given interbank rate. So that is why bank will give lower amount to the customer when it is buying from the customer. It will give lower rate than what interbank is giving it to the bank. Okay, so minus. When bank will sell, it will apply plus. But when bank is buying, it will apply minus. Okay. Now let us say this is a retailer. Now this basic thing you should know. In revision batches, this should not be asked. This is the customer and this is wholesaler. If customer sells to retailer and retailer has to sell to wholesaler, if wholesaler buys at 100 rupees, at what rate you will buy from the customer? 100 or less than 100? Suppose you go and sell your book to a bookseller. Bookseller will sell to somebody else. So the middleman will always buy at a lower rate, so minus, and sell it to the other party at a higher rate. So what we teach in our basic lectures of Forex, when you are computing buying rate, margin will be deducted from the interbank buying rate, and when you are selling to the customer, margin will be added to the customer. So if you are applying buying rate, deduct margin. Okay. Now come to 14th April. हाँ जी. There is no confusion. हाँ. हाँ.
I got that because पहले हम लोग sell का contract था.
First you have sold, so buy.
But जो rate दिए वो interbank पे थे.
So that is why the margin is adjusted, na? The rates are given interbank. So whenever you are entering into a contract with the customer, the margin will be adjusted. But when you are entering into a contract with interbank, then margin is not adjusted. Okay, now write down 14th April. Write down 14th April. Bank always have an upper hand. You are right. 14th April, now this father of this girl comes and says, now I want to enter into a fresh contract. So this is like entering into a fresh contract. Forward sale due 14 June at 73 point. Can you go to 14th April column? In 14th April column, fourth line, which is June, sell rate 73.7050. 14th April, last column, fourth line, 7050. Can you see that? Fourth line, ask rate and plus margin. Plus margin. Because now you will say, sir, why plus margin? Answer is, when I am taking interbank selling rate, I will add margin and sell it to the customer. Okay. Now, okay. Now let us see the calculation. How do we do the calculation? I'll explain on this table first and then we'll solve. I have not seen any book who is explaining properly the answer why something is done like this. They just simply take this rate, this rate, this rate and do the calculation. So first you understand, on 4th April, there are two inflows and outflows happening. Here you are purchasing at this rate, so there is an outflow. And here you are selling the same thing, so there is an inflow. These two are real transactions where inflows and outflows are taking place. Am I right? So the difference between these two is net inflow or net outflow. If it is net outflow, interest at 12% will be charged. Interest at 12% will be charged. Okay. Now come to these two rates, which are written in red font purposefully. This is swap. Because of the customer's default, bank had to sell and bank had to purchase. The difference between these two rates is swap gain or loss. The difference between the rate at which bank had to sell and the bank had to purchase because the customer defaulted is swap gain or loss. Okay. And this rate versus this rate is the cancellation rate, and that is cancellation charge, which is our first question. Is it right? This is cancellation. This 2 in red font is swap, and the C versus D will be required for interest calculation. Perfect. If somebody can explain it to you like this, you can always solve. But of course, you will have to also think and spend time on this. Okay. It is not a magic that you will understand in one go. But if you also put efforts, the efforts which we as a teachers put, you will understand. And it takes time to explain. Okay. Even though it is a revision batch, but still I want that you must understand. I am expecting this question now in the exam. First question 1 is cancellation rate. Cancellation will happen after 3 days if the customer does not come within 3 days from the due date. Suppose you don't have time in the exam, don't draw the table, summary table. But summary table is everything. Write down. Now write down little fast. Rupees per dollar, market buying rate. Rupees per dollar, market buying rate. Rupees per dollar, market buying rate. The applicable rate is spot rate on 7th April. But because you are using buying rate, you have to deduct margin. Less margin at the rate 0.10%. Less margin at the rate 0.10%. Very good. Come on. 0.0732. You can just round off in 4 digits because the problem says in the last paragraph, rates must be rounded to 4 decimal places. Last line of the question. So therefore the cancellation rate will be 73.0843. Check. But one more instruction in the last paragraph. It should be in multiples of. It should be in multiples of 0.25. So we have to round off in multiples of 0.25. So 0.43 is near to which number? Is it near to 25 or near to 50? Near to 50 because the gap is 7 points only. With 25 the gap is 18 points. So I will round off to 73.0850. Okay. 2 marks or 1 marks or 1.5 marks. So please note down. I have to move fast now. Everything has been explained. You can watch the video again. 73.0850. Step 2, write amount payable on $1 lakh. Amount payable on $1 lakh. Amount payable on $1 lakh. So you have already computed the cancellation rate. So initially the bank had entered into a contract to sell dollar at 73.8775. 73.8775. So the amount comes to 73,87,750. Bank buys at 73.0850. 73,08,500. So the amount payable by the customer is 79250. This is your second answer. 1.5 marks for this much effort. But for that, this rate you must have found out properly. Is it right? When you will appear for some banking company interviews, suppose after you qualify you go to some bank, then you have to prepare this chapter because they can ask you question on this in interview. Now I will go back to the question to answer the third part, swap loss. Swap loss. The bank had to enter into a sell transaction at this rate and bank had to enter into a purchase transaction at this rate on 4th April. The difference between these two rates is the swap gain or loss. In your table, it is point number, I think E and F. Just check E and F. In interbank A, B, C, D, E, F in the table, summary of transaction table. Yes or no? D and E. D and E. Okay, sell spot. Yes, sell, D and E. Sell. Swap loss, write down. Bank sells to the market 73.2775. Bank buys from the market at 73.4275. Take the nearest month. Take the nearest month. Be hopeful. Take the nearest month and then write down swap loss per dollar. Swap loss per dollar. Swap loss per dollar. Because of the default of the customer, bank had to buy at a higher rate. Bank had to buy at a higher rate. Bank had to buy at a higher rate. So what is the total swap loss for $1 lakh? Total swap loss for $1 lakh will be 1 lakh into 0.1500, 15,000 rupees. 15,000 rupees. Now I'll go back to the question again. What is your next question? Interest on the outflow of fund. Is it right? So now you see, bank has to enter into two transactions on 4th April, which will result into net inflow or outflow. It is purchasing from interbank at the contracted rate 73.7575, the highlighted figure, and it has to sell in the interbank market today at 73.2775, which is also printed in your book. So that difference will, C and D difference will result into 12% interest on the differential amount. 12% interest on the differential amount. Write down step 4. Interest on the outflow of fund. Interest on the outflow of fund, right hand side amount. Right hand side amount, bank buys at what rate? As per the contracted rate, 73.7575. Bank sales at 73.2775. So is the outflow, or is it outflow or inflow? Outflow, because you are buying at a higher rate, so there is more cash outflow. Outflow per dollar. Outflow per dollar. A minus B. Outflow per dollar, come on, 0.4800. Outflow for $1 lakh. Outflow for $1 lakh. You have to multiply now. So you have 48,000. Now this is not to be recovered from the customer. Interest on that will be recovered from the customer at 12% for 3 days. At 12% for 3 days till the cancellation date. Till cancellation date. Because on 7 the contract will be cancelled. Round off the amount, 47, round off, no problem. Is it 47? Make it 47. So this is how interest is calculated. And come back to your next question, what is the new contract rate? The customer comes on 14th April. The customer comes on 14th April. He wants to take a forward contract for 14th June. Sorry. The bank would sell dollar to the customer. Yes or no? So higher rate. Plus 0.10% margin also, because you are selling to the customer. So you will have to apply 0.10% margin. So I will take this rate. You can also tick mark in your book, and you have to add 0.10% rounded off to 0.25. Rounded off to 0.0025. So write down new contract rate. The new contract rate, step 5. The new contract will be executed at current rate. So whatever on 14th April the rates are available, those rates will be considered now. It is like a new contract. It is like a fresh contract now. It is like fresh contract. Right hand side amount, rupees per dollar. Write down rupees per dollar market forward rate for June. 73.7050. Whenever a customer wants to buy dollar, banks apply selling rate, higher rate. But because the rates are with interbank, we have to sell to the customer. Bank will add exchange margin, profit margin at 0.10%. 0.0737. .0737, is it right? So new contract rate will be 73.7787. Rounded off to, now this 0.87 Is it closer to 75 or is it closer to 100? Very close. With 75 the gap is 12, with 100 gap is 13. So maybe you can take it 7775 also. Okay. So rounded up to, you can write 74.7775, because if I am taking 87, 75 is closer. 74.7775. Yes. Last question. Total cost. Total cost will be sum of three figures: cancellation charge, interest and swap loss. Cancellation charge, which is answer in point number 2, swap loss answer in point 3, and interest answer in point 4. Write down. Write down cancellation charges. Cancellation charges 79,250. Swap loss 15,000. Interest step 4 47. The student is asking previous answer should be 73.7800. Just let me check. Just let me check. The student is saying it should be 73.7800. I said 73.7775. So we have to round off to the nearest 25. If I take 75, the gap is 12 points. If I take 800, the gap is 13 points. So the nearest will be 75. We have to take the nearest figure. Okay. So the answer is 73.7775. Okay, come back to this question. Interest is 47. Therefore, total charges 94,297. 94,297. This is very good question for exam purpose. This is called complication. Okay. Previous one was a small kid in front of this. Okay, Preeti, is it right? Now we'll go to one more wonderful question. 5. One more question for today. Are you ready? Say yes. If we solve this question today, then tomorrow we can complete the remaining question. So our revision session will get over by tomorrow, but then I need to complete this question today. Okay. So last question for today, question number 5. It is 8-mark question. July 21 exam. XP Pharma Limited has acquired an export order, underline export order, underline, for rupees 10 million. Amount is 10 million for formulation to a European company. The company has also planned to import, underline import, bulk drugs worth 5 million from a company in UK. The proceeds of the export will be realized in 3 months. So export realization is after 3 months and the payments for imports will be due after 6 months. 3 months export, 6 months import. These are two different questions. The invoicing of these exports and imports can be done in any currency. That is, 3 options are there: dollar, euro, pound, at the company's choice. So what do you do? Please reply. If you are exporter, you will choose the option which gives you rupee inflow maximum, and if you are importer, you will choose that option which will result into rupee outflow minimum. Understood? Say yes. Yes. Advise XP Pharma Limited about invoicing in which currency? Calculation should be up to 3 decimal places. You are given spot rate. In order to calculate the forward rate, they have not given you forward rate, but they have given you annualized premium. Annualized premium percentage per annum is given. For export, you have to take 3 months, 3 by 12 of this, and for import, 6 by 12 of this. You will add in spot rate, you will get forward rate, and then using forward rate, compute the rupee outflow or rupee inflow. For exporter, choose the highest of the 3. For the importer, choose the lowest of the 3. This is one of the easiest question for 8 marks, but you have to do it very carefully. Step number 1. Decision relating to currency in which export should be invoiced. In which export should be invoiced. Right hand side 3 columns. Right hand side 3 columns. Dollar, euro and pound. Dollar, euro and pound. Okay. So first you write down export proceed in rupees. What is the rupee value of this export order? Rupee value of the export order is 10 million, which is equal to 1 crore. So write down 1 crore 3 times. 1 crore 3 times. Now the next important thing is which rate you will take for exporter. Spot buying rate or spot selling rate. Exporter will bring foreign currency. Bank will buy foreign currency from the exporter and give Indian rupee. Correct? Which rate will be applying? The lower rate or the higher rate? Customer will sell dollar to the bank. Bank will buy dollar. Which rate? Lower rate. Very good. So lower rate means buying rate. So the buying rate is for dollar 67.10, buying rate for euro 63.15, and buying rate for pound is 88.65. Next line. So invoice amount at spot rate. So we have to convert the invoice in respective currency. A divided by B. Yes, Preeti is right. You have to take bid rate. Very good, Preeti. Wonderful. And now you tell me what is the invoicing to be done in dollar. 149,031.297. You can take up to 3 digits. They have written in the problem last line. Divide 1 crore by 63.15. How much? Euro 158,353.127. Check the calculation. Tell me the answer for pound. Yes, Preeti, answer for pound. What should be the invoice amount in pound? Take on your calculator. Now, why are you confused? 1 crore divided by 88.65. You thought you have to multiply? That day is 1 million year away when you'll have to multiply to get the answer in dollar. Okay, we are still 1 million year away from that date when your dream will be realized, that you'll have to multiply. For that time being, we have to divide only. Okay, now the important task is exchange rate after 3 months. Exchange rate after 3 months. You are given spot rate, you are given annualized premium, but I have to add premium only for 3 months. Is it right? So I will take 67.10 into 1 plus 0.07 divided by 4 will give you the factor for 3 months. 67.10 into 1 plus 0.07 by 4, that will give you the premium for 3 months. 68.27 rupees per dollar. Next, euros, do the same thing. 63.15 into bracket 1 plus 0.06 divided by 4. 64.10 rupees per euro. Now who will give me the answer for pound? What is the expected forward rate for pound? Expected forward rate for pound, yes, come on, 88.65 plus into bracket 1 plus 0.05 by 4. Is it 89.76? After 3 months you will receive foreign currency, and these are the rates after 3 months. Now you multiply. Now you fulfill your dream of multiplying. So write down amount received after 3 months in rupees. Amount received after 3 months in rupees. Come on, student. You multiply C into D. Multiply column number C, line number C into line number D. These two you multiply. 101,74367, correct? Now next column, this into this. Give me the answer. Yes, come on. What is the answer? 101,50435. You can round up. These are big numbers. Points will not make any difference. Anybody last answer? Anybody last answer? 101,25211. Very good. Which is the highest figure? Dollar is higher. Can you see dollar is higher? Dollar has 74,367 here. So write down advice. Because you are exporter, take higher of the three. Advice, write down, since cash inflow is highest in case of dollar. Since cash inflow is highest in case of dollar, invoice should be in dollar. Invoice should be in dollar. Invoice should be in dollar, correct? Now write down step 2. Step 2. Decision relating to currency in which imports should be invoiced. Decision relating to currency in which imports should be invoiced. Write down 3 columns again. Dollar, euro, pound. Keep space in the columns. Dollar, euro, pound. Dollar, euro, pound. First write down payment to be made in INR. Payment to be made in INR. Go to your question. Second line, 5 million, 50 lakh. 50 lakh, or you can write 5 million. And then you write down spot selling rate. You are an importer. Which rate will be applicable to importer in India? Importer wants to buy. Bank wants to sell. So bank will apply higher rate, ask rate, selling rate. Write down selling rate 67.20, 63.20, 88.75. Is it right now? So point number C, write down invoice amount at spot rate. Will you multiply or divide? To convert rupees into dollar, will you multiply or divide? Divide. Divide is right. Divide is right. Same question. So same answer. So you will get 74.404.762 dollar. Okay, now student will try next column. Answer please. Next column 79,113.924. Very good. Next column. Next column, yes, answer please. 56,338.028. Then point number D, expected exchange rate after 6 months. Expected exchange rate after 6 months. Your spot rate is 67.20 right here into 1 plus 0.07 divided by 2 this time. Sir, why divided by 2? Because the gap is 6 months. So for 6 months the premium will be half. 7% is for full year. So for half year it will be 3.5%. Calculate 69.55 rupees per dollar. Very good. Okay, student, please try next column yourself. Next yourself. What is the answer? What is the answer? 65.10. Round off. Rate you can round off in 2 digits. No problem. 2, 3 is okay. Tell me the last column. Tell me the last column. 90.97 rupees per dollar. Now next is amount to be paid after 6 months. Very easy question. Amount to be paid after 6 months, multiply column C and column D. The mistake you can make is the rate that you can take may be wrong. The premium you may not consider divide by 2 or divide by 4. And some basic mistake like multiplying and dividing when you are converting rupees into dollar. So my first answer is 51,74,851. Next 51,50,316. Last one 51,250,70. Very good. Which is the lowest one? The last one. Because you are an importer, you would like to minimize outflow. So the answer, write down advice. Advice, write down. Advice, write down. Cash outflow is lowest in case of pound. Cash outflow is lowest in case of pound. Cash outflow is lowest in case of pound. Hence, imports should be invoiced in pound. Hence, imports should be invoiced in pound. Hence, imports should be invoiced in pound. Okay. So this answer is over. Yes, good morning and welcome to this wonderful SFM revision one more time. So please come to question number 6. Question number 6 is from November 2020 RTP revision tension paper. Okay, because some question give you tension. You are a treasurer of XYZ in the UK. UK is your country. XYZ have two overseas subsidiaries. One subsidiary is in Amsterdam and the other one is in Switzerland. Very good. The surplus position of the funds in hand is as follows, which it does not need for the next 3 months. Understood? So they have surplus funds which they don't require for next 3 months. So that can be invested. That can be invested. Either you can invest in the respective country or you can bring all the money to the head office in UK and the head office can invest. But will be needed at the end of that period. So for calculation purpose take 91 days. For calculation purpose take 91 days. Holding companies in UK, it has 1,50,000 pounds. Swiss subsidiary has 1,996,154 CHF, the currency of Switzerland, Swiss franc, and it is written as CHF. Okay, and Dutch subsidiary means Amsterdam uses euro. Exchange rates are as follows. What is exchange rate for euro? This is exchange rate given for which currency? Euro. Exchange rate is for euro, spot rate, and it is given in terms of pound. So it's basically pound per euro. Pound per euro. So you will read it as pound per euro. This is the buying rate and this is the selling rate for pound per euro. And then you are given 91-day points. These are the premium. These are the premium. Why it is premium? Why it is premium? Reply please. Why it is premium? Because it is in ascending order. Very good. It is in ascending order. Then they have given you spot rate in bracket pound, CHF buying rate, selling rate. So this you will read it as CHF per pound. This you will read as CHF per pound. This you will read as CHF per pound. And 91-day points 0.0242, 0.0228. My question is whether pound is at a premium or at a discount. Pound is at a premium or discount. Please reply. Look at these premium points. Look at the swap points. Pound is at a discount. Why? Why it is at a discount? Because it is in descending order. Because it is descending order. So So while calculating the 91-day forward rate, you will deduct discount, and here while calculating the 91-day forward rate, you will add premium. So very interesting question. This is premium, this is discount. So accordingly, you will do the adjustment. Okay. So are you ready for the question? This question is very, very important. 91-day interest rate on per annum basis, underline per annum. So wherever you have to do the calculation, you have to multiply 91 by 365 because, 360, because the number of days are given as 360. So 91-day interest rate on the deposits in the money market are as follows. So these are the interest rate for pound, euro, CHF. And the interest rate will be according to the amount of the currency. Is it right? If you invest between 0 to 2 lakh, these are the rates. Between 2 lakh 1 to 10 lakh, these are the rates. Like this. Like in India, bank also gives you FD rates. Do you know that? Bank says if you invest for 91 days, 6.5. 1 year, 8%. More than that, 8.5. So that is how even in the foreign countries, the interest rates on deposits are given. Do not calculate slab-wise interest. Do not calculate slab-wise. Because one student had asked me in the earlier batch that can we take slab-wise that first 2 lakh, this is the interest, after that this is interest. This is not income tax. Have you ever invested in a bank FD? So do they charge slab-wise interest or according to the amount you invest and the period for which you invest? According to that, on the whole amount they will apply the interest. So we will also apply the interest on the whole amount. We will not go slab-wise. So for the clarity of doubt, no slab-wise interest. You have to just see which is the right line and that you will follow. For example, this holding company is 1,50,000 pounds. 1,50,000 pound will fall into this range. So interest rate applicable will be 1%. Another example, suppose CHF is 1,996,154. CHF will be in which range? Third range. So the interest rate applicable will be 0.5%. Very good. Like this we will do. Next line. Very good question for checking the knowledge of a student. You have been approached by your banker wherein the above mentioned surplus was lying, requesting you to swap the surplus lying with other two subsidiaries and place them in deposit with them. So one bank has come. Bankers are very smart. They found that you have got so much of surplus. So they are telling you, don't keep money with this Amsterdam and Switzerland subsidiary. Bring the money into your country, that is UK, and invest with us. So that is the proposal of a banker. In that case, you will have to bring the money first into UK and invest with UK bank, the entire amount. One option is called decentralized investment. Sir, what is decentralized investment? Each subsidiary or holding company will invest on their own. And centralized means all money will be brought at one place, holding company, and then the holding company will invest. So right now one calculation will be the value on maturity if each subsidiary follows decentralization approach. And the second calculation will be if they follow centralization approach. Determine the minimum interest rate per annum. This is your reverse question. Determine the minimum interest rate per annum that should be offered by the bank to your organization so that your organization is ready to undertake such swap arrangement. So when you will be ready to undertake such swap arrangement, when you will get the same maturity value which you will get by decentralization approach. We will get the same maturity value which you will get by decentralization approach. Is it right? So you'll have to find out what interest rate the bank in UK should offer so that you will take the proposal of that bank. So you will say, I will take your proposal if you also give me the same maturity amount which I can get myself by investing separately by each subsidiary and the holding company. So I will be indifferent only if I get the same money from you which I can get myself. Is it right? So what will be my first task? My first task will be to find out if each party invests on their own, how much will be the amount on maturity. Is it right? How much will be the amount on maturity? So some simple calculation we will perform now. Students are requested to start writing. We will take the amount available with them, add interest for 91 days. That will give me amount on maturity and convert into pound so that we can take the total. Because to take the total I need same currency. You're right. So come on, write down. Step 1, calculation of cash balance in pound. Calculation of cash balance in pound after 91 days. Calculation of cash balance in pound. Because why in pound? Because I have to compare with the other option also. So to add the three currencies, you have to first bring them down into one same currency, that is pound, because pound is the holding company's currency. So start writing, please. First write down calculation of cash balance in pound after 91 days if each party acts independently. If each party acts independently. If each party acts independently. Is it right now? So write down holding company in bracket UK, Swiss subsidiary and Dutch subsidiary. So first point A would be naturally surplus at the beginning. Surplus at the beginning. So go to your question, you will find surplus at the beginning is given pound 1,50,000, CHF 19,96,154 and Dutch subsidiary has a surplus of 14,50,000. Second point again should be interest rate applicable per annum. You will tell me, yes, come on, yes, students, please reply. What is the interest rate applicable to holding company if it has to invest 1,50,000 pounds? One student has replied 1%. You are right. Swiss subsidiary. Come on, Swiss subsidiary. Look at the CHF column and look at the range 10 lakh to 20 lakh. Is it 0.5%? Very good. Come on, next. Who will answer? Dutch subsidiary? Yes, yes, yes. Come on. 2%. Yes. 14,50,000 will come in the third slab. So 2%. This is just to find out the applicable rate that is given. All figures are not relevant. They are testing your understanding of the question. Now calculate interest for 91 days. Calculate interest for 91 days. Take on your calculator 1,50,000 into 1% into 91 divided by 360. 91 divided by 360. Yes, Rishabh, you are right. Come on, next. Around 379.17 you are getting. Okay, try the next one. Try the next one. Next column is how much? Simple interest for 91 days. 2522.92 you are getting. 2522.92. Try the third one. Try the third one. Anybody for Dutch subsidiary? 14,50,000 into 2% into 91 by 360. Yes, what is the answer? 7330.56. Very good. Point number D. Amount received after 91 days. Amount received after 91 days, you will add the principal A plus interest point C. Write in bracket A plus C. A plus C. Sidana is right. Come on, Sidana. Holding company maturity value of deposit. A plus D without calculator. 150,379.17. This you can do without calculator. Now try the next one. Dutch subsidiary. Swiss subsidiary first. 1998676.92. You are right. Keep writing the currency also CHF. Now tell me Dutch. Without calculator you will do last one. 1457330.56. Are you getting? Say yes. Now the next task is to convert all these numbers into pound. First number is already in pound. So I will just write exchange rate 1. Even if you don't want to calculate the first column, it's okay. So please students, write applicable exchange rate after 91 days. And if you can get this right, out of 8 marks, you will get at least 4 marks. If you can manage these two rates. So I am asking you question. What is the applicable exchange rate between pound and CHF? Pound and CHF. Applicable exchange rate, forward rate between pound and CHF. Give me the correct answer. I will send you one e-chocolate. One student has given 2.3098. 1.2. So which rate you have to use? So first you look at the rate between pound and CHF. The rate is per pound. The rate is CHF per pound. So imagine you will bring CHF. Okay? So you will sell CHF and buy pound. What bank will do? Sell pound. So sell pound means bank will apply the higher rate, that is 2.3326. But I have to find 91 day rate, which is at a discount of 0.0228. So 2.3326 I will take minus 0.0228. 2.3326 you can see selling rate. Below that 91 day 0.0228 is given. Minus that. So your answer would be 2.3098. 2.3098. Mehul is right. 2.3098 was the right answer. I have shown the calculation also on the screen. Please write the calculation. Later on you will forget. Preeti is wrong. Preeti, you have to change your answer. Okay. Now my question is again, what is the rate for Dutch subsidiary? Rate between euro and pound. Rate is for euro. So you will bring euro and you want to buy pound. What bank wants to do? Bank will sell pound but purchase euro from you. So rate is for euro. Rate is for euro. Rate is per euro. Am I right? Bank is purchasing euro from the customer. So bank will purchase euro at a lower rate. That is your 0.6858 plus the premium for buying rate 0037 plus 0.0037. So the answer would be 0.6895. Rishabh is right. Very good. So I am going to send you one electronic chocolate now. This is the chocolate. These are the wrapper. Cadbury is written here. Okay. Enjoy. Yes. And many students get it wrong sometimes. Not everybody. So that is why I took this question. It has lot of data. Yes, Rishabh, enjoy your Cadbury. Amount in pound. Convert amount in pound. First one will be same. First one will be same. Now again $1 million question. What is the pound equivalent of this CHF figure? Pound equivalent. The student is saying, sir, the chocolate is yummy. Wow. I will send you some more after some time. You can distribute in your society also. Yes, answer the middle column. 865303.02. Very good. One more. Last column. Last column. Are you multiplying or dividing? You have to multiply. You have to multiply. That is the trick. The amount is in euro. The rate is per euro. When the rate is per euro, the answer will be 10,04,829.42. Yes. Those who have replied, the answer was right. So what are the two possible mistakes in this question? One possible mistake is using a wrong rate here. Second possible mistake is instead of this needs to be divided and this needs to be multiplied, because the rates are given in different ways. One is rate per pound, one is rate per euro. So when the currency is already in euro and rate is euro, you need to multiply. But when the currency is CHF and the rate is per pound, then you need to divide. So now you tell me the total amount in pound after 91 days. Take the total of these three figures. If you manage funds on your own in a decentralized manner, the firm will have after 91 days, 2020511.61 approximately. After decimal, if there is a difference, don't worry. Before decimal, it should be right. Yes. So this is what I must get from a banker also. This I should get from a banker also, who is telling me that you please come and deposit with us. So I will tell him, boss, I can earn this much myself. So you should also give me the maturity value at least equal to this much. Yes, minimum. Then only I am motivated to invest in your bank. Now write down step number 2, swap to sterling. So now what I'll do, I'll bring all the funds before on the first day to UK only using spot rate now, and then we'll see how much interest do we need and find the rate of interest. Okay, are you ready? Right. Step 2, everybody should try. This is a batch for your exam purpose, and this is one of the most important questions. So first you write down, right hand side, write down, don't write rupees, write down amount, write down amount. cut the rupees because we are used to writing rupees every time. When we'll go to moon also, we'll write rupees there also. Convert euro into pound. Convert euro into pound. How many euros are there? 14,50,000. And what is the spot rate? The spot rate is 0.6858. I will use 0.6858. We will sell euro to the bank. Bank will buy euro from us. The rate is per euro. The rate is per euro. So the lower rate will be used because bank is buying euro from the customer. Answer please. 994410. Okay, now I will give you a chance. Convert that Swiss subsidiary CHF figure into pound at spot rate. CHF into pound. Convert CHF into pound. So this time the rate is per pound. This time the rate is per pound. So the bank is so this I think I have written a wrong symbol here. It should be multiply and it should be divide. Oh, my mistake. Human mistake. Okay. Human beings are bound to make mistakes. Answer is right. Okay. Answer is right. So this is just a typing error. Calculation was right. So now please write down how much will be the pound you will receive. 855,763. 855,763. I have rectified. You also rectify. So now amount with holding company is already in pound. 1,50,000. Is it right? 1,50,000 now. So tell me the total. Who will give me the total first? The one who will give me total first will get e-chocolate again. Total amount is 2,000,173.53. Very good. But this time the student in the classroom has given the answer first. You will get the e-chocolate, okay? You will get physical chocolate. Now write down desired amount at the end of 91 days. Desired amount at the end of 91 days. Go to step 1 total. Go to previous step, look at the total. Yes, students, please reply. What was the answer in the previous step? 2,020,511.61. So you want this amount the bank should give you on maturity. So how much interest the bank should give you on maturity? This is you will invest today. This is your maturity value. So the difference is your interest. The difference is your interest, right? Interest required, E minus D. Interest required, E minus D. Come on, come on. Please take the difference, 20,338.08. Now I am going to ask you a school level question. This is the principal amount. This is the interest amount. Number of days are 91. What is the rate of interest in your 4th standard simple interest calculation you have done? So this is the interest amount, this is the principal amount, this is the time. Can you not find me the rate of interest per annum? Start on your own. What is the rate of interest? Everybody, come on. This much you should be able to do. Now your exam is very close. So the required interest will be interest amount divided by principal into 361 divided by 91 into 100. The answer is, come on everyone, the answer is 4.023%. That is also right. 4.022 is also right. So this was a very important question, considering so many currencies, so many rates are given. Choice of the correct number is important. So conclusion, write down. The minimum rate to be offered by the bank is 4.023%. The minimum rate to be offered by the bank is 4.023%. The minimum rate to be offered by the bank is 4.023%. Per annum. You can write per annum. 2.023% per annum. Very simple if you use the correct rates. That is, we have done. We have converted everything into pound and then invested at this rate. You are saying the same thing. But the question is what interest rate the bank should offer. So I have to answer what is asked. Okay. So that is what the other student is also asking. Can we convert into pound in the beginning and then compare with the other answer? So if you suppose invest in pound directly, how much money do you have? 20 So normally the first paragraph says the surplus position of the fund in the hand is as follows, which it does not need for next 3 months but will be needed at the end of that period. So that means each subsidiary will keep the money with themselves only and they will invest on their own. So we have to basically compare decentralization with centralization. Is it right? The other option, other answer which you want is, suppose I have this much amount at the beginning and if I invest in pound, I'll get 5.38% for 91 days. Oh, that is okay. Then in that case, the answer is 5.38% only. There is no calculation required because you will also get 91 days is same for both options. Either you invest or the bank will give you 91 days interest. Then in that case, your answer will be 5.38% only. There is no need to do any calculation. The moment you find you exceeded 20 lakh, you will get 5.38% on your own. That is what the banker should also offer you. So from the overall design of the question, it appears you have to see if each party invests independently, then what will be the amount you will receive on maturity. Okay. Otherwise, there is no need to give forward rates, etc. Question number 7. This question is very important because it has been asked only once and it is a very different type of question. Okay. November 2019 exam 007. A German subsidiary of US based MNC has to mobilize, underline German subsidiary of a US based multinational company has to mobilize 1 lakh euro working capital for next 12 months. 1 lakh working capital for next 12 months. It has the following options: loan from German bank 5% per annum. So if you borrow in your own country, If you borrow in your own country, how much you have to pay? 5%. If you borrow in USA, 4%. If you borrow in Switzerland, you will have to pay 3%. So from the rate it appears this is better, but wait, there are other issues involved. Okay. Banks in Germany charge an additional 0.25% per annum towards loan servicing. So basically what will happen, if you borrow from Germany, it will not be just 5% interest, but a German bank also charges 0.25% for servicing the loan. Whatever are the cost of servicing the loan, they charge 0.25%. There is one more problem. Loan from outside Germany attract withholding tax of 8%. Loan from outside Germany will attract withholding tax of 8%. What is withholding tax? Whenever the payment will be made, whenever any payment is made to a foreign country, the domestic country will have to deduct 8%. The domestic country will have to deduct 8%. So this US parent bank is charging 4%. But they will say, I want 4% in my account. So who will have to bear the burden of the withholding tax? German firm. So German firm will have to actually give them a higher interest rate, so that after deducting 8%, they should get 4%. Is it right? Like my office staff says, sir, I want 17,000 rupees salary, but I have to pay 200 rupees profession tax also. Then what I have to do? How much salary I have to offer him? On paper, I have to give him 17,200 rupees salary. Because he says, I have negotiated with you 17,000 on that day. You said I will get 17,000. I want 17,000 in my account. So similarly, the US bank is saying we want 4% interest. So you have to bear the burden of withholding tax. So my effective cost will actually go up. 4 divided by 0.92. So that when I will pay that higher amount and deduct 8%, actually the other party will get 4% only. Is it right? Similar to your office example, my office example. Now next point, if the interest rates given above are market determined, examine which loan is most attractive using interest rate differential. Which loan is more attractive using interest rate differential? One more problem is that these are different countries, Germany, US, Switzerland. So interest rate parity theorem will also apply. Interest rate parity theorem, because you will benefit on the exchange rate, interest rate, you will benefit on the interest rate, but there is a problem. Exchange rate after 1 year would have changed. Exchange rate after 1 year would have changed. So you have one more cost, hidden cost, and that is your exchange premium that you will have to pay at the time of repayment. At the time of repayment, if you suppose borrow $100 today, convert into euro, after 1 year when you will go to pay, the rate of exchange will not be the same. Why rate of exchange will not be the same? Because interest rates are different. If interest rates are different, by that time you go and make the payment of that principal amount, you will have to pay a higher amount depending upon which country has a higher interest rate. So Germany has a higher interest rate. So as per interest rate parity theorem, German currency will depreciate. Foreign currency will appreciate. So there is one more cost that you have to add, and that is the premium. Yes. Three costs. One is 4%, one is withholding tax, and one is that premium. So that premium you will calculate as per interest rate parity theorem. Is it right? Oh my god, we never visualized that this question has interest rate parity calculation also. If you are different countries with different interest rate, exchange rate will also change. That is called interest rate parity theorem. Okay. In this previous example, one student has said that if we follow 5.38%, there will be a problem on after 3 months we'll have to send the money back to their country, and that time the exchange rate can be different. So that is why you have to also ensure that you get the same exchange rate. Okay, and that is why first you computed the individual figure and then compared with the consolidated figure. So write down answer of question number 7. This also you write important new question, not usually taught in the regular class, but it has been asked. So if they have asked in earlier exam, they can ask in the next exam also. Calculation of net cost under various options. Calculation of net cost under various options. Please write down. Calculation of net cost under various options. As far as German is concerned, it is simple because you are a German subsidiary and you are borrowing in Germany. So exchange rate fluctuation will not matter here. Right? Start writing loan from German bank, and here my calculation is simple. 5% is interest and 0.25 is loan servicing charges. That gives me 5.25%. Step option 2, write down. Option 2, loan from USA parent bank, loan from USA parent bank, loan from USA parent bank, right hand side amount, effective rate of interest, 4% divided by 1 minus 0.08. I will have to pay a higher amount so that the withholding tax is also covered. After deducting withholding tax, the US bank should get 4% in their pocket. Is it right? So I will have to actually pay 4.35%. 4% plus also we have to pay with withholding tax, and write down the premium on USD. Yes. So first 4.35 when you will go to pay, if you take 8% of that, it will come to 0.35. 0.35 will be deducted and 4 will be remitted to the other company. Okay. And then you write down premium on USD using interest rate parity theorem. Premium on USD using interest rate parity theorem. Using interest rate parity theorem. Premium on USD using interest rate parity theorem. So one of the formulae you have learned in interest rate parity theorem is RD minus RF upon 1 plus RF. RD minus RF upon 1 plus RF. So RD means interest rate in domestic market, which is 5%, minus interest rate in USA 4%, divided by 1 plus 0.04. So how much is that? 0.96. 0.96. Net cost. Net cost will be, under US parent bank option, net cost will be A plus B, 5.31%. 5.31%. Is it right? This formula we have discussed in the regular class and we have derived it also, but now we don't have time. Write down next line. Option 3, loan from Swiss bank. Loan from Swiss bank. Loan from Swiss bank. Same calculation. First point A, effective rate of interest. Effective rate of interest. Effective rate of interest here will be 3% divided by 92%, 3.26, and premium on Swiss franc, premium on Swiss franc, premium on Swiss franc will be 1.94. 1.94. Very good. So what is the net cost? Come on, net cost Swiss bank 5.2%. Very good. So one has to look at the issue from various angles. It's not just the interest rate, but also whether any tax issue is involved, whether any exchange risk is involved, and then one has to decide which is cheaper to borrow from. Now you compare the three answers and tell me where will you borrow from, which is the lowest figure, which has the lower effective cost. Swiss bank. One day when you will join the Adani enterprise and they will ask you to borrow from different countries, keep this question in front of you, okay? And this will help you to decide. Adani ji will give you 10 crore rupees bonus. So write down the conclusion. Loan from Swiss bank is the best option because they are searching for loan, okay? So help the great Adani is the best option as the net cost is lowest. Why? Because the net cost is lowest. Understood? One more important question. Highly repeated question, write down. Highly repeated question. 2-3 times they have asked in exam also. And 3-4 times it has come in MTP, RTP. This question is everywhere. Question number 8. DOM Limited. If you write correct answer, your mark sheet will boom. If you write wrong answer, your mark sheet will doom. Okay. So DOM Limited is an export business house. Underline the word export because the answer will completely change if it was import. So as a homework you can try assuming it was an import business house. Okay. The company prepares invoice in customer's currency. So there will be a problem of exchange risk. It daters of US dollar 48 lakh is due on 1st April. So what is the maturity date, due date of this amount receivable? 48 lakh. So this is a question of amount receivable. Are you getting? Now next is market information on 1st January 2020 is. Today is 1st January. And the payment will arrive on 1st April. So 3 months gap. Now lot of information is given, some information may not be useful. Okay, like exchange rate is given, spot rate, 1 month forward rate, 3-month forward rate. Are we interested in 1 month forward rate? Are we interested in the spot rate? No, because my payment will come after 3 months only. So I will have to book a 3-month forward contract. And then they have given you information about future, currency future. So this is a question on currency future. Okay, that means it is used for hedging purpose. And see the rate they have given, US dollar per INR. And what is the contract size? Rupees 288,16368. That means one lot is equal to, one contract or one lot is equal to 2,88,16,368. Yes, make it a small correction. That is why I have written in red font. This number is 288. In your book it is typed 258. So kindly rectify. Have you rectified? 288. Typing mistake. 1 month future is irrelevant, because I will book a future contract which will match with my maturity or near my maturity. So 3 months. So this is the rate. Now this will be USD per INR. This will be USD per INR. Understood? Next line. Initial margin. When you take a forward contract, future contract, not forward, future, the exchange requires you to deposit initial margin. The exchange requires you to deposit initial margin. Again, 1 month data is irrelevant. Unnecessary they have given to confuse you. Extract money from you. Extract money from poor student who have already dedicated his youth for this course. 3 months is relevant. So 3 months. Initial margin for one contract is 32,500. But because initial margin is paid at the beginning and we are going to do calculation at the end, there will be a 3 months interest loss on initial margin. There will be 3 months interest loss on initial margin, because all cash flows I am going to calculate after 3 months. Initial margin will be paid today. So the interest loss on that is also a cost under future contract. The interest loss on initial margin is also a cost under future contract. If it is given, you have to consider it. If it was not given, then interest on future contract is ignored. On 1st April 2020, the spot rate is given and the currency future rate is given. This is on maturity, not spot. So when you go to the maturity date, that day you find that in the market, the rate between dollar per rupees 0.01384, and on that date, the currency future is also trading at almost the same rate, but it is different. So this currency future contract which you are going to take, to calculate the gain or loss, you will apply the future rate available. You will apply the future rate available. Okay. And whatever amount you will receive, that amount you will convert at spot rate after 3 months. And on currency future, you will get the difference. Recommend as to which of the following method would be most advantageous to Doom Limited. Now, if you are an exporter, the answer is higher of the three. What are the three options in front of you? Either you can take a forward contract and book the rate at this amount, matter closed. Using future, so you have to take a future at this rate and don't hedge, just wait. So if you wait, you will get the conversion at spot rate on maturity. You will get the conversion at what rate? At spot rate on maturity, because you have not done anything. So whatever is the spot rate on 1st April, this is the rate, at that rate you will convert. Now this is a question of currency future which involves several steps to solve. So first what you do, to make your task easier, I have drawn a flow chart. Please draw this flow chart in your notebook. Please draw this flow chart in the notebook. I will explain once you have drawn. I'll just come after 45 seconds. Okay. In the meantime, please draw the diagram. I will come back in 45 seconds. Okay, I am back. So have you drawn the diagram? First tell me yes or no. Everybody, those who are learning from home, have you completed the diagram? Yes. So now you see in this question, what position I have to take, I have to decide that. Okay, So whenever you have doubt in future, you can refer this chart. So first you identify who is the party. Is he an exporter or is he an importer? Is it right? So if it is he is an exporter, what is the risk involved? The risk is that foreign currency may depreciate. If foreign currency depreciates, if suppose dollar depreciates and you are an Indian company, you will get less rupees. Or you can also say home currency may appreciate or home currency may appreciate. Understood? So to an exporter, the risk is that the foreign currency may depreciate or home currency may appreciate. And if you are an importer, suppose same question is given from importer's point of view, what is the risk? The foreign currency may appreciate, you may have to pay more if foreign currency appreciate, or it is same as saying that home currency may depreciate. Now I will come back to exporter, which is our question. If the future contract is denominated in foreign currency, if the given future contract is denominated in foreign currency, that means home currency per unit of foreign currency is given. Home currency per unit of foreign currency is given. Then you have to sell future. Then you have to sell future to hedge the risk. Because if there is a depreciation in foreign currency, the loss in foreign currency will be compensated by the gain in the future. If you have taken a short position in future and if it is dollar, the loss in this transaction will be compensated by the profit on future. That is also not relevant to us in this question. This is relevant to us in this question. We are an exporter. The future contract is denominated in home currency. So this you tick mark, which is applicable for this question. Future contract is given as dollar per rupees. Is it right? Future contract is given as USD per rupees. So now what is my risk with respect to home currency? My risk is that home currency may appreciate. My risk is home currency may appreciate. If home currency is going to appreciate, I will lose. Then what is my position in the future required? Buy future, long position in future required. So the loss here, the loss will be compensated by the gain if you buy future when future is denominated in home currency. Is it right now? Yes. So one Mr. Rishabh has also said the same thing, long the future in this case. So basically student can tick mark these two things which is applicable. But suppose in your exam they give you importer. If the future is denominated in foreign currency, the risk is that foreign currency may appreciate. So buy future. If future contract is denominated in home currency, the risk is that home currency may depreciate. In that case, sell future. So one more time I will explain. We are here. This is the contract and this is the strategy I will follow. Now write down one more note. Steps in solving currency future hedging problem. Please write steps in solving currency future hedging problem. I have found students having difficulty here. So I am going to first give you a note. How to solve currency future hedging problem. How to solve currency future hedging problem. So step 1, write down, check the exposure. Check the exposure. Check the exposure means what is the firm afraid of? What is your risk? What is your risk? Accordingly, the firm should buy or sell future. Accordingly, the firm should buy or sell future. For that, I have already given you a diagram. To write in bracket, refer diagram. The answer depends on whether you are exporter or importer. The answer depends on whether future contract is denominated in home currency or foreign currency. Accordingly, we will buy or sell future. Step number 2, write down future maturity. Step 2, write down future maturity. Step 2, write down future maturity. Step number 2, write down future maturity. Always choose future maturity equal to or just before exposure maturity, or just before exposure, near to the maturity. Is it right? Like in our question, why I have given you this note? In our question, 1 month future is also given, 3 month future is also given. So afterwards you should not have a doubt. My currency will come to me on 1st April. So I will take a future contract which will also mature around that period. So I don't have the risk, or I don't have much risk. But in this question, that problem will not be there because both are April. Step number 3, calculate number of future contracts. Calculate number of future contracts, because you can't buy future contracts in fraction. Okay, you don't get exact amount of future contract. You have to either round it off to the lowest or the highest side. Write down. Student has to write. Later on you will not remember what did I say, but your notes will remind you what I did say, what I said. So how do you compute the number of future contract? Student will follow this highlighter or pointer now. If exposure currency future are available, if exposure currency future are available. In our question, the exposure currency is dollar. The exposure currency is dollar. We have to receive dollar. So in that case, if the future was also denominated in dollar, my life is easy. Exposure divided by lot size. Suppose this was 40 lakh dollar and the lot size is $10,000, then my life is easy. But this formula I will not apply. Sir, why? Because my lot size is not given in dollar. My lot size is given in rupees. My lot size is given in rupees. So next formula will be applicable in this question. Case B. Case B, write down. If exposure currency future are not available, which is applicable to our question number 8. Which is applicable to our question number 8. If exposure currency future are not available, exposure is in dollar, future is available in Indian rupee. So what do I do? Write down number of contracts equal to, below, left side below, number of contracts equal to exposure equivalent based on future price. Exposure equivalent based on future price. So my exposure is 48 lakh dollar. I will find out the equivalent amount in rupees. 48 lakh dollar is equal to how many rupees? For that I will apply the future price. Is it right? So that will convert 48 lakh dollar into rupees and divide by lot size. Lot size is given 2 crore 88 lakh 16,000 368. Okay. So this will give me number of contract. Step number 4, write down. Step number 4, please write down. Settlement on maturity date of exposure. Settlement on maturity date of exposure. This should be taught line by line so that any time you revise, you will understand. Whatever we speak in the class, you will forget after a few hours. But whatever you write in the notes will remain with you forever. If your notes are there forever. Don't sell your notes. Whatever basics you are learning will be required for the rest of your life. Till death. Okay. That is equal to rest of your life only. Settlement on maturity date of exposure. So how do you settle the amount? Square of the future. Square of the future. In our question, we have entered into a future contract. Then after 3 months, the future rate is given. The difference will be your gain or loss. And calculate the gain or loss. And calculate the gain or loss. Be careful about the currency. Whether the loss or gain is in dollar or the loss or gain is in rupees. So here also the student make mistake. They write a wrong currency here. When we will solve it, that time I will explain this point again. Be careful about currency. Then you will receive the dollar. Need the payable or receivable by buying spot or sell the receivable spot. So if you are an importer, then you have to buy spot. If you are an exporter, you have to sell spot. That is why in the question spot rate on 1st April is given. So to us this line is important because we are exporter in this problem. But if the question is of importer, then this line will become important. Now next line, write down. Calculate interest expense on. Calculate interest expense on initial margin blocked. Calculate interest expense on initial margin blocked. Calculate initial expense on interest expense on initial margin blocked. If initial margin is given to you. In some question they don't give you. So then ignore. Then write down next line. In case of importer, just 2 more lines, then we'll solve. In case of importer, which is not applicable in this problem, in case of importer, final answer is home currency outflow. Final answer is home currency outflow. Final answer is home currency outflow. And in case of exporter, the final answer is home currency inflow. So your last answer should be inflow in rupees. And if you are comparing with different options, then the one which will give you highest inflow in rupee would be taken, would be selected. Understood now? Now I am going to apply the theory into practice. Write down answer. In the exam you start from here. Previous 2 slides were irrelevant. So answer starts from here, from exam point of view. So dear students, write option 1. Option 1 is enter into 3-month forward contract. Enter into 3 months forward contract. I am waiting for this question to be asked again in the exam because it is repeated in several RTP, MTP, old syllabus, new syllabus. Point A, write down amount receivable in dollar, 48 lakh. Point number B, write down 3-month forward rate, 3-month forward rate, 3-month forward rate dollar per rupee, 3-month forward rate dollar per rupee. Just look at your forward rate 3 month 0.013889. Can you see that? So convert into rupees now. This is dollar, 48 lakh dollar, and this is rate per rupee. So when the currency is in dollar but the rate is in rupee, you will divide. One student is saying this is my favorite question. Very good. So divide, you will get 34 crore 55 lakh 97,000 to the divide. Are you getting this answer? Check it again. 34, 55, 97, 235. Now write down step number 2. Option 2 write down. That is the purpose of taking this question, to explain to you how the future contract gain or loss is calculated, how cash flow are calculated. Are you ready? Yes. Option 2, future contract. Option 2, future contract. I will give you a note for understanding purpose. Note not required in the exam. If you don't have time in the exam, then you can skip this note. This is for your reference, for your understanding, for your future revision. The firm is afraid of dollar falling, that is rupee rising. That is rupee rising. It should buy rupee future. So when you are afraid that rupee will go up, the appropriate position will be buy rupee future. It should buy rupee future of April maturity. Underline April. Okay, they have given you 1 month also, but that is to be ignored. April maturity at, look at your question again, 0.013881 dollar per rupee. Then your query can be why we have taken April, because why we have not taken February. The answer is, since receivable is on 1st April, the firm should choose April future contract. Since receivable is on 1st April, the firm should choose April future contract. Now you see, the exposure is in dollar. Exposure is in dollar, but the contract is in rupee. So you have to find out rupee equivalent of USD exposure. What is 48 lakh dollar equivalent to? For that you will apply the future rate. For that you will apply future rate 0.013881. Now please take your calculator and check this. Is right 34 57 96412. Say yes. Step 2, number of contracts. Step 2, write number of contracts. Number of contracts will be your exposure in rupee divided by 1 contract size. I am going to ask you to check whether you are listening or not. How many future contracts you have to buy? How many future contracts you will have to buy? Take the previous answer, divide by 288,16368. So 12 contracts. If you are getting in fraction, round off. 12 contracts you have to buy to hedge yourself. Is right 12? Yes, 12 number of contract is right. Now write below step 3, profit on squaring of future. Profit on squaring of future on 1st April. profit on squaring of future on 1st April. What is the answer? Now you have entered into a future contract at this rate 0.013881, correct? Bought. And now the future rate on 1st April, future rate is 0.013893. So the future has gone up. So if you have bought future, if the rate goes up, even though it has gone up by a very small number, but it has gone up, so you are going to make profit per rupee. You are going to make a profit per rupee. So this is the profit in dollar per rupee. The difference is the profit in dollar per rupee multiplied by one contract size and multiplied by 12 contracts. So that will give you total profit in which currency? Dollar. The profit you are calculating is dollar per rupee. So the total profit will be total dollar profit versus so many rupees. Is it right? So write down the calculation. Write down, this is an important calculation now. This is the 1st April future rate. This is the contracted future rate. So the difference between the two is our profit because the rate has gone up and we have taken a long position. This is one contract. This is 12 contracts. So the answer is $4149.56 gain. $4149.56 gain in future contract. Now step number 4, write down. Step number 4, total amount available after 3 months. Total amount available after 3 months. Total amount available after 3 months. Total amount available after 3 months will be, understand this point, $48 lakh you receive from customer. 4149.56 you will receive from profit on future. So now you have with you 48,04,149.56 So you are holding so many dollar on hand on 1st April, 48,04,149.56. This you convert into rupees now. Step 5. Come on student, reply please. Rupee inflow after 3 months. Rupee inflow after 3 months will be at spot rate. Take this dollar, go to the market, sell dollar in the market. The spot rate, this is the spot rate in the question last 5th line. So you will get how much? You will have to divide because amount is in dollar, rate is in rupees. So divide, you will get 34,57,71,524 rupees. Very good, Rishabh. You seem to be a highly talented student. Now write down interest on initial margin blocked for 3 months. You have to take initial margin of 32,500 because the 3-month future contract has an initial margin of 32,500 per lot. It is per lot. You have bought 12 lots into 12 lots. Very good. Into 9% interest rate. 9% interest rate and the time is 3 months into 3 by 12. Time is 3 months. So finally your interest obligation would be 8775 or opportunity cost, whatever you want to say. This amount you have to deposit at the beginning. This cash flow is after 3 months. To make them comparable, I will have to also consider the interest lost 8775. So finally my last step 7 for future contract. net inflow on 1st April, net inflow on 1st April, net inflow on 1st April, net inflow on 1st April. Come on, you have to deduct it because this is your opportunity cost. So the answer student has given 3457624749. Very good. So this is my inflow under future contract. This is inflow under future contract. Okay. Now one more option is don't do anything, no cover. Wait for 3 months. Wait for 3 months, not hedging the currency risk. Option 3, not hedging the currency risk. Right hand side, write down. Right hand side, amount. Point A, amount receivable in dollar 48 lakh. Amount receivable in dollar 48 lakh. Point B, write down 3 month spot rate. 3 month spot rate dollar per rupee. 3 month spot rate, or you can write spot rate after 3 months. Spot rate after 3 months. Spot rate after 3 months. 0.013894. So what is the amount receivable after 3 months in INR? Amount receivable in INR after 3 months. Amount receivable after 3 months. 345472,866. Very good. Right? Compare the 3 answers. Which is lowest? Sorry, which is highest? Which is highest? You are an exporter, so I will maximize inflow. So write down future is preferable. Yes, second one. Future is preferable because rupee receipts. Because rupee receipt is highest. Very good. Those who are saying rupee future is better, amazing, wonderful. Because rupee receipt is highest. Is it right? Now we'll take one question on economic value added. Now we'll take one question on economic value added, EVA. Economic value added means whether the firm is genuinely efficient or not. Whether the firm is genuinely efficient or not. So suppose a firm says our net operating profit after tax is 100 crore. Is it efficient or inefficient? Or data is not sufficient? Data not sufficient. Only profit is not enough. We are applying capital in the business. There is an opportunity cost of using capital in the business. So I will also calculate what is called capital charge, which is capital employed into weighted average cost of capital. Is it right? Suppose this comes to 120. So the difference is EVA negative. So even if you are profiting 100 crore, even if you are making a profit of 100 crore, but if your EVA is negative, you are a wealth destroyer. You are a wealth destroyer. But if EVA is positive, it means you are generating profit more than cost of capital and you are a wealth creator. So that is the concept of EVA. Now we'll take one example from RTP November 2021. Write down important. Similar question they ask in the exam. Not very different. So we'll solve it and I will explain the concept of EVA again with the help of the example. Question number 1. On EVA, STR Limited's current financial year income reported is net income after tax at rupees 50 crore. So they have given you PAT 50 crore. Following is the capital structure at the end of the current financial year. So you have debt 80 crore on which you are having to pay interest at the rate 11%. Then equity means share capital plus reserve 250 crore. Total of these two, which is my invested capital, is 330 crore. So this is my capital employed. This is my capital employed. I have to multiply it by weighted average cost of capital to get the capital charge. Is it right? Weighted average cost of capital is KD into WD plus KE into WE. Now, weight of debt and weight of equity can be easily calculated from the balance sheet. This is weight of debt, weight of equity. Is it right? Cost of debt also you can calculate easily. 11% is the interest rate and 30% is the tax rate. So cost of debt you will get. But cost of equity will be calculated by applying this data, and which is tricky. Asset beta is given. Asset beta here would be overall beta. Asset beta means overall beta. Asset beta is not equity beta. Asset beta is the overall beta of the company. That is weighted average beta of debt and equity you can say, or weighted average beta of all the assets on the asset side. From overall beta, you have to find equity beta. For that, portfolio management chapter will apply. You have to convert the overall beta into equity beta. Is it right? Now risk-free rate is 8.5%. Market risk premium means RM minus RF is 9%. So using your portfolio management knowledge, first you will have to find cost of equity, beta of the equity, and once you get beta of the equity, cost of equity, then apply WACC formula, then multiply by this, you will get the capital charge, minimum profit the firm should earn, then compute NOPAT, and then take the final decision whether this company is able to generate economic value added or not. So write down step 1, calculation of equity beta using asset beta. Calculation of equity beta using asset beta. This formula you must have seen in portfolio management chapter. Suppose there is an unlisted company and there is a listed company. So listed company is used as a proxy firm. Using the data of a similarly placed listed company, we find out the beta, because overall beta of an industry will remain the same. Beta of equity and debt can change, but overall beta will remain same. Is it right? So please write down beta levered is beta unlevered upon 1 plus debt by equity into 1 minus t. 1 plus debt by equity into 1 minus t. Put the values here. Put the values 1.11 divided by 1 plus debt is 80, you can see in the problem, equity is 250, you can see in the problem, into 1 minus 0.30. Anybody wants to reply? What is the solution of this calculation? 1.36. Is it 1.36? Anybody wants to check whether it's 1.36 is right? Please check and then tell me. I have not checked. I have taken the answer from institute. Is right 1.36 or not? You're getting a different answer. One person is saying mine is 1.46. Oh my god. Just take on your calculator. First you take 80 on your calculator. Divide by 250 into 0.7 plus 1.
So 1.224.
1.11 divided by 1.224. Now you solve it.
So 0.9068.
0.90686. You are getting 0.90686. Wait, actually we should use a different formula. Beta of equity will be equal to unlevered beta into 1 plus debt by equity into 1 minus t. So that will be 1.11 into 1.224. Now check the answer. 1.11 into 1.224. 1.36. My mistake. You write this answer. This is right. Beta of equity has to be more because the firm is using debt. The firm is using debt. So overall beta is 1.11. Beta of equity has to be higher because the firm is using debt. Have you written 1.36 now? Have you written 1.36? I also had a doubt. So good we checked it. Now write down step 2. Calculation of cost of equity using CAPM. Calculation of cost of equity using CAPM. KE. Calculation of cost of equity using CAPM. K is equal to RF plus beta into RM minus RF. Yes, Mr. Rishabh, you are right. You can use weighted average also. This is weighted average. Weight of debt is given, but cost beta of debt you will assume 0. Then your answer will be same. Beta of debt is assumed to be 0 in this example. We have assumed beta of debt is 0. You can write it later in this example. So cost of equity is equal to 8.5 plus 1.36. RM minus RF is market risk premium. When they are using the word market risk premium means it is RM minus RF. So answer for equity is 20.74%. Answer for equity is 20.74%. Right. Step number 3, write down. Step number 3, write down post-tax cost of debt. Post-tax cost of debt. Post-tax cost of debt. KD is equal to I into 1 minus T. KD is equal to I into 1 minus T. So that is how much? 7.7%. Next step number 4, write down. Step number 4, write down weighted average cost of capital. Weighted average cost of capital. Weighted average cost of capital is equal to KD into WD plus K into WE. So I will give you the formula, you will calculate and give me the answer. Anybody wants to answer WACC? Anybody wants to answer WACC? The answer is very good, 17.58%. Very good. Everybody got this answer? I am happy. 17.58% is right. Now write down calculation of NOPAT. What is the meaning of NOPAT? Net operating profit after tax. It is equal to PAT plus interest net of tax. It is equal to PAT plus interest net of tax. It is equal to PAT plus interest net of tax. Most of the students make a mistake here. They simply take 5,000 given in the question as NOPAT. This EVA is calculated from the point of view of long-term fund. So when you are calculating long-term fund, the profit should be before making payment to providers of finance. Is it right? The profit that we take here is before making payment to providers of finance. It should be operating profit after tax, before deducting interest, preference dividend or equity dividend. But PAT is arrived at after deducting interest. And interest is a tax deductible expenditure. So I will add back interest net of tax, because while deducting interest, you also got the tax shield on interest. So interest will be added net of tax. Write down please. PAT 5,000, interest net of tax. If it is given EBIT, then I will not deduct interest, I will directly deduct tax. But if you are given PAT, you have to do reverse working, and in that case you have to add interest. But interest is a tax deductible expense, so interest net of tax will be added. So write down 5616. Now write down my final answer. Step number 6, EVA. We always follow this format for EVA. However, this is not mandatory. This is my format. Right hand side rupees in lakhs. Right hand side rupees in lakhs. So please write down NOPAT. If you want to write the steps also, most welcome. Write the steps also. NOPAT is step 5, 5616. capital invested 33,000, given. Question says you should present the answer in rupees in lakhs. So I have converted rupees in crore into rupees in lakhs. Okay. Then WACC we have computed in step 4. WACC we have computed in step 4. 17.58%. Capital charge will be B into C. 5801.40. So EVA will be negative. Oh my God. EVA is negative. The firm is not a wealth creator, wealth destroyer. Its opportunity cost of funds is this much, but it is able to generate only 5616. So this is the answer for this question. EVA is negative. EVA can be negative also. EVA can be negative also. Okay. One more topic we will take on which sometime you get questions in the exam is called money market instrument. Money market is a market for short-term securities. Money market is a market for securities whose maturity period is less than 1 year. Firms require funds for short period also. Like they require funds for 3 months or 6 months or 9 months or 12 months. So in that case they will not issue a long-term bond or equity share or preference share. Then they issue money market instrument like commercial paper. Okay, treasury bill is issued by government for raising funds, or certificate of deposits are issued by banks for raising funds for short period. So those are called money market instrument. One of the money market instrument is repo, that is repurchase option. So there is a question for 5 marks asked in July 21 exam on money market instrument repo. If you know it, yes, if you know how to solve it by practicing it in advance, you can solve in the exam. Otherwise, you will not be able to solve. Okay. So just 2 more questions. Just 2 more questions. Okay. Happy? I hope you enjoyed. The bank BK. Name of the bank is BK. My name is BK. Enters into a repo for 9 days. So that means you will borrow for 9 days. You will borrow for how many days? 9 days with bank any in 6% government bond 2022 for an amount of rupees 2 crore. This 6% is coupon rate, and this 2 crore is face value of this government bond. 2 crore is the face value of the government bond. The other relevant details are as follows. Other relevant details. Now these are some important terms. Start proceed. This is the amount borrowed. Amount borrowed. Second leg payment. Second leg payment means repayment. This is the amount repaid. Amount repaid. What is the difference? Guess. Difference is interest, and which is paid at repo rate. Then initial margin. Initial margin means the lender will not give you advance equal to 100% of the value of security. They will give you advance which will be equal to 98.75% of the value of security. Just like in case of share. Suppose you are Adani. Okay, suppose if you become Adani, will be in top 25 richest people. It keeps fluctuating every day also. And you have holding shares of 400 crore rupees of Adani say power. You want to pledge this share and borrow money from the bank. Will the bank give you 400 crore rupees advance, or will they give you 60% of 400 or 50% of 400? Yes, depends on the quality of the share. So normally in case of share market, they give you 40 to 50% of the value of the share as loan. But because it's a government security, the risk is negligible. So therefore, they will keep a margin of only 1.25% of the value of that security and give remaining 98.75% value as advance. Okay, say yes. So this I will require in one of the answer. Days of interest accrued is 240. So this amount already includes interest accrued for 240 days. This amount includes interest accrued for 240 days. Assume 360 days in a year. Wherever interest calculation you will do, take 360 days. You are required to calculate the repo rate. Basically, you have to find out what is the rate the lender has charged to the borrower. What is the rate the lender has charged to the borrower? So this is your initial amount, this is maturity amount, this is 9 days, this is 360 days. So don't you think you can easily find out the rate charged by the lender? Simple interest, school level mathematics. Next is what is dirty price. Dirty price means cum interest price. Dirty price means cum interest price. Okay. And what is clean price? Clean price means ex interest price. Clean price means ex interest price. Okay. So we will have to do some calculation and find out cum interest and ex interest price. So first what I'll do, I will give you a note. Otherwise you might get confused. How this repo works, understand. Repo means repurchase option. Repurchase option. If this question comes and if you have not done it in advance, if you have not understood the concept, I have a serious doubt that will be able to solve it. Because in the exam you can't apply your own trial and error. First part probably repo rate you can get it right. Okay. So are you ready? Repo are, the steps are today. Today what happens, the borrower goes to the lender. Borrower says, I want to borrow money for 9 days. Then the lender says, what is the collateral you are offering to me? So the borrower sells government security at full price. Full price means dirty price. Dirty price means cum interest price. Because when you are going to sell a security, by that time interest must have accrued from last interest payment date till the date of transaction, and the bank will give you loan equal to sell proceed. Bank will give you loan equal to sell proceed on maturity. Time right on end of repo period. On maturity, reverse. The borrower bank will repurchase the government security at loan repayment amount. Borrower will repurchase. That is why it is called repurchase option. You will sell it and repurchase it at the loan repayment amount. So you get back your security and you repay the loan along with interest. You repay the loan along with interest. So today you sell and get the loan, later you repurchase that security when you return the loan. The purpose of this GSEC is that it gives security to the lender. The lender is confident that even if the borrower does not pay, I have got the government security. In India, government security is the most safest instrument. So my risk is very low. This you will discuss in your financial reporting paper also, Ind AS 109. There also we have accounting entry of repurchase option. There that knowledge you will learn is that if you have transferred the risk and reward to the other party, okay, and you don't have control, then usually we will de-recognize the instrument. But in certain cases, we do not de-recognize the instrument, we continue to recognize the instrument in our books. Okay, more about that in Ind AS 109. This is first note. Second note, write down. The convention in repo market, the convention in repo market for coupon calculation, coupon means the interest rate on the bond, is 30 by 360. Sir, what is 30 by 360? 1 month is treated as 30 days, 1 year is treated as 360 days. This is the convention that is followed in the government security for interest calculation. Is it right? 30 by 360. However, if the institute gives number of days, follow the same. If the institute gives number of days, like in this question they have taken 360 days. So for all my calculation I will take 360 days. Second note, write down. This is for a theory question. What is repo? What is repo? Theory question for 4 marks. Repo should be looked upon as collateralized borrowing. It's a form of borrowing by giving government security as a collateral, as collateralized borrowing amongst bank in the money market. The collateral being government security. One party borrows money from other party by giving government security as collateral. It is not just giving collateral, you are selling that security to the other party with a promise to repurchase it. Okay, so in fact, now this is, you must write in the exam for a theory question. In fact, the government security is not just a collateral. Instead, its ownership is transferred. Its ownership is transferred from borrower to the lender, because it is not just keeping it as a collateral, you are selling it. Ownership is transferred from borrower to the lender, so the lender has complete safety. He can sell off the government security. And recover the amount and recover the amount in case the borrower fails to repay. In case the borrower fails to repay. In case the borrower fails to repay. So that is how this works. Okay, one more note, write down. One more note. Full price is equal to, full price in bracket dirty price. In bond valuation chapter you may have come across dirty price and clean price. Okay, dirty price includes interest accrued till that date. Dirty price includes interest accrued till that date. Full price is equal to clean price plus accrued interest plus accrued interest based on 30 by 360 day count convention. 30 means number of days in a month and 360 means number of days in a year. So if it's a 6 months problem, we will take 6 into 30, 180 days and divide by 360. Okay. Now write down loan with interest. That means the loan which is actually given. The amount lent by the lender is calculated at the repo rate using actual divided by 360 days count convention. The interest will be charged by the lender using actual number of days divided by 365 days. But in our question 360 is given, so I will take 360. Okay. From the final repurchase price, we deduct the accrued interest. We deduct the accrued interest to calculate clean repurchase price. Means in bracket write X interest price to calculate the clean repurchase price. Anything can be asked in this chapter. These are a lot of technicalities involved, but those who are fund managers in big banks, mutual funds, insurance companies, government sector, they have to know all this calculation. Okay. Now I am going to come to this question. Before I come to this question, understand one party took the loan at 200,06750 and then he repaid this amount 200,31759. Okay, this is called start proceed and this is called second leg. This is called second leg, and the gap is how many days? 9 days. This gap is 9 days. So basically this is like a future value, this is present value, this is time. You have to find out what is the rate of interest charged by the lender. Is it right? So write down the formula. Calculation of repo rate. Step 1. Calculation of repo rate. By what rate of interest this amount after 9 days will become equal to 200,31759. Don't worry. Try again. So I will give you the data, you will solve. It is like a small equation you have to solve. future value is given, present value is given, time is given. You need to find the rate. Yes, can you solve and give me the answer? Can you solve and give me the answer? Repo rate. Yes, Mehul, Rishav, Preeti, Ajinkya. What is the answer? Repo rate. Can you please reply? Can you please reply? So approximately 5% you are getting? Yes. Check the calculation yourself, but the answer should be approximately 5%, which means the lender is charging 5%. You should know that this price includes accrued interest. This price includes accrued interest, and this amount also includes accrued interest, because it's a government security, so the interest will keep on accruing every day. Now write down step 2, dirty price. Dirty price. Write down the formula for dirty price. Dirty price is your first leg into bracket start proceed. This amount 2,06,750 is the dirty price. So we have to find out what is the dirty price per 100 rupees, per unit, per bond. That is for 100 rupees face value. What is the dirty price? So it is equal to nominal value, which is the face value, into dirty price divided by 100, proportionate. But in case if there is a margin involved, so the lender is not paying you 100%. The lender is paying you only, in this example, 98.75%. So whatever is the value of your security today, the lender is only going to pay 98.75%. So the amount that is lent is equal to the dirty value of the investment multiplied by 98.75%, as the lender is not paying you the full value. He is keeping some margin. Okay, write down. I will give you the equation and you will solve. Let us see who will solve first. Come on, who will solve first? In some question, initial margin is not given. Okay. If initial margin is not given, then student is not required to write this portion. If initial margin is given, then you will write it. Yes, come on, Mehul, Sidana, reply please. What is the dirty price? You have to solve equation, otherwise how will you pass the exam? Whatever methods you have learned, apply. Yes, any answer? How much? What is the answer? Yes, the answer is 101.30. Approximately you can write, because rounding off difference will be there. 101.29 is also right. Dirty price means it includes interest. In your intermediate debenture chapter, they used to call it cum interest price. They used to call it cum interest price. So your with interest the amount is 101.30. And what will be X interest price? That is your last question, clean price. So in the problem they have said interest has accrued for 240 days. Interest has accrued for 240 days. So if I deduct from 101.30 interest accrued for 240 days, I will be able to reach X interest price. Okay. So they have this amount includes accrued interest. If I remove the interest for 240 days from come interest price, I will get X interest price. Last step, write down calculation of clean price, which is very easy. This they teach in your accounts chapter, investment accounting also, and that debenture accounting also. Come interest price is equal to X interest price plus interest accrued. Dirty price means come interest price. Clean price means X interest price. You have to find out what is clean price. I will write the equation, you will solve. Please come on, fast. Yes, solve. Please solve fast. Just one more question after this and then bye bye. Okay. Anybody who got the answer for this? Remember your happy intermediate days? You used to convert come interest price into X interest price. It is the same thing. So the clean price is $97.30. So in the Indian market, the bonds are traded at clean price. The bonds are traded at clean price, but one has to also pay to the seller the accrued interest, because who has held that bond? The seller has held the bond. The seller gets clean price plus accrued interest on that bond on the date of sale. For accounting purpose, the X interest amount is adjusted in the value of investment and the interest amount is adjusted in the P&L account as interest income. One more question we will solve. So that question was for 5 marks in the exam. One question artificially designed for you, not from any exam, not from any RTP, MTP, but for understanding. Are you ready? PNB. What is PNB? Punjab National Bank wants to borrow rupees 500 crore. So what is the amount they want to borrow? 500 crore via repo. Via repo means they will first sell the government security and then on maturity they will repurchase it at using its collateral. What is that collateral? 10%. This 10% is coupon rate. This is the name of the government security, GY 2032. Name of the security. 32 has nothing to do with the answer. It is a maturity year of that bond. Presently trading at rupees 103.10 clean price. Write down here clean price. Now in your book clean price is not written. Then the student will ask what we should assume. So in India the government bonds are traded at clean price. The price quoted is clean price, but of course the buyer will have to also pay accrued interest till that date. Is it right? And when was this transaction taking place? 11th August 2017. The coupon dates are 24th March and 24th September. So when was the last coupon paid? Last coupon was paid on 24th of March. When was the transaction happening? 11th of August. So you have to in this problem calculate number of days interest accrued. So calculate from 24th March to 11th August number of days interest accrued. Anybody wants to reply? Number of days. like in your 11, 12 foundation inter, you have done this kind of days calculation. How many days interest accrued? Please reply. Okay, we'll see later. And the next interest payment date is 24 September. So the transaction have taken place between two interest payment dates. So interest will accrue from 24th March to 11th August. Repo is for a period of 12 days. So you will calculate repo interest for 12 days and the repo interest rate is 8%. This is the interest that the lender will charge to the borrower. Okay. 10% is the coupon rate on the government security. You are using government security to borrow money and you are borrowing the loan at 8% interest. To show the nature of transactions involved. So in this problem I will tell you how to calculate dirty price, how to calculate the amount of money that will be lent today, amount that will be repurchased on maturity, how much amount will be lent today, how much amount will be repurchased on maturity, and what are the clean price and dirty price today also and on maturity also. So this is a complete problem, but this problem does not have initial margin. Okay, are you ready? Yes. So please write down few lines. First write down clean price is equal to 103.10. If in the exam nothing is given, you will assume 103.10 is the clean price per rupee 100 face value. Per rupee 100 face value. Per rupee 100 face value. Then you write down step 2, interest accrued. Interest accrued from 24th March to 11th August. That is 137 days. So you will calculate interest on face value 100 rupees. Interest will always be calculated. Coupon will always be calculated on face value. Is the days not matching? Later on check as homework. And if it is not matching, change the answer. Let us first move ahead. So for March you will take, now at this age of your life you are calculating interest and making mistake. 30. April. May how much? June how much? July how much? 31. And August how much? 11. So how much you are getting? I think it is some different number. 140. I said no, it is possible. 140. Okay. So what I'll do, instead of 11th March, 11th August, can I make it 8th August? So that my answer matches. In the exam, don't change the question, okay? But for the timing, change the question to 8th of August. Change the question to 8th of August. 140 is right, but I have already prepared the answer on the basis of 137 days. So I will request the student to change the date in the question to 8th August. It will become 8 and this will become 137. So everybody is saying 140. You are right, I was wrong. So I have changed the question. So just tell me the answer. Just tell me 100 into 137 divided by 360 into 10%. How much is that? 3.80. That means 137 I have used. Maybe mistake from my end, no problem. Now write down step 3, full price. Full price will be clean price plus interest accrued. Clean price plus interest accrued. Clean price plus interest accrued. That is how much? 103.10 plus 3.8056 106.9056. Okay, this is 106.9056. 106.9056. So some mistake in my calculation. Then step 4, write down amount borrowed. Amount borrowed. Amount borrowed is equal to, in bracket, first leg, or in bracket, start proceed. Whatever terminology they use in the exam, you follow that. Is it right? Nominal value into dirty price divided by 100 into 100 minus initial margin upon 100. Write down the full formula. Whatever is not given, take it 0. Initial margin is not given, take it 0. So the answer is, your nominal amount is 500 into 106.9056 divided by 100 into 100 minus 0 upon 100. Anybody got the answer? So the amount borrowed will be equal to, write down this answer, 534.528 you are getting? Right, this is the amount you have borrowed. And on this amount, you will pay interest for 12 days at 8%. On this amount, you will pay interest at 8% for 12 days. So write down below, after 12 days, repo interest. Coupon is calculated using 360 days convention, but repo rate is calculated using 365 days. Repo is calculated using 365 days. Is it right now? To solve for repo interest, this question is reverse of the previous problem. Previous problem, repo interest rate you have to compute. Now repo interest rate is given, amount you have to compute. How much is that? 1.4059. Now write down amount repaid by PNB. Amount repaid by PNB. Amount repaid will be amount borrowed plus repo interest. Amount borrowed plus repo interest. This is called second leg payment. This is called second leg payment. So this is equal to amount borrowed 534.528 plus repo interest 1.4059. That comes to 535.94. You can round off. Okay, 9339 is okay. This is the amount repaid. Now this amount includes accrued interest also. This amount includes accrued interest also. Write down a small note. This amount includes accrued interest. This amount includes accrued interest for. This amount includes accrued interest for. Earlier was 137 plus 12. 12 days more have passed. 137 plus 12 more days. This amount includes accrued interest of 149 days. So what is the accrued interest component in that? How much is the accrued interest component in that? So the interest will be calculated on face value, and the convention is to take 360 days. So 10% into 500 into 149 by 360. If they ask you what is the accrued interest in the repayment amount, this is answer 20.6944. And the last thing that they can ask you, what is the X interest repurchase price? What is the X interest repurchase price? Tell me. X interest repurchase price. Very good, Rishabh. Come on, next. X last thing, and then bye bye. You have repaid the dirty price minus accrued interest, reverse working, amount repaid minus accrued interest, amount repaid minus accrued interest. Yes, please reply. You have just computed both the numbers above. Why are you taking so long? Previous to answer, you have to take the difference. Anybody for 515.2395? Say yes. This is the X interest repurchase price. Okay, now just mentally revise this question yourself, you'll understand. Just revise this question mentally, you'll understand how the interest is calculated, how the dirty price or clean price are calculated. Is it right? So these are the two varieties of questions I have taken from money market instrument. So wish you all the best. Thank you very much for joining this SFM marathon revision, and I'm sure you'll do very good in the exam. If you have a doubt, you can WhatsApp on 976692180. You can email on my personal mail ID vinod_ca@yahoo.com. Okay, and this way you can connect to me and ask for any doubts. Okay. So as I had told you, we are starting a test series. From 13th March we will start releasing the paper. There are 4 papers. You can appear in any number of papers you want, 1, 2, 3, 4. Most of the question will be new type of question which are not asked in the exam, so that you should be able to handle surprise elements. And the same thing for FR also. We will try to give new varieties of question not asked regularly in the exam, and this way you will get the shock that, oh, this is also I can be asked in the exam. Okay. Thank you very much. See you soon. Bye bye.